Hello, hi everyone. I'm Ravi Kumar, CA and CMA. So welcome to BCCA. I am FM and BDA faculty for CMA Inter and SFM faculty for CMA Final and also CFR faculty for CMA Final. Okay. I teach CA Final AFM and CA Final FR also financial reporting. So for next 2 to 3 minutes, I'm going to provide details about this FM and BDA batch. Okay, in our BCCA, we are providing CMA Inter Group 1 and CMA Inter Group 2, 100% English as well as Telugu classes. And if you are joining this batch, you can attend live classes in our BCCA app, or else you can buy recorded classes, or else you can attend face-to-face classes at our Nujividu main campus. Okay, and whoever purchasing FM and BDA class will get a concept book and a work book. Okay, so right now 30% discount is applicable on all courses up to June 30 because this is a BCCA anniversary month. So if you want to buy classes, you can buy now. So the link of our app is being provided in the description. Okay, so without wasting time, let us start financial management and BDA. Thank you. So financial management and business data analytics, 80-20. So financial management weightage 80%, business data analytics 20%. So business data analytics completely theory. Financial management is a practical subject. Okay. So before starting our subject, let us see the past paper analysis. How the questions are being asked. You know the question paper pattern, right? So what is the question paper pattern? First you will get section A, 15 MCQs. Each MCQ carries 2 marks. So they're asking basic MCQs only from financial management. They're asking, okay, some basic MCQs, multiple choice questions. Okay. So first section A, 15 MCQs and each MCQ carries 2 marks. I will not say you will get 15 into 2 to 30, but you will be definitely be able to score 12 into 2. That is 24 marks. 24. Even an average student will be able to score at least 10 into 2 in worst case scenario, 20 marks. Okay. So, and next you will get 7 descriptive questions. 7 descriptive questions. Out of 7, you have to write 5. Each question carries 14 marks. And again in that question, you will have a 2 into 7. 2 7 marks questions. 2 7 marks. So for example, in FM and BDA, the last question, 8th question will always be theory from BDA, Business Data Analytics. Okay, theory. For suppose if you are not comfortable with theory, okay, with BDA, for example, then what you can take a 8th question as a choice. 8th question as a choice if you are not comfortable with theory. Okay, but generally in a subjects like FM or SFM, you should not leave the theory as a choice. For example, if they ask practical questions very tough, then you have to rely on theory. Okay, so that's why your paper pattern will be 2A, 2B, 3A, 3B, 4A, 4B, 5A, 5B, 6A, 6B, 7A, 7B. So this is your paper pattern. Okay. So let us see the syllabus and weightage. So first topic, fundamentals of a financial management. Fundamentals of financial management. In that we have a 3 subparts. 3 subparts. First part, introduction to financial management. So nothing but this is a basics of FM. So why are we learning FM? In this topic we are going to learn so basics of a FM. Second, time value of a money. So you might have already seen in CMA foundation, okay, or CA foundation. Time value for money, annuity chapter, simple interest, compound interest, and annuity. So for FM and strategic financial management, so time value for money is very important. Time value of money. So this topic is very important and we have to learn this topic conceptually. So we might have learned this topic in foundation itself, even though if you are not aware of this topic, again, we are going to teach this time value for money from basics. See the weightage of this topic, time value for money. December 23, 1 MCQ. June 24, 2 MCQs, 2 multiple choice questions. And December 24, 0 marks. And June 25, 1 MCQ. So from time value for money, you will not get 7 marks question. You will get only 1 MCQ. But this topic is very important. If you are not able to understand time value for money, without knowing the time value for money, we cannot proceed further. We cannot. Okay. So risk and return. Risk and return. Risk and return, June 24, 1 MCQ. June 25, 1 MCQ. Risk and return. So this topic is final level topic, CMA final SFM topic, risk and return, small topic. So basics are given in this topic. Basics. Basics of SFM, strategic financial management. Okay. So in total, the weightage of first chapter is very less. That doesn't mean we should leave this topic in choice. Because without knowing the introduction to financial management and time value for money, we cannot understand the other topics like capital budgeting, cost of a capital, working capital estimates, etc. So that's why we cannot leave this topic, okay, as a choice. So this topic comes under A category. This topic comes under A category. Okay. Next topic. Institutions and instruments in financial markets. Completely a theory topic. Completely theory. Institutions and instruments in financial markets. You will get one theory question compulsory, and that theory question will be asked in second question. 2A. 2A. So first 2A question will be from institution and instruments in financial market, 7 marks, completely theory. Okay. And 2B will be asked from BDA, business data analytics. 2B. For suppose if you are not comfortable with theory, then you have to take second question and 8th question as a choice. Second question and 8th question. But you might miss some MCQs because multiple choice questions are also being asked from institution and instruments in financial markets. So for example, in December 23, 2 MCQs, June 24, 1 MCQ, December 24, 1 MCQ, June 2025, 2 MCQs. Clear? Okay. So second topic, completely theory. Third one, tools for financial analysis. Tools for financial analysis. So do not worry about the chapter names. Okay. So we are going to discuss, but right now I'm just discussing the weightage. Tools for financial analysis. In this we have 4 parts. 4 parts. So comparative, common size financial statements and trend analysis, you will get 1 descriptive question. 1 descriptive question. And this is very easy. If you learn 1 question for 1 topic, that is enough. That means for comparative financial statement, 1 question. For common size financial statements, 1 question. And for trend analysis, 1 question. That is more than enough. So generally in examination, they will be changing numbers only. Okay. So you will get 1 descriptor. Next, financial ratio analysis. Financial ratio analysis. This is very simple topic once again. Okay. This topic will help you to get exemption. You will get one or sometimes two descriptive questions. Okay. So for example, December 23, they have asked one descriptive and three MCQs. Next, June 24, one descriptive, two MCQs. Next, December. Okay, December 24, two descriptive and three MCQs. From MCQs point of view also, this topic is very important. Okay. So this topic, hardly we might discuss this topic for 6 to 7 hours. 6 to 7 only, but this topic is very important. This topic comes under A category. A category. Okay. And next, December 25, I mean June 25. June 25, one descriptive and two MCQs. Clear? Next, fund flow statement. Fund flow statement, only one descriptive. You will get either cash flow or fund flow. But in December 24, instead of asking a question from fund flow or a cash flow, they have asked a question from ratio analysis. Ratio analysis. Am I clear? Okay. So fund flow statement and cash flow statement, this topic comes under B category. B comes under B category. Okay. And next, sources of finance and cost of a capital. Sources of finance, again, it is a theory topic. No question is being asked from the topic. Cost of a capital. Cost of a capital, 7 marks, and you will get 1 to 2 MCQs. 1 to 2 MCQs. Clear? This topic comes again under A category. A category. Next, capital budgeting. Capital budgeting. Again, this topic will be there in CMA final also. The same topic will get continued in CMA final SFM. First chapter. Capital budgeting. You will get 2 7 marks. 5A, 5B. 5A, 5B. Okay. And you will get MCQ also. Multiple choice question. You will get 1 or 2 MCQs. 1 or 2 MCQs. Okay. Am I clear? Capital budgeting. Working capital management, again 2 7 marks. 2 7 marks. 6A, 6B. 6A and 6B. Working capital management, 6A and 6B. And for the past, okay, out of 4, 3 attempts, one question completely asked from costing. Materials chapter. You know the EOQ concept, right? If a supplier gives 2% discount, whether to accept or not. So that kind of a question was asked in FM, financial management. Okay. So working capital management, again 2 7 marks, and you will get 1 to 2 MCQs, multiple choice questions. Okay. Am I clear? 6A and 6B. Next, financing decision of a firm. Financing decision of a firm. So financing decision of a firm, capital structure and capital stacking. You will get one descriptive question. So they might ask you descriptive question either from capital structure or dividend decisions. For suppose if they are asking you a capital structure, then they will not ask dividend decision. Clearer? Okay. And MCQ, they might ask you MCQ also. MCQ. You will get 1 to 2 MCQs. Leverages, you will get one descriptive question, and you might get what? 1 to 3 MCQs. In December 24, how many MCQs were asked? 3 MCQs were asked from leverages topic, and again this is very simple topic, leverages, and with the 3 formulas you can solve all the questions of a leverages chapter. Next, dividend decisions. Dividend decisions and dividend theories. You will get one descriptive and one MCQ. One MCQ. Okay. So this is all about financial management and BDA, business data analytics. So in business data analytics, we have a 4 units. 4. Total how many units we have? We have a 4 units. Okay. And out of first unit, introduction to data science for business decision making, you will get one descriptive and one MCQ. Data processing, organization, cleaning and validation. You might get one descriptive and 2 MCQs. Okay, in these 4 topics, the most important topics are 8 and 11. Out of 4 units, which are the most important units? 8 and 11. Because 8th unit compulsory you will get one descriptive. 11th you will get one, sometimes 2 descriptive questions. 2 descriptive questions. Okay. So clear? So this is the past paper analysis. So I will categorize these topics into A, B and C, and I will give you the list. Okay, A, B and C. If you are worried about time management, just focus on A category topics. A category topics. Okay, and try to solve questions from Super 50 list under B and C category. That is more than enough. Okay, clear? So these are the topics. In BDA, how many units we have? So we have a 4 units BDA, business data analytics. Okay, so you will get theory question. So under which question you will get theory? 8A, 8B, 2B. 8A, 8B, 2B. Am I clear? Okay. And one more theory topic is there we have. What is the theory topic? Institutions and instruments in financial markets theory topic. You will get 2A. They will ask a question under 2A. Clear? What about capital budgeting? 5A, 5B. Working capital management 6A, 6B. 6A and 6B. Clear? So 3A, 3B. They will be asking a ratio analysis. 3A, 3B. Ratio analysis, comparative or common size financial statements. 4A, they will ask you cash flow statement or fund flow statement, or they might ask you ratios. 4B, they will ask you cost of a capital. Cost of a capital question. Cost of a capital. Okay. So clear? So these are the topics we have. Let us start with financial management. You have already completed what? Cost accounting, right? Cost accounting completed or not? Completed. So what about financial accounting? Completed financial accounting. Okay. So what is our course name? CMA. Cost and management accountant. So what is the purpose of learning accounts? Purpose of learning accounts. What is the purpose of learning accounts? So what is the definition of accounting? Definition of accounting. It is an art of recording, summarizing, classifying, analyzing, interpreting. Next. Computing, communicating to end users. Okay. So first word is recording, right? What is the first word in definition? Recording. So what are you recording actually? Transactions. Yes or no? So for example, okay, plant and machinery is purchased. What is the journal entry? Plant and machinery to bank. Plant and machinery to bank. Yes or no? Okay. So only recording is done in financial accounting. For example, an accounts manager is concerned about what? Recording. Is concerned about what? Recording. So the purpose of learning financial accounting is recording. Yes or no? Now, what is the purpose of learning cost accounting? Cost accounting. What is the purpose of learning cost accounting? What are the objectives? Cost control, cost reduction, determination of selling price, ascertainment of a cost, ascertainment of cost, determination of a selling price, cost control, cost reduction. Yes or no? So the object of cost accounting is nothing but determination of a selling price. For example, if a car is manufactured. So then what is the next step? We have to determine the selling price. At what price that particular car has to be sold. Yes or no? So ascertainment of a cost and determination of a selling price. Of course, cost control and cost reduction, no doubt. So these are the objectives of a cost accounting. Likewise, so what is the purpose of learning financial management? Financial management. Okay. So what is the purpose of learning financial management? What is the meaning of financial management? What is the meaning of financial management, Bharat? So financial management is nothing but what? Management of finance. Okay. No doubt, management of a finance. Management of finance. Okay. So financial management is called as a science of a money. Financial management is a science of a money. So okay. So in early 1900s, the finance manager is concerned about raising the funds. Raising the funds. Now, after, so 1950s, the role has got changed. The finance manager is concerned about raising the fund and utilization of a funds. Utilization of a funds. Okay. Before starting financial management, what is the starting point of a business? For suppose if you want to start any business, what are you going to do first? For example, Manikanda, he wanted to start a business. Okay, he wanted to start a college in Tanuku. So, what is the first step? What is the first step? What is the first step? The first step to start any business, first of all, nobody will be starting a business right away. First step is to estimate the investment. First, we have to estimate the investment required. Investment required. First, we have to estimate the investment required. Yes or no? Is it the first step or not? Yes or no? Okay. So, for example, if Manikanda he wanted to start a college, he has to estimate the investment. Now, tell me, what can be the investment to start a college? Common sense. You are seeing BCCA, right? So, what can be the investment? Without investment, can we start a college or not? No, we have to investment money. Okay, invest money. Yes or no? So, what is the kind of investment we require? I mean, where to invest money? We should take a building on a lease or not? We should take a building on lease. So thereafter, what else is required? Benches are required or not? Okay, we cannot say students to sit on ground, yes or no? So what do we require? We require benches. Next, what we require? We require AC. We require television. We require table, chair, etc., etc. Yes or no? So that means what? So first step is to estimate the investment. How much we require? How much we require? First step. Okay. So the estimation is done. What is the next step? What is the next step? So there can be two types of investments. One, investment in fixed assets. Investment in ఫిక్స్డ్ అసెట్స్. నువ్వేనమ్మా మహాతల్లి బంగారు తల్లి, నీ పేరేంటి? కావ్య. కావ్య ఫ్రమ్ కాత్మండు. సరిగ్గా వినమ్మా. సో the point is, first topic is, I mean, first step is to estimate investment, and investment is required for fixed assets and current assets. Now tell me, AC is a fixed asset or a current asset? AC is a fixed asset. What about furniture? Furniture is a fixed asset. Okay, so we should make an investment in fixed asset and current asset. Current asset example, cash. Cash is a current asset. We have to keep some cash or not? Any organization, it has to keep some cash. Why? Why we should maintain cash? What is the purpose of keeping cash? The purpose of keeping cash is to meet the transactional needs. To meet transactional needs. For example, you might be keeping cash. Purpose number one, to meet a transactional need. What is the transactional need? You might purchase something in canteen. So that is a transactional need. First need, transactional need. Second reason, speculative need. Speculative need. Speculative need means, for example, okay, so Bharat might keep some cash during IPL season. During IPL season, Bharat might keep some cash. That means, what is the purpose? Purpose is not transactional need. The purpose is speculative need. Speculative need means nothing but he is keeping that cash for IPL betting. He is keeping that cash for IPL betting. Okay. Third reason, safety need. Safety need. So why do we keep cash? Safety. For suppose we might get health affected, our health might get affected. Okay, or some emergency may arise, so that's why we keep some cash. Okay, so likewise organization also, organization will maintain a cash for three purposes. First reason, transactional. For example, BCCA keep cash for payments, for payment of salaries, electricity bills, etc. Okay. Second reason, speculative need. So generally we don't keep cash for speculative need, but okay, some companies might keep a cash for speculative purposes, especially real estate companies. Real estate companies may keep some cash for what? Speculative purposes. Speculative means suddenly land price might rise or sudden land price might fall. If a land price suddenly decreases, then real estate company wants to buy the land. Yes or no? Real estate company will keep a cash for speculative need. ఎందుకంటే జనరల్గా ఫర్ సపోజ్ ఇఫ్ అ ల్యాండ్ ప్రైస్ డిక్రీజెస్, దెన్ ఏం చేస్తారమ్మా? రియల్ ఎస్టేట్ కంపెనీ విల్ బై ద ల్యాండ్. Likewise, every mother will keep a cash for speculative purpose. If a gold price decreases, okay, mother gives entry and sheep start purchasing gold. Yes or no? So generally cash is maintained for three purposes. What are the three purposes? Transactional need, speculative need, okay, so and the safety need, okay. Now the point is financial management. So before starting a financial management, anybody whoever wanted to start a business, first step is to estimate the investment. Estimate the investment. Where do we invest money? We invest money in fixed assets and current assets. Fixed assets and current assets. For example, DMart. DMart. DMart has started a store in Nujividu, yes or no? Near our college. So now, so they have invested in what? Fixed assets and current assets. Are you able to identify the fixed assets and current assets in DMart? Yes. If you are entering into the DMart, so whatever the structure you are finding it, that structure is fixed asset or a current asset? Fixed asset. What about the stock inside? What about the stock inside? Current asset. That means they have invested in fixed assets and current assets. Stock is a current asset. Stock is a current asset. So the point is, whoever wanted to start a business, first step is estimation of investment. Estimation of investment. Estimation of investment. What is the next one? Investment is made in what? Investment is made in investment in fixed assets and current assets. Fixed assets and current assets. Okay. Next, after estimation, what is the third step? After estimation, what is the third step? Third step is procurement. Apply your common sense. Apply common sense. What is the third step? Procurement. For example, we have estimated an investment. So we require 100 crores to start a project. So what is the next step? Are you getting my point? Estimation of investment is done. What is the next one? We have to decide whether to start a business or not. We have taken a decision to start a business. We decided to start a business. What is the next step? We have to procure fund. We have to procure fund. Straight away we cannot purchase building. We need funds. Yes or no? For example, I want to start a multiplex theater. So okay. So nearby our college, multiplex theater. So we have estimated an investment. We require 20 crores to start a multiplex theater. So we decided to start a multiplex theater. What is the next step? We have to procure 20 CR funds, 20 crores funds. So what are the sources? Tell me the sources of procuring that 20 crores. Bank loan. Okay. Any other source? Partners. Forming a partnership and getting money from partners. Next. Getting funds from public. Getting funds from public. Okay. Simply we can categorize the sources into two. Own, loan. Either own or loan. For example, if a company is issuing equity shares, company is issuing equity shares. Is it a loan or a own? Loan or own? Own. Are you getting my point? For suppose I want to start a multiplex theater and I'm procuring fund from your batch. You are investing in equity share capital. You are investing in equity share capital. Now who is the owner of that multiplex theater? We all are the owners of a multiplex theater. This is not a debt. Debt means loan. This is not a debt. So this is own. Own. Okay, if a business is not doing well, am I liable to repay the loan? I mean, am I liable to repay to you? No, because you are making an investment in equity shares. Equity shares. What is the other source? Instead of getting equity from you people, we can go for preference share capital. So generally, we categorize preference share capital as either equity or loan, because it is a hybrid. Preference share capital is a hybrid source of a finance. Hybrid means there are two breeds. Two breeds. Two breeds. One, it is having a features of both equity and debt. Both equity and debt. For example, preference share capital. Do they have voting rights? Preference share capital. Preference shareholders do not have any voting rights. Yes or no? That means it is similar to debt. Debenture holders will not have any voting rights. Preference holders do not have any voting rights. They both have same features. What about the rate of interest on debenture? Fixed. Rate of interest on debenture is fixed. What about the dividend rate on preference? Preference dividend rate is also fixed. Again, the features are matching. So here the preference share capital can be categorized as what? Debt. Okay. But preference dividend, are we going to pay when the company is having losses? When the company is having losses, we are not going to pay preference dividend. Preference dividend is paid only in case of profits. Preference dividend is an appropriation to the P&L. Appropriation to the P&L means only if there are profits, we are going to pay preference dividend. That means this feature is matching with equity share capital. What about interest? Interest has to be paid even if the company is having losses. Interest is a charge to P&L. Charge to P&L. Charge and appropriation. These words are very important. You might have learned in financial accounting. Charge. Charge means we have to pay irrespective of a financial position of a company. Whether we are getting a profits or losses, we have to pay. Example, interest is a charge to P&L because payment of interest is mandatory. What about preference dividend? It is an appropriation. It is an appropriation. Why it is an appropriation? Only if there are profits, then you appropriate it to preference shareholders. Equity dividend is also an appropriation. Equity dividend is also an appropriation. Clear up? Okay, done. So now my point is, if you want to start any business, first step is to estimate investment. Second, where are we going to make investment? Investment in fixed assets and current assets. So we decided to start a business. What is the next step? Procurement of fund. From where can we procure fund? Own or loan. Remember these two words, own or loan, or we can call it as equity or debt. Equity or debt. Equity or debt. Clear? So for example, let us assume equity shareholders, girls equity shareholders and boys debenture holders. Boys debenture holders. Clear? Debenture holders means company. I am the company and you are the debenture holders, and these are equity shareholders. So company is doing a business. If a company is earning profits, it will pay dividend, equity dividend to equity shareholders, interest to the debenture holders. If a company is having losses, even then company has to pay interest to the debenture holders, but dividend need not be paid because dividend is an appropriation to P&L. Interest is a charge to P&L. Clear? Okay. So procurement has to be done. Procurement. And here we have to decide from where to procure money. Equity or debt. Equity or debt. That has to be decided, yes or no. So from where to procure money, tell me. Which is better one? Which is better one? Equity or debt? Why equity? Why equity? For example, okay, BCCA wanted to take a new hostel on a lease. It requires 1 crore investment. So let us think of from the point of view of a BCCA. BCCA require 1 crore amount. So BCCA is having two options. One is taking from equity shareholders. Second is getting 1 crore from debenture holders. Now tell me which is the best option? Equity is the best option. Okay. Why equity? Why equity? Even if you tell wrong answer, that's fine for me. Tell me something. Equity or a debt? Okay. So losses, in case of a losses, we need not pay dividend. In case of a losses, we need not pay any dividend. Okay, fine. That is the plus point. Because if a BCC is not doing well, we need not pay any dividend. Okay. And repayment of a capital, is it mandatory or not mandatory? Is it compulsory or not compulsory? Repayment of capital. Repayment of capital to equity shareholders is not compulsory. If a company went into liquidation అంటే తెలుసు కదా, దివాలా తీసింది. సో క్యాపిటల్ రీపే చేయాలా లేదా? బీసీసీఐ నీడ్ నాట్ రీపే ద క్యాపిటల్. అదే డెట్ అయితే ఇఫ్ అ బీసీసీ ఈజ్ నాట్ డూయింగ్ వెల్, ఇట్ హ్యాస్ టు పే ఇంట్రెస్ట్, it has to repay debt. It has to repay debt. Yes or no? Fine. So which is the best option? Equity. If equity is the best option, that means FM has got completed. We can leave now. Okay. So now I will tell the minus points. If I take capital from these girls, I will tell you the minus points. Okay. First minus point. What do you think right now? Control is with Ravi sir or all these girls? Present, as of now. Who is taking a decision? I'm taking a decision. When to start a batch, when to close, okay, what to do, what not to do. Everything is being done by Ravi sir. Yes or no? Promoter. Promoter means a person who gets an idea of starting a company. I'm the promoter and decision making lies with me. Yes or no? Now, if I take 1 crore from these girls, what happens? They will get ownership. They will get ownership. Okay. So after 5:30, I wanted to give a break. Then Shahin will say, no, sir, please do not give a break. I'm the owner. I'm the owner. I agreed. Okay, so let us postpone the break to 6. Okay. So then Amulya will say, sir, not 6. Give break now itself. Yes or no? And some other girl will come and say, give break after 8. Okay. And some other person will come and say, so why don't you start branch in Chennai or Bangalore, something. That means what? Everybody will be involving in what? Decision. If everybody gets involved in decision making, is it a plus point or negative point? Negative point. Because we cannot come to the conclusion. We cannot come to conclusion. And are getting my point? If I ask you, so for example, if I give a responsibility to Deva, let us decide one place. We shall go to tour. We shall go to tour. You decide the place and date. So on one day, we all together shall go on a tour. I gave the responsibility to Deva. So by evening he will come with a date and place. Yes or no? Clear? For suppose if I gave this responsibility to all girls and I asked them to decide a place and date. What happens? Date and place will get finalized or not? Will not get finalized. That means ownership will get diluted. Ownership will get diluted. So before starting any business, first step is to estimate investment. Second step is to where to invest. Investment in fixed assets and current assets. So whatever the structure you are seeing in DMart structure, that is fixed asset. What about the stock? Current asset. Okay. So in DMart counter you will find some cash or not? You will find some cash. That is current asset. Current asset. So we have decided to start a business. What is the next step? Procurement of fund. From where to procure money? Own money, loan. Own or loan. Which is the best one? Loan or own? Own or loan? Okay, so that we are going to learn in capital structure chapter. Capital structure. Own or loan. So financial management is concerned about two aspects. Two aspects. You know that financial accounting purpose is to record. Cost accounting purpose is to ascertain cost, determine selling price. Okay. Now, financial management is concerned about procurement of fund and utilization of a fund. Okay. So we got an admission from Nepal, Kavya from Kathmandu. So thank you for coming all the way from Nepal. So financial management, two aspects. Financial management, two aspects. Okay. So two aspects. First aspect, procurement of fund. Second aspect, utilization of a fund. So simple terms. Accounting purpose, recording. Cost accounting purpose, ascertainment of a cost. Third, FM, financial management objective, procurement of fund, effective utilization of a fund. Okay. So first FM, and then costing and last accounting. Okay. Starts with FM. Any business starts with FM because to start a business you require funds. So how to procure money, that we are going to learn in financial management. How to utilize money, we are going to learn in financial management. Accounts is simply recording. For example, we purchased an AC. You just record in accounts. But whether to purchase an AC or not is a part of a financial management. Whether to start a DMart store in Nujividu or not is a part of a financial management. Once started, so the daily transactions are recorded. It is a part of financial accounting. At what price a dairy milk silk chocolate has to be sold? That is a part of a cost accounting. For example, if you are going to a PVR cinemas, PVR Inox, whether to start a PVR Inox theater in Nujividu or not is a part of a financial management. At what price popcorn has to be sold is a part of cost accounting. Okay. Popcorn sold for rupees 300. Recording it. Financial accounting. So two aspects of financial management are procurement of fund, utilization of a fund. Okay, for procuring fund we have two sources, own, loan. Girls, boys. Girls, equity. Girls, equity. Boys, debt. Okay. And next what? Utilization of funds. We utilize fund for two purposes. Fixed assets, current assets. Fixed assets and current assets. So the two aspects of financial management are procurement and utilization of funds. Okay. Are you able to understand this part? Okay. So before starting any business, first step is to estimate an investment in fixed assets and current assets. Then decide. You have decided to start a business. Next step is to from where to procure money. You have to decide from where to procure money. So generally we have two sources: own and loan. Own and loan. So this is everything is a part of financial management. So two aspects of financial management are procurement of fund and effective utilization of a fund. Am I clear? So clear? Okay. Now let us discuss from which source we have to procure money. So there are two sources, right? Debt, equity. Debt and equity. While procuring funds, we should consider four factors. While procuring funds, we should keep in mind four factors. Four factors we should keep in mind. First factor, risk. Second factor, cost. Third factor, control. And fourth factor, flexibility. Okay. Apply common sense. Okay. So this is a common sense subject. So for procuring fund, generally we have two sources: equity and debt. But while procuring fund, we should consider four factors. We should keep in mind four factors. Four factors. So first factor, risk. What is this risk? What is the meaning of a risk? When you join CMA, your relatives and friends might have told, why are you taking risk? Yes or no? They have told you or not? Why are you taking risk? If somebody is getting married, we say that person is taking risk. That too after marrying, he is going to honeymoon to Meghalaya in Air India flight via Ahmedabad. Then what do we say? He is taking a risk. He is taking risk. Why? Why do we say that? So what is the meaning of that risk? For example, Bharat, he is jumping from third floor. What do we say? Okay. He is taking risk, yes or no? So Kavya, she is going opposite to Balaya. Okay. So she wanted to take a selfie from Balaya. She wanted to take a selfie photo from Balaya Babu. So is she taking a risk or not? She is taking a risk. So what is the meaning of this risk? Risk. Many a times you might have heard about the word risk. What is the meaning of risk? For example, if Bharat is jumping from third floor, what might happen? Leg fracture, okay, or hand fracture, yes or no? So okay, okay, done. Next, Kavya is going to take a selfie from Balaya. She's taking selfie with Balaya. So now tell me, what is the, I mean, what is the chance? What might happen? Okay. So likewise, for example, You have taken a CMA. Why your relatives or friends are worried? Why? Why they are saying you're taking a risk? Why? Because there is a possibility of failure. Possibility of failure. So that's why they are worried. Yes or no? Possibility of a failure. Okay. Manikanda is getting married and going to honeymoon to Meghalaya. Why do we say he is taking risk? Why do we say he is taking risk? The reason is he might get murdered by his wife. Yes or no? Okay, so that is the reason. That is the reason. So the point is, there is a, in all these examples, the common point is there is a possibility of a loss. Possibility of a loss. So they might get fracture, or they might lose their life, or they might lose their result. Yes or no? Risk means possibility of occurrence of a loss. You have to remember this word. So this is the basic term risk. Risk means what? Possibility of occurrence of loss. Possibility of occurrence of a loss. So paper analysis, weightage analysis. So what is the first topic? Fundamentals of financial management. So fundamentals of financial management, it contains three subparts. First one, introduction to financial management, time value of a money, risk and return. Risk and return is a CMA final topic. Risk and return topic, small topic, but the basics of a strategic financial management has been given in FM. Okay, so the weightage of this topic is very less, but so we have to learn this topic. Without this topic, we cannot understand cost of a capital, capital budgeting, working capital estimates, etc. So that's why we cannot leave this topic as a choice. Okay. Next one, institutions and instruments in financial markets. Complete theory. 2A. You will get one descriptive question. Next, tools for financial analysis. In that we have a four parts. Comparative common size financial statements and trend analysis. Financial ratio analysis. Fund flow statement. Cash flow statement. Fund flow statement and cash flow statement. The next, sources of finance and cost of a capital. Cost of a capital, you will get compulsory descriptive question. Capital budgeting 5A and 5B. Working capital management 6A and 6B. Financing decision of a firm. Financing decision of a firm. Capital structure and capital stacking. Leverage analysis and EBIT EPS analysis. Dividend decisions and dividend theories. Next, business data analytics. Business data analytics, you will get 3 7 marks questions. 3 7 marks. 8A, 8B, and 2B. Okay, 8A, 8B, and 2B. So there are 4 units in business data analytics. Okay. So now, so let us come to the module 1. What is the module number 1? Fundamentals of financial management. Fundamentals of financial management. So in that we have a 3 topics: introduction to financial management, time value of a money, risk and return. So time value of money is very important topic, and risk and return. So yesterday we have seen introduction to financial management. Introduction to financial management. What is the purpose of financial accounting? Recording. Recording is the main purpose of learning financial accounting. What about cost accounting? Cost control, cost reduction, ascertainment of cost, Determination of a selling price. Yes or no? So whether to start a new project or not. So that is not a part of cost accounting. But at what price a good produced has to be sold. So that is a part of a cost accounting. So financial management, the two basic aspects of financial management are procurement of fund, effective utilization of fund. So the finance manager, he is responsible for procuring fund and utilizing the funds properly. Utilizing the funds properly. Okay. So these are the two basic aspects. So now introduction. Any entrepreneur goes through the following stages of a decision making. First stage, decide which assets to buy. Decide which assets to buy. Yes or no? For example, Manikanda, if he wanted to start a college, so first stage is to decide which assets to buy. So first asset to be bought, car. Okay, show off. Okay, decide which assets to buy. First stage, yes or no? You can imagine any business. For example, if somebody wanted to start a okay theaters business, multiplex theaters like Mahesh Babu, AMB cinemas, like Allu Arjun. Okay, in Amirpet, there is a theater for Allu Arjun, yes or no? If you want to start a theater, okay, then what? First, you have to decide which assets to buy. Which assets to buy. For example, Basha, Babjan, he wanted to start a tea stall opposite to BCCA. So he has to decide what assets to buy. What assets are required to start a tea stall? Chairs, tables, yes or no? Okay, steel, iron. I mean, so these are the assets. Decide which assets to buy. Iron sheets, iron sheets, okay, and tables, chairs, etc. He has to buy. Next stage two, determining what is the total investment required. And stage three, determining working capital requirement. Working capital requirement in case of a tea stall. What is the working capital? Usmania biscuit, Chakkalu, Chakralu, all these are working capital. That is not a fixed asset. So, okay, Usmania biscuit is what? Current asset, stock. Okay. So, he has to determine working capital requirement also. Working capital requirement. So, first stage, decide what assets to buy. Example. So, for example, if you are seeing a tea stall, okay, so what asset he has to buy? Iron sheet, chairs, tables, etc. And next, determine the total investment. 5 lakhs is the total investment. Let us assume. And third step, determining working capital requirement. Working capital means in case of a tea stall, what is the working capital? Usmania biscuit, tea powder, coffee powder, Horlicks, Boost, etc. These are working capital. Okay. So likewise, okay, Kavya, she wanted to start a Kmart. Instead of D-Mart, she wanted to start what? Kmart. Okay. So in that Kmart, so I mean girls can buy Korean items, everything. All Korean. Okay. So Kmart. So now the point is whatever the inventory items, inventory means stock items you are finding in Kmart is a working capital. Working capital. Working capital means current assets minus current liabilities. Current assets minus current liabilities. Clear? So current asset example, debtors, cash, stock, and in stock also raw material stock, work in progress stock, finished goods stock. All these are current assets. And the fourth stage is to decide. Okay, Babjan, he wanted to start a tea stall. Okay, fine. What is the fourth stage? To decide what all sources does the entrepreneur need to tap to procure funds. What all the sources? What all the sources? So tell me, for suppose if he is an entrepreneur, if he wants to start a tea stall immediately, what can be the source? He cannot incorporate a company and issue equity share capital. Yes or no? For 5 lakhs, for 5 lakhs, for procuring 5 lakhs and for to run a tea stall, okay, incorporating a company. If he wants to incorporate a company, public company, for that 50,000 would be the charges. He has to incur 50,000 expenses. Okay. And moreover, whether he can accept funds from public or not, public will not be making investment in that Babjan tea stall. Why? Nobody knows about Babjan, yes or no? Why do they invest? Okay. So everybody knows about Cave Coffee Day, CCD. Cave Coffee Day. You might have seen Cave Coffee Day stores throughout India elsewhere, yes or no? So if a Cave Coffee Day is asking funds from public, then obviously what public will be interested. Likewise, if a Zomato is asking for investment, Zomato, public will be investing in Zomato because everybody knows about Zomato. But what about Babsan? Okay. So the point is, generally, if you apply your common sense in the beginning itself, in the beginning, if he is an entrepreneur and if he is starting as a business, then source can be what? Own fund. That too not equity share capital. He has to rely on his father. He has to rely on his father or friends. Yes or no? So that can be the source. That can be the source. Whether bank will give a loan or not, even bank will not give a loan because bank will ask how will you repay the installment? What is the source of income? What is the source of income? But however, so central government scheme is there, Mudra loan. Mudra loan without any security. Central government will give a loan up to 10 lakhs. But he should show the tea stall. Are you getting my point? So that means generally, if a person is a small entrepreneur, or if he is starting a business now itself, sources will be very less. Sources will be very less. Yes or no? Yes or no? For example, if I am starting a business, then I might be able to procure 20 crores or 25 crores. But if you are starting the same business, you will be able to procure only 5 to 10 lakhs. Why? Because you are starting a business for the first time. Okay. So fourth stage is to decide what all the sources does the entrepreneur need to tap to procure funds. These are the four stages. Okay. So here financial management is concerned with two aspects. What are the two aspects? Procurement of fund, effective utilization of a fund. Procurement of fund, effective utilization of fund. So these are the two main aspects of a financial management. If you see the syllabus, in syllabus we have a topics like cost of a capital, 7 marks compulsory question, capital structure and leverages. You can see the index, okay? So these three topics comes under which category? Procurement of a fund. As already we discussed, there are two sources for procurement of fund. One is own fund, second is loan fund. Own fund, loan fund. Okay, or else we can call them as equity, debt. Equity and debt. Okay, two sources. So, capital structure means capital mix. Capital structure means what? Capital mix. So, we have to decide as a finance manager, we have to decide whether we should procure 100% equity. 100% equity or 80% equity, 20% debt, or 50% equity, 50% debt, or 20% equity, 80% debt. That we have to decide. So that we are going to learn in capital structure chapter. Capital structure. We cannot, I mean, in all cases, we cannot procure 100% equity or 100% debt. So we are going to discuss. And next, the second one, effective utilization of a funds. We utilize the funds for two purposes. One is fixed assets, second is current assets. Fixed assets and current assets. Yes or no? Tea stall, chairs, tables, fixed assets. Usmania biscuit, current asset. Kmart, whatever the structure you are finding, Kmart, fixed assets. What about the stock inside? Current asset. Okay. So we utilize the fund for two purposes. One is fixed asset and second one is current assets. So that fixed assets we are going to discuss under a topic capital budgeting. Capital budgeting. What about the investment in current assets? Working capital management. Working capital management. Okay, clear? Effective utilization of funds. So what are the objectives of a financial management? Purpose. I mean objective. Okay, objective of completing CMA is to get good salary. Yes or no? Likewise, objective of learning financial management or applying financial management techniques. What is the objective? First objective, profit maximization. No doubt. Everybody will do a business to maximize the profit. Second objective, wealth maximization. What is wealth and profit? Both are not same. Profit is different from wealth. Profit is different from wealth. So what is profit and what is wealth? Okay. So for example, Amulya, she is having 2 acres of a land. She is doing farming. She is doing farming, 2 acres of a land. 1 acre cost 50 lakhs. So 2 acres, 1 crore. 2 acres, 1 crore. She is doing a farming. Okay. So for the last 6 months on the crop, she got a profit of 50,000 per acre. 50,000 profit per acre. That means for 2 acres, the profit is 1 lakh. Now tell me, what is the profit here? 1 lakh is the profit. No doubt, objective of doing farming is profit maximization. Done. What is wealth here? What is wealth? 1 crore. Land value is a 1 crore. Wealth. Wealth. Wealth is different. So if I ask what is the wealth of Amulya, what is your answer? 1 crore is the wealth of Amulya. How much profit she earned? 1 lakh is the profit earned. So profit is different from wealth. So you might be thinking that, sir, if a profit increases, automatically wealth increases. Yes, no doubt. For example, if she is getting every year 50 lakhs, every year 50,000 on each acre, she will be investing that 50,000. Yes or no? Yes or no? If she is getting profits, what she will do? She use that profit to purchase a piece of a land. So that's how she can increase her wealth. Yes or no? Am I clear? Clearer? So that means if a profit increases, obviously wealth also increases, no doubt. Then why there are two objectives, profit maximization and wealth maximization? If a profit increases, that no doubt wealth increases. No doubt. If profit increases, no doubt what? Wealth increases. But wealth not just depending on one factor, profit, wealth depends upon two factors. Two factors. One is the profit, second one is risk. Risk. Yesterday I have discussed about risk. Risk means possibility of occurrence of loss. Possibility of occurrence of loss. Okay. Somebody is going opposite to taking selfie with Balaya. That means what? Taking risk. And one more person jumping from third floor. Bharat. So that means he is taking risk. And Manikanda, he is getting married and going to honeymoon to Meghalaya. So he is also taking risk. He is also taking risk. Yes or no? Here the risk means what? Possibility of occurrence of loss. Possibility of occurrence of loss. Am I clear? So wealth always depends upon two factors. One is profit, second one is risk. Profit and risk. So let me give an example. Okay. So for example, Deva, okay, he is getting 1 lakh salary. He is getting 1 lakh salary per month. He is working in L&T or Infosys. He is working in Infosys. And what is the salary he is getting? 1 lakh. Okay. Manikanta, he is working in, okay, government sector. Government sector. And he is getting salary of 1 lakh per month. Same salary. Same salary. Now tell me, whose value will be more? Manikanta or Deva? I mean, in society perception, who will have a greater value? Obviously, Manikanta will have a greater value. Why Manikanta will have a greater value? Government employee. So, okay, government employee. So, what? What is the reason behind it? Risk, less risk, less risk. Okay, less risk. For example, if Deva is sleeping in office, what happens? Next day, so management will remove him from the particular job, yes or no? What about Manikanda? No, because it is a government job, yes or no? So the point is, who will have a more value? That means profit is same. Still, Manikanda will have a greater value. Why? Less risk. For example, Monica, she is earning only 80,000 government job. So now tell me, Deva value will be more or Monica value? Monica value only. Why? Less risk. Less risk. That means if risk decreases, value increases. These are very fundamentals you have to understand and very important. If risk decreases, value increases. Remember this point. Wealth depends on two factors: profit, risk. If a profit increases, wealth increases, no doubt. If risk increases, value decreases. Yes or no? For example, Sunita, she is having a building in Hyderabad. She is having building in Hyderabad and building is generating a rental income of 10 lakhs. Rental income of 10 lakhs. Rental income 10 lakhs. Clear? Okay. So Sunita is having another building in Tehran, Iran capital. Okay, generating a same amount of a rent. Which building will have a more value? Hyderabad or Tehran? Hyderabad. Why Tehran? There is a war between Israel and Iran. The building might get collapsed, yes or no? Even America is doing a war on Iran, yes or no? So the point is risk is high. Risk is high. Risk increases, value decreases. Okay. For example, she is having a building in Israel also. The value will be less. Why? risk increases. If risk increases, value decreases. If risk increases, value decreases. The basic fundamental. Okay. So we are going to discuss extensively, but for the time being, there are two objectives of FM: profit maximization, wealth maximization. Which is the superior objective? Wealth. That means profit or wealth. Wealth. We choose only wealth. So wealth maximization is the superior objective. Am I clear? Okay. Next, financial management focuses on three important decisions of a firm. So already we discussed investing decision. Investment decision means where to put money. Where to put money. Second, financing decision, from where to get money. From where to? Equity or debt? And in what proportion we should procure money from equity and debt. Third, dividend decision. Company is having profits. Company is having profits. So company can distribute these profits as a dividend, or second option, can retain the profits and use those profits for business. Yes or no? For example, Manikanta Educational Society is having 100 crores profit. What it can do? Okay, what it can do? It can distribute 100 crores as a dividend. You have to observe one point. Manikanda Educational Society. You might have gone through the Companies Act 2013. Manikanda Educational Society means a Section 8 company. Section 8 company cannot distribute dividend. So here straight away the answer is it cannot distribute dividend. But suppose if it is Manikanta, okay, Beverages Private Limited. Beverages Private Limited. 100 crores profit is there. So it has a two options. Company, either it can distribute 100 crores profit as a dividend to the shareholders. What is the second option? Retain 100 crores profits. Retain 100 crores profits and can reinvest. Can reinvest. Reinvestment means it will start another manufacturing plant. Beverage means what? Drink. Not cool drink. Beverage means what? Drink. Clearer? Okay. So dividend decision means whether to declare a dividend or not. Whether to declare a dividend or not. So that we are going to discuss in a chapter, dividend decisions chapter. Dividend decision. Dividend policy. Okay. Clear? So financial management is concerned about what? Three decisions. Investing decision, financing decision, dividend decision. But suppose if we are not procuring money, that means no use of accounts, no use of costing. First a finance manager has to procure money and invest money. Clear? Next. While procuring funds, the firm has to consider four factors. The firm has to consider four factors: risk, cost, control, flexibility. Risk, cost, control, flexibility. So, financing decision, from where to get money. So, yesterday I have told girls, equity shareholders, boys, debenture holders. Now, the point is, I am the company. So, how to procure money? So, before procuring money, so we have to consider four factors. We should keep in mind four factors. What are the four factors? Risk, cost, control, flexibility. What is the risk? Risk means possibility of occurrence of loss. Risk means a possibility of occurrence of loss. Clear? Okay. So possibility of occurrence of loss. So tell me, in which case company will have a high risk? Debt or equity? Debt or equity? Debt or equity? Debt. Why? On debt, company has to pay interest. For example, company is not doing well. Company is not doing well. Okay. If a company is not doing well, still company has to pay interest. Company has to pay interest. Yes or no? Manikanta will ask for interest. I have to pay. So there is a possibility of occurrence of loss. No sales. You know the basic income statement, right? Marginal basic income statement. Sales minus variable cost, contribution minus fixed cost, profit. Here in finance, income statement will change. Okay. For example, sales 0, variable cost 0, contribution 0, but you will have some fixed cost, right? Let us assume fixed cost 1 lakh. Then profit will be minus 1 lakh. For suppose if a company is having interest also 1 lakh, then what is the loss? Minus 2 lakhs. Possibility of occurrence of loss. For suppose if it is equity, Ishwar Naik. For suppose if it is equity, then what? For suppose if it is equity, then what? So is there any payment of interest? No. Payment of interest mandatory or not mandatory? Not mandatory. That means the sales 0, variable cost 0, contribution 0, fixed cost 1 lakh, profit minus 1 lakh. Yes or no? So the chances of losses will increase in case of a debt or equity. Debt or equity. Debt or equity. Debt. So from risk point of view, which is the best source? Equity or a debt? Equity or a debt? Equity. If you want less risk, better to procure fund from equity. Clear? For suppose if I procure 5 crores from girls and if I am starting a branch in Karnataka, no student has joined in that branch. Still okay. Why? Still okay. Why? No need to worry. I am not worried about payment of interest. Yes or no? Okay. So the point is no risk. For suppose if I am taking 5 crores debt from boys and if I start a branch in Karnataka and if no student is coming, then what? Then there is a risk. Manikanda will come and ask for interest. I have to pay. So if I don't want risk, which is the best option? It is better to procure fund from Bangar Talul, yes or no? Okay, but there are other factors to be considered. Other factors, not just the risk. We have to consider other factors also. Flexibility. What is this flexibility? For suppose we started a branch in Karnataka and that branch is doing very well. Okay. If I wanted to repay debt, is it possible or not? So I have a profits were generated in first year itself. So now the company wanted to repay the debt. Will it be possible or not? Yes, possible. Flexible, yes or no? Yes or no? For suppose if I want to repay the equity capital of a girls, okay, I told them to go out. Is it possible or not? Will they go out or not? They will send me out, yes or no? The point is it flexible or not? You know the buyback conditions also. In Companies Act, you might have gone through the buyback. You cannot buy back 100% equity share capital at once. There are conditions. And even in that case also, you have to make a proportionate buyback. Proportionate buyback. We cannot expel one shareholder. Are you getting my point? For suppose in Karnataka, branch is doing well. I wanted to pay back the capital of Monica. Will she accept? For suppose if she is not accepting, I can pay off and I can send her out or not? No. That means in case of equity, there will be a flexibility or not? Equity, flexible or not? Equity is not flexible. What about debt? Flexible. If I take a bank loan, I can pay off the loan at any time. What about equity? I cannot pay off. Clear? So we want flexibility or not? Company want flexibility or not? Company want flexibility or not? Yes. Company want flexibility. Promoter. The person who has started a business always want flexibility. If a promoter wants flexibility, which is the best option? Debt equity. Bangar talla, bangar tandrula. So debt is the best option. Debt is the best option. From flexibility point of view, debt is the best option. Next, control. Next, what? Control. Okay. So, for example, so we have to decide faculties for Karnataka branches or no? Karnataka branch. For DT, I want to, take Bharat as a faculty. Let us assume for DT, Karnataka branch, not in, in our Ravi sir is there, okay? So, so DT, Bharat, I want to take Bharat as a faculty. So will I ask all the debt holders or not? Will I ask debt holders or what? I will not ask anyone. Yes or no, no need to ask because completely control lies with promoter. Yes or no? For suppose if it is a debt, if it is a equity. So my proposal is Bharat is a DT faculty. Amma appude already. She is saying no. She is saying no. Okay. So the point is, so I have to ask everyone. So before taking any decision, what? I have to ask them, yes or no. Bharat, okay or not? What about Babchan? So okay. So what about Manikanta? What about Manikanta? No. So will that branch will succeed or not? No. Why? The reason control is getting diluted. Control is getting diluted. Till now, control is with myself, with the promoter. But now the control is getting diluted. Okay. Yes or no? Clear? So control should get diluted or not diluted? Control should not get diluted. There has to be one person to lead. Only one person has to lead. Okay, so then what? Decision making will not get delayed. Are you getting my point? If I take equity from girls, I lose flexibility, I lose control. Okay, and the other factor, third factor, let us come to the cost. Here the cost means expectation. Cost means what? Expectation. Cost means expectation. Company is offering 10% debentures, 10% debentures and equity to the girls. 10% debentures means what? debenture holders will get 10% interest. Debenture holders will get 10% interest. Yes or no? Am I clear? So I'm giving the same option to girls also, but they have chosen equity. They have chosen equity. That means they do not have any expectation or what? They do not have any expectation or what? I gave an offer of 10% debentures or equity. Instead of choosing 10% debentures, they are choosing equity. That means they do not have any expectation or what? They have expectation. No doubt. Here cost means expectation. Cost means expectation. So their expectation is less than 10% or greater than 10. Less than 10 or greater than 10? Greater than 10. Greater than 10. What is their intention? What is their intention? This business will succeed. So pay off 10% interest to okay debenture holders. The rest all profits we can enjoy. Yes or no? So their expectation less than 10 or more than 10? More than 10. Expectation. I'm talking about expectation. Yes or no? Will they expect just 5%? 5%? 6%? Who is taking more risk, boys or girls? From investors point of view, debenture holders are taking more risk or equity shareholders? Equity shareholders are taking more risk because they may or may not get dividend, they may or may not get back the capital. Who is taking more risk? Equity shareholders are taking more risk. Now tell me the point, who will have a more expectations? Obviously equity shareholders will have a more expectation. So basic fundamental till final you have to remember this point. If risk increases, expectation increases. If risk increases, expectation increases. A BCom student, okay, and CMA student, who will have a more expectations? CMA students will have a more expectation or BCom student? CMA student will have a more expectation of a salary. Why? Why? More risk. Why? More risk. Yes or no? If you compare BCom student, I mean, debentures are like BCom. Debentures are like BCom and equity like CMA. Business may or may not succeed. If business will not succeed, then they will not get back the capital. So that's why if risk increases, what happens to the expectation? Expectation increases. If risk increases, expectation increases. Are you able to understand this point? If risk increases, expectation increases. Clear? For suppose after CMA, Manikanta he is preparing for UPSC, Union Public Service Commission exams. He is preparing for IAS. So will his expectation increase or decrease? His expectation increases. If risk increases, expectation increases. Yes or no? Yes or no? So that is basic thing. If risk increases, expectation increases. And if expectation increases, value decreases. We should keep always the expectations low. We should keep all others' expectation on us low. And value depends upon expectation. Value depends upon expectation. Wealth depends on expectation. So once again, I'm giving a clarity. If risk increases, expectation increases. If expectation increases, wealth decreases. Let me give a point. Example. If a Monika's mother, she is expecting Monica has to get all India first rank. Okay, Monica's mother, she is expecting all India first rank. అంటే అన్నారు కానీ ఆ ఊహ ఎంత బాగుంది కదా. So she is expecting all India first rank, but she secured 49th rank. She secured 49th rank. Now tell me, will their family celebrate the occasion or not? Generally, they don't celebrate the occasion. Why? Expectation is high. They don't know the value of 49th rank. They don't know the value of 49th rank. Yes or no? Okay. For example, Ishwar Nayak, father, expectation, my son has to attend the classes regularly. He has to write exams. He has to write exams, at least one group. Whether he will clear or not, that is fine. But he has to write exams. But he secured 49th rank. Then what is the, value? Father's perception. They will celebrate or not? They will celebrate. Yes or no? So they will celebrate and they will do a grand function at home. Yes or no? Why? Both have got 49th rank only. But expectation. If expectation increases, value decreases. That is the life principle. If your expectations are increasing, then obviously what value increases. So value decreases. Value decreases. So that's why if you see some people will be celebrating for small things also. So for small achievements also people would be celebrating. Why? Because their expectations are low. So that's why the value has got increased. But some people they will feel sorrow, unhappy, even though they have achieved a lot. Why that happens? Expectations are high. We should always keep expectations low. So that means here here cost is an expectation. Cost means what? Expectation. Here there are two expectations on a company. On company, two expectations. Debentures holders have expectation on a company. Debenture holders have an expectation on company. Equity holders have an expectation on a company. Now tell me, who has a more expectation? Equity holders have a more expectation. Monica's mother has a more expectation. Then what happens to the value? Decreases. Expectation should be high or low? Expectation should be low. Expectation should be low. Clearer? So that means from cost point of view, which is the best source of a finance? Which is the best source of finance? Equity or a debt? Debt is the best option because they will have a lesser expectation on a company. Clearer? Cost. So we are going to discuss about cost extensively in cost of a capital chapter. Cost of a capital chapter. For the time being, cost means expectation. Cost means what? Expectation. If expectation increases, value decreases. So that is the fundamental principle. That's why. So the current generation at 11:30 they will keep a status, feeling lonely. No one is there. Everybody is backstabbing. Okay. If you compare the current generation with previous generation they used to have a chicken or a mutton once in a month. They used to watch a film on Sunday at 4 p.m. once in a week. Okay, entire family. Now the current generation they are watching movies whenever they want. They're having chicken or a mutton whenever they want. And the previous generation they used to go for shopping once in a year. They used to buy one or two pairs of a dress in a year. Now this current generation purchasing every day. Yes or no? So, and the previous generation, they used to walk 3 or 4 kilometers to save 1 or 2 rupees. Now, the current generation, they are taking taxi, cab by spending 200 or 300. The current generation is having everything, but still, what they are unhappy. They have a Insta, YouTube, okay, so to get entertainment, but still, what at 11:30 they feel lonely. Then get married. So, module 1.1, Introduction to Financial Management. So, there are three parts in Fundamentals of Financial Management. First part, Introduction to Financial Management. Time value of money, risk and return. So, Introduction to Financial Management, any entrepreneur will go through 4 stages. Decide what to buy, determine what is total investment, determine working capital requirement, and decide what are all the sources available. Next, the financial management is concerned with two aspects: procurement of fund, effective utilization of fund. So, procurement of fund side, we are going to discuss three topics: cost of a capital, capital structure, leverages. Effective utilization of fund. We utilize the fund for two purposes: current assets, fixed assets. Current assets, fixed assets. For current assets, we have a working capital management. For fixed assets, we have capital budgeting. Concept 3, objectives of financial management: profit maximization, wealth maximization. Which is the superior objective? Wealth maximization is the superior objective. So, most important objective is wealth maximization. Wealth depends on two factors: profit and risk. Profit and risk. If a profit increases, wealth increases. What about risk? If risk increases, value decreases. Because if risk increases, expectation increases. If expectation increases, value decreases. Okay. So we are going to discuss examples. I mean, in cost of a capital chapter, time value of money. After completion of cost of a capital, you will get to know why wealth maximization is superior objective. Okay. Next, financial management focuses on three important decisions: investment decision, financing decision, dividend decision. Investment decision means where to put money. For example, Hyderabad Metro Rail project was constructed by L and T, Larsen and Toubro. Okay. Chennai Metro, Jaipur Metro, all metro rail projects were constructed by L and T. But suppose if it has to take a contract from government for Vizag Metro, so whether to accept the proposal or not. So that is investing decision, whether to put money in Vizag Metro Rail project or not is an investment decision for L&T. Likewise, Hyderabad International Airport was constructed by GMR. GMR. If GMR got a proposal of construction of an airport in Gannavaram, Amravati, Andhra Pradesh. Now, whether to take the proposal or not, whether to accept the proposal or not, is a investing decision. Next word, financing decision, from where to get money. Dividend decision, whether to declare dividend or not. While procuring funds, the firm has to consider four factors. What are the four factors? Risk, cost, control, flexibility. So tell me, which is the best source of a capital? Debt or equity? We cannot come to the conclusion. That depends on facts and circumstances. That depends on what? Facts and circumstances. Clearer? So, for example, producer Deva, he wanted to produce a film. He wanted to produce a film. Okay. So, Ishwar Nayak is a hero. 20 crores budget. Ramudu. Okay. 20 crores budget. 20 crores budget. So, Deva, he is the producer. Now, tell me whether high risk is involved in that film or not. High risk is involved in that film. Why? Because hero Ishwar Nayak, nobody knows about Ishwar Nayak, and he's a okay. So that's why what high risk is already involved. Already high risk is involved in that particular film. Now Deva, he wanted to take a loan from bank and he wanted to produce a film. Is it a correct decision or not? No, it is not a correct decision. Why? Already there is a high possibility of a occurrence of a loss because of casting. Who is the hero here? Ishwar Nayak. Already there is a high risk of loss. So he is adding some more risk by getting loan from bank. So is it correct or not? No. Yes or no? Clear? So first suppose Deva is producing a film. Deva is producing a film and hero Nani. Now risk is less or high? Comparatively less. So minimum guarantee, at least break even will happen. Okay. So that's why what that depends upon a business. That depend on business. Facts and circumstances. We cannot come to the conclusion that we should go for equity or we should go for debt. That depends on facts and circumstances. Facts and circumstances means we should ask for the situation. What is the situation? Okay, what type of a business they wanted to start. Based on that, we have to recommend the capital structure. Capital structure means what? Capital mix. Capital structure means capital mix. Okay. So these are the four factors. But what we can say is from risk point of view, which is the best option? From risk point of view, which is the best option? Equity is the best option. From cost point of view, debt is the best option because they have a low expectation. Next, the control point of view, debt is the best option. And next, the flexibility point of view, debt is the best option. So overall, we cannot come to the conclusion. Okay. So the definition, financial management is the management activity concerned with planning and controlling of the firm's financial resources. So this is the meaning of a financial management. So they will not ask you to write the definition, but what is the definition? It is a managerial activity concerned with planning and controlling the firm financial resources. Planning and controlling. Planning means procuring, controlling means utilization. Okay? Scope. Scope means boundary. Scope means what? Boundary. Scope of a financial management, investment decision, financing decision, dividend decision. So these three are the decisions. Boundary. So determination of selling price is not within the scope of a financial management because that comes under the scope of cost accounting. Cost control and cost reduction comes under the scope of cost accounting. Clearer? Investment decision. 2. Capital budgeting, working capital management. What is this capital budgeting? Fixed assets. Working capital management, current assets. So investment decision of a firm includes two main aspects. What are the two main aspects? Where to invest and how much to invest. How much to invest. Clear? Okay. So I will give time to note down the notes. Okay. So first understand. Next, this maximize the wealth of the firm. So while taking an investment decision, you should keep in the mind the objective must be to maximize the wealth. Capital budgeting decision helps in selecting the projects with higher profitability and feasibility. Capital budgeting decision. Capital budgeting decision means, so do you know PVR Inox? PVR Inox. Inox PVR. PVR has acquired Inox. So now PVR. So PVR, it is operating what? Multiplex theaters. Multiplex theaters. Now the point is, so PVR, if they wanted to start a new multiplex theater in Nujvidu, for them it is a capital budgeting decision. For them it is a capital budgeting decision. Whether to start a multiplex theater in Nujvidu or not is a capital budgeting decision. Okay. So they will have a n number of options. They can start multiplex theater in Nujvidu, Hanuman Junction, or Tanuku, or something. So the point is, so they have a three options: Hanuman Junction, Tanuku, and what? Nujvidu. So they have a three options. Now the point is, we should select a profitable opportunity. Profitable opportunity. Profitable opportunity. So multiplex theater. What factors we should consider before starting a multiplex theater in Nujvidu? First, investment. How much we are going to invest? Second, occupancy. Occupancy. Occupancy means whether people will come to theater or not. Occupancy. Okay. And next, nature of the audience. Will they purchase popcorn? Will they purchase popcorn, nachos, Red Bull, burger, chips, etc. or not? Because PVR will be earning money mostly from snacks rather than the ticket revenue. So more than a ticket revenue, they will be earning money on what? Popcorn, nachos, burger, etc. So now the point is, so before starting a multiplex theater in Nujvidu, first we should analyze the audience, whether audience will come to theater or not. Okay, they are coming to theater. Second point, will they buy popcorn? Will they buy nachos? Will they buy Red Bull or not? So that is very important. That is very important. So that has to be considered. For example, so Allu Arjun theater is in Amirpet. Mahesh Babu theater AMB cinemas is in Gachibowli. Okay. So what happens is in Amirpet, mostly students will come and will do a time pass in the theater. So always you will find that Allu Arjun cinemas crowded, fully crowded, full occupancy, full occupancy. But generally students will not be spending 2000 rupees on snacks. Yes or no? So prima facie you feel like Allu Arjun cinemas is getting a lot of money. No, it is not getting a lot of money because what? Mostly the theater is being occupied by whom? Students. Students will be coming to theater to do a time pass, but they will not be spending 2000 rupees on snacks. But AMB cinemas is different. Why AMB cinemas is different? Because mostly the theater is occupied by the working professionals. So working professional, what they will be spending money on? Snacks as well. So when compared to, I mean, AMB cinemas, Allu Arjun cinemas is a loss making. Why it is loss making? It is always crowded, but loss making. Why? They will not be purchasing water, snacks. Okay, students. Students will be wearing a hoodie, something, and they will keep snacks in the hoodie, yes or no? Punugu bhaji, etc. And they will eat in the theater. Okay, but whereas in AMB cinema is different completely. So capital bursting decision helps in selecting the project with higher profitability and feasibility. Wonderla, you know Wonderla, right? Amusement park in Hyderabad. So for suppose if the same amusement park is started in Vijayawada, will it be feasible? No, it will not be feasible. It will not be financially feasible. Okay. For working capital management decision, the firm should ensure that there is neither excessive nor inadequate working capital. We should not keep excessive investment in working capital or inadequate. What is inadequate and what is excessive? For suppose, so we have to maintain a cash or not. So as I have already told yesterday, cash is maintained for three purposes: transactional, speculative, safety need. Yes or no? So cash is a working capital. Cash is a working capital. Now my question is, you should not keep excessive investment in working capital, or you should not make a inadequate working capital investment. Let's just link it to cost accounting. For suppose in Kmart, okay, Kmart. So Kmart, Ishwar Nayak went for shopping to Kmart. Okay, and he is searching for Santur soap. Santur soap. He wanted to be young throughout his life. So that's why he is searching for Santur soap in Kmart. But he couldn't find the Santur soap. He, in entire Kmart, he couldn't find what? Santur soap. So this situation is called as stock out situation. In cost accounting, you might have came across this word, stock out. Stock out. Ishwar Nayak is saying, I mean, he's asking for Santur soap, but Kmart is saying no stock. No stock. This situation is called as stock out situation. So now tell me, what are the consequences of this situation? Ishwar Nayak will go to room, yes or no? So what is your name? Hari, yeah? Aravind. Ishwar Nayak will say to Aravind, so Kmart is and all waste. So we couldn't find Sandur soap also. Waste of time. Yes or no? Okay. What Aravind will do? Aravind will communicate this fact to all his girlfriends. Yes or no? So telling to his girlfriends means nothing but indirectly he is giving advertisement in all newspapers. Advertisement in all newspapers. Yes or no? Now tell me. So what happens? Reputation. The reputation will get damaged. Yes or no? Nobody will visit Kmart. Loss of a reputation. Second, loss of profit. So Kmart might have sold Santur soap to Ishwar Nayak and might have earned 2 rupees profit on soap. But they lost 2 rupees, and not only 2 rupees, they have lost reputation also, name also. So that's why a company, I mean, there should not be a stock out situation. There should not be a stock out situation. In order to avoid a stock out situation, Kmart has to make a investment in stock. That means it has to maintain Santur soaps. I mean stock. Yes or no? Yes or no? Okay. So Kmart they have got realized, and they have bought 10 lakh Santur soaps at once, and they are keeping a stock in a godown. What happens now? Excessive working capital. Excessive working capital. Excessive. 10 lakh soaps. 10 lakh soaps means they require a go down to store the soaps. Rental cost will increase. Yes or no? Capital will get tied up. Capital will get tied up. Tied up means locked, blocked. You lose interest, yes or no? You have to pay interest on that capital. So that means as a finance manager, you have to ensure, you have to take care, you have to ensure there should not be excessive working capital. There should not be excessive working capital. Excessive working capital means maintaining 10 lakh Santur soaps in a godown. You should not make a excessive working capital investment or inadequate working capital. Inadequate working capital means you're not maintaining a stock at all. That is inadequate working capital. So nothing but as a finance manager, you have to make a working capital investment. So as required. అంటే ఎంత కావాలో అంత ఏం చేయాలి, ఇన్వెస్ట్మెంట్ చేయాలి. ఎక్కువ చేయకూడదు, తక్కువ చేయకూడదు. క్లియరా? So financing decision, we are going to discuss this topic, financing decision in cost of a capital, capital structure, leverages. So the objective of a financing decision of a firm should be to find out the optimum. Optimum means best. Optimum means what? Best combination of debt equity where cost of a capital will be minimum. That is not maximum. Cost of a capital will be minimum. Cost should be minimum. Cost means expectation. Expectation should be minimum. And the return will be maximum. Return will be maximum. So the object of financing decision is to find out the optimum combination of debt equity. Optimum combination means best combination. That best combination can be 100% equity, 80% equity and 20% debt, 60% equity, 40% debt, 50% equity, 50% debt. So in that particular topic, we are going to learn how to find out the optimum combination of a debt equity. And what is the optimum combination? Where a cost of a capital is minimum. Where a cost of a capital is minimum and return will be maximum. And for for procuring fund, there are mainly two sources: internal source, external source. Internal source means retained earnings. Retained earnings. So if we are retaining the profits, that is what? Internal source. External source means taking loan from bank, issuing equity shares to Bangardalu. All these are what? External sources. Internal source means retaining the profits. Company is earning a profits. Instead of distributing dividend, we are keeping our profits with ourselves and reinvesting. This is what? Internal source. Clear? Dividend decision. Dividend decision means what? Determining how much to distribute as a dividend and how much to retain for future expansion program. So this already we discussed, okay? So the object of a dividend decision is to maximize the market value of equity shares. Of course. Okay. So FM objective itself is what? Maximizing the wealth. Maximizing wealth. Yes or no? So the objective of a dividend policy is to maximize the market value of equity shares. So clear? So till now what we have discussed is first introduction. Okay, introduction stages 4. Next what? 2 aspects: procurement and effective utilization. Next objectives of FM. Next, three types of a decision: investing, financing, dividend. Next concept, while procuring funds, the firm has to consider four factors: risk, cost, control, flexibility. If you want flexibility, then what is the better option? Debt. If you want control, debt. If you want less cost, debt. Okay. If you want high risk, equity. If you want high risk, debt. If you want low risk, equity. Low risk, equity. Clear? Next, financial management definition is the management activity concerned with planning and controlling of the firm's financial resources. Scope means boundary. Three types of decision: investment decision, financing decision, dividend decision. Okay. So note down. Next class we are going to start time value of money. We complete introduction to FM, and next what? Time value of money. Tomorrow our target is to complete time value of money and risk and return. By this weekend we have to complete cost of a capital also. Cost of a capital. Okay. Note down. So module 1, fundamentals of financial management. It contains three parts: introduction to financial management, time value for money, risk and return. So introduction to FM. So first we have seen the stages of a decision making. Decide which assets to buy, determining what is total investment, and next determining working capital requirement, and decide what all sources does the entrepreneur need to tap. You should not by heart this, you have to understand. So financial management, two aspects are procurement of fund, effective utilization of fund. Effective utilization of fund. So procurement side we have a three topics to be discussed: cost of a capital, capital structure, leverages. And effective utilization of fund. We utilize the fund for two purposes: fixed assets, current assets. For fixed assets we have a capital budgeting chapter. And next, for current assets we have a working capital management chapter. Objectives of financial management: profit maximization, wealth maximization. Which is the superior objective? So wealth maximization is the superior objective. Wealth depends on two factors: profit and risk. If a profit increases, wealth increases. If a profit increases, wealth increases. If risk increases, wealth decreases. If risk increases, wealth decreases. Okay. Next, financial management focuses on three important decisions of a firm: financing decision, investing decision, dividend decision. Simple. Financing decision means from where to procure money. From where to procure money. From where to get money. From where to get money. Investment decision: where to put money. Where to put money. The next one, dividend decision: whether to declare dividend or not. Whether to declare a dividend or not. So we have our two options: either distribute the profits among the shareholders. Second one, retention. Retain the profits, keep the profits with the company itself and reinvest. So that dividend decisions, we have a chapter. We are going to discuss dividend decision chapter as well. Okay. Next, while procuring funds, firm has to consider four factors: risk, cost, control, and flexibility. From cost, control, and the flexibility point of view, debt is the best option. Debt is the best option. From risk point of view, equity is the best option. Overall, which source is the best option? What should be the mix of a capital? What should be the mix of a capital? Mix of a capital means debt equity. Capital can be debt or equity. So what should be the mix of a debt and equity? That we are going to learn in capital structure chapter. Capital structure. Capital structure means capital mix. Capital mix. Okay. Next, financial management is the management activity concerned with planning and controlling firms' financial resources. Scope. Scope means boundary. Investment decision, financing decision, dividend decision. So investment decision, capital budgeting, working capital management. So investment decision of a firm includes two main aspects. What are the two main aspects? Where to invest or how much to invest. Next, the object of this is to maximize the wealth of a firm. Capital budgeting decision helps in selecting a project with higher profitability and feasibility. So, working capital management decisions, the firm should ensure there should not be excessive or inadequate working capital. There should not be excessive working capital. Excessive working capital means keeping a stock of 10 lakh Santur soaps. Okay, sir, no. Okay, that is excessive working capital. Keeping no stock. Inadequate working capital. Inadequate working capital. So where is Ishwar Nayak? No, okay. Financing decision. Cost of a capital. Capital structure. Leverages. So the object of a financing decision is what? To find out optimum debt equity ratio. Optimum debt equity ratio. Nothing but optimum capital structure. Optimum means best. What is the meaning of optimum? Optimum means best. So where a cost of a capital is minimum, not that is not maximum. Where a cost of a capital is minimum. Cost of a capital should be minimum. I have already told you. Cost means expectation. Cost means expectation. So expectation should be low. Yes or no? Expectation should be low. If expectation is low, value increases. That means to the shareholders, expectation should be low on a company. Then automatically value of a company will increase. Value of a company will be increasing. Yes or no? For example, Ishwar Nayak, okay, girlfriend, she is expecting a world tour on first marriage, okay, anniversary. I mean, his wife expecting a world tour on first marriage anniversary. Okay, world tour. Okay. But on first marriage anniversary, okay, he didn't even came to home. Now tell me whether value will be increasing or decreasing. Value will decrease. Why? Expectations are too high. But suppose if he is taking his wife on all India tour, still the value will be less. Why? Why? Reason? Because expectations world tour and he is taking to all India tour. So that's why the value will decrease. Value will decrease. So, but Deva wife, she is expecting Deva to spend 1 hour time, just 1 hour time on first marriage anniversary. Okay. But Deva, he took a leave from office and he took her to a movie. Okay. And then thereafter what? Candlelight dinner, etc. So what happens to the value? What happens to the value? Value increases. So here completely the value depends on perception. The value will not be same. So everybody's expectations are not same. Everybody expectations are not same. First case, wife expectation, world tour. Second case, wife expectation, 1 hour. For example, Mahesh wife expectation. At least today, he should not come drink I mean, he should not come drunk and okay, he should not beat her. So that is the expectation. That is the expectation. Because every wife expectation is not the same. Everybody's situation is not the same. Yes or no? So here the fundamental point is, if a expectation increases, value decreases. So while coming to class, so my expectation, so at least a student should not go out of the class. Okay. So I'm happy. Still, Kavya, she's sleeping. Still, I'm happy. Why I'm happy? ఆవలించవు కదమ్మా. I'm happy. Why I'm happy? Reason? My expectations are low. My expectations are low. So that's why even though she is sleeping, I'm happy. Are you getting my point? So if expectations are low, then automatically value increases. Value increases. So that's why people, some students, even after clearing one group, they will be celebrating. Okay, as if they have cleared CMA final. But some students, even after clearing both groups, they will not be celebrating. Why? As if someone has died in family. So they will be feeling sad. Even after clearing both groups. Why? Expectations. Expectation. The second person might have expected rank, but they have just cleared both. So always the value depends on what? Expectation. If expectation increases, value decreases. That's why the objective of a financing decision of a firm should be to find out the optimum combination of a debt equity where a cost of a capital is minimum. Expectation on a firm should be minimum and return will be maximum. So there are mainly two sources. There are mainly two sources. Okay. There are mainly two sources, internal and external source. Internal and external source. Okay. So internal source means retained earnings. Retained earnings. What about external source? External source means issuing equity share capital. Okay. And next what? Issuing equity share capital and issuing debt. Issuing debt. Clear? Issuing debt means taking debt. Next, dividend decision. Dividend policy, retained earnings. You return this also, no? Next, dividend decision of a firm includes determining how much to distribute as a dividend and how much to retain for future expansion program. Future expansion program. The objective of a dividend policy is to maximize the market value of equity shares. Clear? So we have completed till here, sir. So next topic, functions of financial management and role of a CFO. Role of a CFO, Chief Financial Officer. Chief Financial Officer. Okay. So clear? Done. Now let us start with time value of money. Time value of money. So we have three topics in fundamentals of financial management. What is the first topic? What is the first topic? Introduction to financial management. Time value of money. Risk and return. Risk and return. Okay, done. So time value of money. Okay. So whenever we give a loan to the other person, we charge some interest, yes or no? We charge interest. Why do we charge interest? For example, Ishwar Nayak is giving loan to Bhavana, whether he will expect interest or not. As why Ishwar Nayak will charge interest? What is the reason? Reason? Opportunity cost. Opportunity cost, no doubt. What is the opportunity cost? Meaning benefit foregone in choosing an alternative course of action. Benefit foregone in choosing an alternative course of action is called as a opportunity cost. So Ishwar Nayak, instead of giving loan to Bhavana, what he can do? He can make a fixed deposit in bank and he can earn some interest, or else he can give some amount of loan to Manikanta, okay, at some rate of interest. Instead of giving loan to Manikanta, he is giving loan to Bhavana. So opportunity cost, nothing but what? Benefit foregone. Or else Ishwar Nayak can do a business on his own. Ishwar Nayak can do a business on his own. Instead of doing business on his own, what he is doing is he is giving that amount to Bhavana. So that means he is foregoing the benefit. He is foregoing, he is leaving the benefit in choosing the alternative. Instead of doing the business, he is choosing an alternative, that is giving loan to Bhavana. So this is called as opportunity cost. Opportunity cost means benefit foregone in choosing an alternative course of action. Okay. So what is the other reason? What is the second reason? Charge this. What is the other reason? Inflation. What is the other reason? Inflation. For example, Ishwar Nayak, he wanted to buy a car. He wanted to buy car. He wanted to buy car. Ishwar Nayak. Ishwar Nayak, he wanted to buy car. Right now the car price is 20 lakhs. Car price is 20 lakhs. But instead of buying a car, he gave a loan to Bhavana and Bhavana agreed to repay the loan after 5 years. After 5 years. Now tell me, after 5 years, will the car price remain same? Right now the car price is 20 lakhs. After 5 years, will the car price remain same? Car price will not remain same. Car price will increase or decrease? Car price will increase. So that rise in price is called as what? Inflation. Inflation. So to compensate that inflation, Ishwar Nayak will be charging interest. Ishwar Nayak will be charging interest. Yes or no? And what is the other main reason? Risk. What is the other reason? Risk. Risk means a possibility of occurrence of loss. Possibility of occurrence of loss. That means what? The opposite party, the opposite party may or may not repay the loan. So Bhavana agreed to repay the loan after 5 years. Okay, she is from Andhra or Tamil Nadu? Tamil Nadu. After completion of CMA Inter, she will leave to Tamil Nadu. Okay, Ishwar Nayak belongs to Telangana. Now the point is, if a Bhavana makes a default, that means if she is not paying the debt, whether there is a chances of making a default or not, yes or no? There is a chance of making a default. So that is called as a risk. Risk means risk of a default. She may or may not repay the debt. Okay, risk. So yesterday I have already told, if risk increases, expectation increases. If risk increases, expectation increases. That's why if you're giving a security and taking a loan, if you're giving a security, security means takat petti. If you're giving a security and taking a loan, lender will be charging a less rate of interest. Lender will be charging less rate of interest. Yes or no? For suppose if you are not giving any security and if you are asking for a loan, then rate of interest will be low or high? High. Why? Because from the other party, I mean from the lender's point of view, in second case, the risk is high. Yes or no? First case, if a borrower is not repaying the loan, at least he can sell that building. He can sell that security. He can sell that security. Yes or no? So the point is here, so if a lender, I mean if risk increases, what happens to the expectation? Expectation increases. If risk increases, expectation increases. That's why if a financier, you might have seen outside also, if a financier is giving loan to a roadside vendors means pani puri or something. Okay, small businesses will be there, yes or no, on roadside. So if you're giving loan to a roadside vendor, then interest rate charged will be very high, extremely high. Extremely high. You might have seen outside also. Why? Because no security and they might have came from some other places like Rajasthan or something. Yes or no? So they do not have any permanent residence in this place. So that's why generally if you are giving a loan to a person who is doing a roadside business and who came from outside state, generally the rate of interest will be high. Why? Because risk is high. So if risk increases, expectation increases. Nothing but interest to be charged will also increase. So the time value of a money, time value of a money. What is this actually? Interest is charged for three reasons. You already told. First reason, opportunity cost. Second reason, inflation. Third reason, risk. And fourth reason, postponement of a consumption. Postponement of a consumption. So Ishwar Naik, instead of buying car, he is giving loan to Bhavana. That means he is postponing his consumption. He can use the car from now itself. But instead of using the car from now itself, what he is doing? He is postponing it. So everybody prefers present consumption or future consumption. Okay, if you have a chance to travel in a Audi car, you want it now or after 50 years? Now itself. Everybody prefers what? Present consumption or future consumption? Present. If you have a chance to go on a world tour now or after 10 years, you prefer now or after 10 years? Now only. Because future is uncertain. Future is uncertain. Here Ishwar Naik is postponing his consumption. Postponing his consumption, his usage of a car. Yes or no? And what he is doing? He is giving that money to Bhavana. So that's why he will be charging interest. Clear? So first reason opportunity cost, second reason inflation, third reason risk, fourth reason postponement of a consumption. So time value of a money. Time value of a money. Most financial decisions, personal as well as business, involve time value of a money consideration. This topic is very important, not just for businesses, for personal purposes also. This topic is very important. Why this topic is very important? Because you might be taking a loan for purchase of a car. You might be taking a loan for purchase of a house. కొంచెం నవ్వండి వీడియోలో పడతారు. సో సో Most of the financial decisions, personal as well as business, involve time value of a money consideration. You have to consider time value of a money for both business as well as what? Finance. Okay. Money involves cash flow occurring at different points of a time. What is this? For example, Kmart. We discussed about a Kmart. For suppose if she is starting a Kmart, so investment has to be done now or in the future? Now. Investment has to be done now. What about the benefit? Benefit. Benefit will come immediately or in the future? Benefit will come in the future. Benefit will come in the future. Arvind, yes or no? Benefit will come in the future. Okay. So whatever the business you start, beginning you make investment and you receive the benefit in the future. And benefit will be for 1 year or more than 1 year. More than 1 year. Kmart will get a benefit for first year, second year, third year. Likewise, she might get a benefit for 10 years or 20 years. 10 years or 20 years. Here, the cash flows are arising at a different points of a time. Cash inflows are arising at different points of a time. That means what? We are not getting cash at once. We are getting cash at the end of first year, second year, third year, fourth year at different points of a time. Now tell me whether 1 rupee received at the end of first year and 1 rupee received at the end of a second year, both are same or not? Same or not? So, okay, let me give an example. If I have to give 10 lakhs, if I have to give 10 lakhs to you, you need now or after 10 years? For example, I have to give 10 lakh rupees to you. Okay. You want 10 lakhs now or after 10 years? Now or after 10 years? You require 10 lakhs. Now or after 10 years? Nobody will expect after 10 years. Why? After 10 years, completely uncertain. I may or may not give. Yes or no? I may or may not be there. You may or may not be there. So that's why what future is uncertain. If there is a chance, if I have to give 10 lakhs as on today or after 10 years, you want now or after 10 years? You want now. For suppose if you have to give 10 lakhs, will you give now or after 10 years? Why? That means if you have to give 10 lakhs, you will be giving after 10 years. Why? If I have to give, you are asking now. But if you have to give, you are asking. I mean, if you are paying after 10 years. Why? What is the reason? Because there is a time value of a money. The rupee as on today and the rupee after 10 years, both are not same. Both are not same. The rupee as on today and the rupee after 10 years, both are not same. Yes or no? Both are not same. Present 1 rupee will have a more value. Present 1 rupee will have a more value. For example, present, if you have 1 rupee, at least you will get one chocolate. Yes or no? 1 rupee chocolate is there or not? 1 rupee chocolate. But after 10 years, will you get the same chocolate for 1 rupee? Will you get the same chocolate for 1 rupee? Okay. So, present 1 rupee will have a more value than future 1 rupee. Future 1 rupee. Yes or no? For suppose if you have 100 lakhs now, 100 lakhs now, you can purchase 1 acre of a land. But after 50 years, if you have a same 100 lakhs, will you be able to purchase the same acre of a land? No. You will not get the same land for 100 lakhs. Why? The land value will increase. Nothing but Present 1 rupee will have a more value or a future 1 rupee? Present 1 rupee will have a more value than a future 1 rupee. Future 1 rupee. So this concept is called as time value of a money. Value of a money depends upon a time. Depends upon a time. Always present 1 rupee will have a more value. Why? Simple. Present 1 rupee is certain. Present 1 rupee is certain. So to remember this point, bird in the hand is always better than bird in the air. Bird in the hand is always better than bird in the air. Bird చేతిలోనే ఉందనుకోండి, ఏం చేయొచ్చు? వండుకొని తినొచ్చు కదా. సర్టెన్. బర్డ్ ఇన్ ద హ్యాండ్ సర్టెన్. బర్డ్ ఇన్ ద ఎయిర్, ఫ్యూచర్ 1 రూపీ ఈజ్ లైక్ బర్డ్ ఇన్ ద ఎయిర్. గాల్లో ఉందనుకోండి బర్డ్, అప్పుడేంటమ్మా? ఫస్ట్ అసలు దొరుకుతుందో దొరకదో తెలియదు కదా. వీ మే ఆర్ మే నాట్ బి ఏబుల్ టు క్యాచ్ దట్ బర్డ్. సో సర్టెనా అన్సర్టెనా? అన్సర్టెన్. క్లియరా? సో present 1 rupee is like bird in the hand. Future 1 rupee is like bird in the air. Future is always uncertain. Yes or no? So that's why always present 1 rupee will have a more value than a future 1 rupee. Clear? Okay. See the notes. Most financial decisions, personal as well as business, involve time value of a money consideration. Why? For example, if you are taking any loan, you have to pay installments. Yes or no? You take loan now and installments are paid immediately or in the future. For example, if you are taking a loan from the bank, okay, you take loan now. What about installments? You pay now or in the future? In the future. So that means payments are being done at different points of a time. So that's why we have to consider time value of a money. For evaluating such cash flows, time value of a money is required. There are 3 reasons. There are 3 reasons attributable to individual's time preference of a money. First reason, the first most important reason, risk. No doubt risk. Risk means what? Possibility of occurrence of loss. Okay, if you're giving money to someone, you might lose money. Okay, so that other person may or may not repay. Next, preference for. So everybody prefer present consumption or future consumption? Present consumption. If you're giving loan to the other person, that means you are postponing your consumption. So that's why we charge interest. Next, investment opportunities. Investment opportunities. If you have money now, you will have a investment opportunities. If you're giving that money to some other person, that means you are losing investment opportunities. So that's why whenever we give a loan, we charge some interest. Whenever you are making any investment, you expect some return. You expect some return. Okay. Clear? Now, so let us start with problematic. We start with simple interest. Note down the examples. We start with simple interest. Simple interest. Principal P is equal to 1 lakh. Principal P is equal to what? 1 lakh. Simple interest, principal P is equal to what? 1 lakh. Time T is equal to 5 years. Interest rate R is equal to 10%. Interest rate R is equal to what? 10 percentage. Interest rate R is equal to what? 10 percentage. Clear? Interest rate R is equal to 10 percentage. Done? Principal P 1 lakh. Time T 5 years. Rate of interest 10%. Rate of interest 10 percentage. Okay. So now the simple interest is equal to, what is the formula for simple interest? PTR. Principal 1 lakh and T 5 and rate of interest 10 percentage. Rate of interest 10 percentage. So how can we write this 10%? 0.1. 10 percentage means 10 divided by 100. Nothing but 0.1. So what is the answer? 50,000 is the answer. And what is the amount in this case? 1 lakh principal plus 50,000 interest. That is equal to 1,50,000 rupees. That is equal to 1,50,000 rupees. Yes or no? You already know this concept, right? But here the concept is understand deeper concept. Here the principal is 1 lakh, right? Principal means the amount which is given as on today. Which is given as on today. 1,50,000 is the amount what we get after 5 years. So nothing but 1 lakh is the present value. 1,50,000 is the future value. So what is the meaning of these numbers? The present 1 lakh is equal to the future 1,50,000. So that means if you are getting 1,50,000 after 5 years and present you have 1 lakh, both are same. Present 1 lakh will have a more value. Are you getting my point? Present 1 lakh is equal to 1,50,000 after 5 years. After 5 years. So this is simple interest. Simple interest. Next, take second example, compound interest. Compound interest means interest on interest. Interest on interest. Compound interest. Compound interest means interest on interest. So let us take an example. Principal 1 lakh. Rate of interest 12%. Rate of interest 12%. T is equal to 2 years compounded annually. Compounded annually. So what is the compound interest and what is the amount? Simple example. Are you able to understand this? Principal 1 lakh, rate of interest 12%, time t is equal to 2 years, compounded annually. That means every year interest will be added to the principal. And we have to find out compound interest and amount. Compound interest and amount. So next solution. Solution. What is the principal amount? Principal 1 lakh. What is the rate of interest? 12%. Compounded annually. Compounded annually means every year interest will be added to the principal. That means add first year interest. Add first year interest. What is the first year interest? 1 lakh into 12%. 12,000. 1 lakh 12,000 is the principal for second year. Okay. 1 lakh 12,000 is the principal for second year. Next, add second year interest. Add second year interest. What is the second year interest? 1 lakh 12,000 into 12%. 13,440. So overall, what is this? This is amount. This is amount. 1 lakh 25,440. 1 lakh 25,440. 1 lakh 25,440. Amount is equal to 1 lakh 25,440. Am I clear? Done? For suppose if it is 5 years, then we have to do another 3 times. Okay. So that involves a lot of labor work, yes or no? So that's why what we apply a formula. What is the formula? Amount is equal to amount A is equal to P into 1 plus I power n. Yes or no? Amount A is equal to P into 1 plus I power n. Okay. So what is the principal here? 1 lakh into 1 plus 0.12 square. Amount is equal to principal into 1 plus I power n. You will get 125 440 rupees. 125 440 rupees. Yes or no? One 125 440 rupees. Am I clear? Done. 125, 440 rupees. Am I clear? Okay, done. Next. What is the compound interest here? What is the compound interest, Vaishnavi? Compound interest is equal to amount minus principal. So 125, 440 minus 1 lakh. 25,440 rupees. 25,440 rupees. Yes or no? Clear? Done. So, but every time we cannot do like this. So, we follow the shortcut. Okay. And that shortcut also you have to understand conceptually. Shortcut for amount calculation. First step, take I. Next, add 1. Next, multiply with 1. Take I, add 1, multiply with 1, multiply with 1. Take I, add 1, multiply with 1. Press equal to n times fifth. Multiply with principal. Multiply with principal. Then you will get amount. So these shortcuts you need not by heart, okay? You will get habituated. First take I, then add 1, multiply with 1, press equal to n times, multiply with principal. So everybody have a calculator? Everybody having calculators or not? Fine. So first in calculator take I. What is I here? 0.12. 0.12. Next word add 1, multiply with 1, press equal to how many times? 2 times. Be careful, you might press equal to 3 times. Be careful. 0.12 plus 1 into 1. Press equal to 2 times, only 2 times. First time equal, when you press 1 first time equal to, you will get 1.12. Second time you will get 1.2544. Yes or no? Okay. And then multiply with what? Principal. What is the principal? 1 lakh. So what is the amount final? 1,25,440. 1,25,440. Clear? Done? Okay. Now again, so start again 0.12. Calculator, take 0.12. First understand what is this 0.12. Interest for 1 rupee. For 1 rupee, what is interest? 0.12 per annum. Per annum. Interest 0.12 for 1 rupee. So 0.12 plus 1. Nothing but you are adding principal into 1. Press equal to. You will get 1.12. What is that meaning? What is the meaning of that 1.12? If you are lending 1 rupee, if you are lending 1 rupee at the rate of 12%, in a year, within a year, that will be equal to 1.12. Press again equal to. If you are lending 1 rupee at the rate of 12%, that 1 rupee will be equal to 1.2544 in 2 years. Now multiply with 1 lakh. Why? Because I am not lending 1 rupee. I am lending 1 lakh. So that's why multiply with 1 lakh. So the answer is 125,440. Clear? So what we are doing actually, we are doing compounding, multiply. Okay. So we can do, we can discuss later on about compounding. Are you able to understand the shortcut? For suppose if it is 5 years instead of t, here t instead of 2, if it is 5, then what is your answer? For suppose if a time is not equal to 2 years, time is equal to 5 years, then what is the shortcut? Tell me from the beginning. 0.12 plus 1 into 1 press equal to 5 times into 1 lakh. So let me write the answer. For suppose same example, we are making a little change. What t is equal to 5 years compounded annually. So tell me the answer. Tell me the answer. Amount is equal to 1 lakh 76,000. So you have to understand the concept as well, not just the answer. So 176,234 is the answer, right? Am I clear? Compounded annually. Compounded what? Annually. Okay. For suppose the same question, if it is compounded half yearly. Compounded half yearly means for every half year, interest will be added to the principal. For every half year, interest will be added to the principal. Then what? So again the same step. First step, take I. But this time we should take interest rate per half year. Because compounded half yearly. If they ask you to find out amount, and if they are saying compounded half yearly or semi-annually, half yearly or semi-annually, first in calculator we should take half year interest rate. Tell me what is the half year interest rate? 0.06. So first calculator take 0.06. Why 0.06? Compounded half yearly. We should take only half year interest rate. Because for every half year interest will be added to the principal. So that's why in calculator take 0.06 plus 1 into 1. Press equal to 1 time, just 1 time. What is the meaning of this 1.06? 1 rupee will become 1.06 in next 6 months. Press again equal to 1.1236. What is the meaning of this 1.1236? If you are lending 1 rupee, that will become 1.1236 in 1 year. Next 6 months. That means next 1 year. So here you have to press equal how many times? Already 2 times, remaining 8 times. Because 5 years means how many half years? 5 years means 10 half years. 5 years means 10 half years. So that's why press equal to n times. N is not number of years. N means number of a periods. Number of a periods. That period can be year, half year, quarter, month or a day. Clear? So in calculator take 0.06 plus 1 into 1 press equal to 10 times. So tell me the amount. 1,79,008,085. So the amount will increase. Amount will increase. So when compared to compounded annually, you're getting a higher amount for compounded half yearly. Compounded half yearly. So that is simple common sense. Because for every half year, interest is being added to the principal. Okay. Clear? So now tell me, if it is compounded quarterly, then what? First, suppose if it is compounded quarterly, then what? Compounded quarterly means you should take interest rate per quarter. How many quarters will be there in a year? 4 quarters. 4 quarters. Okay, 4 quarters. So first in calculator you should take 0.12 divided by 4. So tell me the answer. In calculator you should take 0.03. 0.03 plus 1 into 1 press equal to 20 times. Because for 5 years, how many quarters are there? 5 into 4, 20 quarters. 1 lakh, 6, compounded quarterly. Compounded quarterly. So the number will increase, right? Yes or no? Because for every quarter, interest is being added to the principal. Clear? But suppose if it is compounded monthly, then tell me the answer. Compounded monthly. Compounded monthly. Compounded monthly. What is the answer? 1,81,670. So this time, how many times you have to press equal to? 60 times. Clear? Are you able to understand the concept? For suppose if it is compounded daily, then what? Compounded daily means what? First you have to take interest rate per day. That means 0.12 divided by 365 plus 1 into 1 plus equal to how many times? 5 into 365. 1 1825. Yeah. Okay. For suppose if it is compounded every minute, then what? Every minute. Compounded every second. Compounded every nanosecond. So that concept is called as continuous compounding. Continuous compounding. So that we are going to discuss in CMA final SFM. Continuous compounding. Right now, compounded monthly. So that is enough. Okay. Compounded monthly. Am I clear? So clear? So see the question number 1. A bank offers a 12% compound interest payable quarterly. If you deposit rupees 2000 now, how much it will grow at the end of 5 years? Future value factor is given. Future value factor. Whatever the factor we are getting before multiplying with principal is called as a future value factor. For us, future value factor is not required. We can do directly. So what is the rate of interest? 12%. What is the amount deposited? 2000. Interest is payable quarterly. Compounding is done quarterly. So that means in calculator you should take 0.03 0.03 plus 1 into 1 press equal to how many times? Press equal to how many times? 20 times. Clear? 0.03 plus 1 into 1 press equal to how many times? 20 times. So what is the number you got? 1.8061. That is given in the question itself. Okay. So that is called as the future value factor. Future value factor. The meaning of this is, if you are depositing 1 rupee as on today, by the end of 20th quarter, by the end of a 20th quarter, that 1 rupee will be equal to 1.8061. 1.8061. Clear? So, but here the amount being deposited is not 1 rupee. Amount being deposited is 2000. So that's why multiply with 2000. 3612 is the answer. 3612 is the answer. Am I clear? Done. Next, question number 2. How long it will take for 20,000 to double at a compound rate of 8% per annum approximately? How long it will take for 20,000 to double at a compound rate of 8% per annum? So this is very important concept. I mean, for personal purposes also. The question is how long it will take 20,000 to double at a compound rate of 8% per annum. Okay. What is the rate of interest here? 8%. Simple. Simple. In calculator take 0.08. Double means what? 1 rupee has to become 2 rupees, right? 1 rupee has to become 2 rupees. In calculator take 0.08 plus 1 into 1 press equal to 1 time. You're getting 1.08, right? That means in 1 year 1 rupee will become 1.08. But I require a time within which that 1 rupee will become 2. Press equal to until you get 2 in the calculator. Press equal to until you get 2 in the calculator, and count equal to. You have to count equal to, yes or no? 9. Yes or no? By the time you press equal to 9 times, you're getting 1.99. So the answer is what? 9 years. Clear? So it is very simple. Okay. You have to count equal to. Are you able to understand this part? In calculator, you have to take 0.08 plus 1 into 1 press equal to until you get 2. But you have to count equal to. So how many times you are pressing equal to, that has to be counted. Clear? Okay. But what is the market interest rates? Generally, market interest rates. Do you know the market interest rates? Market interest rates means outside, if you want to take a loan, what are the rates of interest? What, 4 or 5%? I'm asking, for suppose if you want to take 2 lakh rupees loan outside, your father might have taken. So what is the rate of interest? 2 rupees interest. What is the 2 rupees interest? 2 rupees interest means 2 rupees per 100 per month. 2 rupees per 100 per month. Nothing but 2 percentage per month. 2% per month. 2% per month. Are you able to understand? Okay. So now tell me 2 percentage per month. 2% per month. Nothing but per annum. 24%. You might have heard about 3 rupees interest. 3 rupees means 3 rupees per 100 per month. 3 rupees per 100. Per 100 means 3% per month. That means per annum 36%. 36%. Okay. So for suppose loan has been taken at the rate of 3% per month. Loan has been taken at the rate of 3% per month. So how much time it will take to get doubled? Let us find out. Are you getting my point? So outside you might have heard about 3 rupees interest, 3 rupees interest, 2 rupees interest, 10 rupees interest. You heard about interest rates or not, Manikanta? Interest rates, 3 rupees, 2 rupees, 5 rupees. Okay. So let us find out 3 rupees interest. 3 rupees interest means 3% per month. 3% per month. So in calculator, first you take 0.03 plus 1, 0.03 plus 1 into 1 press equal to until you get 2. We are going to find out the time within which this amount will get doubled. Press equal to until you get 2. 24. That means what is the meaning? If you are taking 1 rupee loan at the rate of 3% per month interest, then that 1 rupee will get doubled in how many months? 24 months. That means in 2 years, the amount will get doubled. So for example, Ishwar Nayak grandfather has taken a loan. Okay, 1 lakh rupees loan. Ishwar Nayak grandfather has taken a loan 1 lakh. 20 years back. 20 years back at the rate of 3% per month. Then what are the consequences? Let us assume Ishwar Naik, grandfather, has taken a loan. What is the amount of loan? 1 lakh. How many years back? 20 years back. What is the rate of interest? 3% per month. Okay. So what are the consequences? In first 2 years, that 1 lakh will become 2 lakhs. Yes or no? First 2 years. In next 2 years, that 2 lakhs will become 4 lakhs. Okay. In 6 years, that 4 lakhs will become 8 lakhs, because for every 2 years it will get doubled. Yes or no? So first 2 years 1 lakh will become 2 lakhs. Next 2 years 2 lakhs will become 4 lakhs. And by the end of 6 years it will become 8 lakhs. By the end of 8 years 16 lakhs. 10 years 32. 12 years 64. 14 years 128. 16 years 256. Okay. 18. 5. 12. So 20. 1024. That means that is equivalent to 10 crore 24 lakh as on today. Ishwar Naik, grandfather, has taken a loan of rupees 1 lakh 20 years back. That means that is equal to 10 crore 24 lakhs as on today. So what is the interest rate? 3% per month. Clear? Adhavenda? 3% per month means what? So the principal will get doubled in how many years? 2 years. 2 years. Clear? Clear? So likewise, Mahesh, grandfather, has taken 1000 rupees 40 years back. 1000 rupees 40 years back. You find out what is the loan amount to be repaid as on today. Forty years back means 20 times it will get doubled. 1000 will become 2000, 2000 will become 4000, 4000 will become 8000. How much? What? 1048576 crores or lakhs? 21 21 crores 95 lakhs. Mahesh, inquire with your grandfather. If he has taken 1000 rupees 40 years back, that is equivalent to as on today 20 crores. If rate of interest is 3% per month. Emma, కోపం వస్తుందా మీ తాత మీద? Okay. So there is another rule, question number 2. I mean, to find out the time within which the amount will get, principal will get doubled. Rule 72. Rule 72. Rule 72 means simple, 72 divided by rate of interest. 72 divided by rate of interest. Here 72 divided by rate of interest, 8. 9. Earlier also you got 9, right? 72 divided by 8. 9 years. So rule 72. Clear? So there is another rule, rule 69. They might ask you MCQ, multiple choice question. In June 25, they have asked you MCQ on rule 69. But we need not follow the rule 69 also. We can do it conceptually. Okay. So 69 divided by rate of interest. 69 divided by 8. 8 point plus 0.35. 8.975. So this is the answer. So 69 rule, 69 divided by rate of interest plus 0.35. But instead of applying this rule 72 or rule 69, directly we can do it. 0.08 plus 1 into 1 press equal to until you get 2. Clear? Done? Manikanta? Clear? Clear? Are you able to understand the shortcut? Next question number 3. Mr. P deposited rupees 1 lakh on January 2015 in a fixed deposit scheme with a nationalized bank for 5 years. The maturity value of the fixed deposit is 2 lakhs. Compute the rate of interest compounded annually. Principal 1 lakh, amount is given. What is amount? 2 lakhs. Time is also given, 5 years. Compounded annually. We have to find out what? Rate of interest. Rate of interest. Okay. How can we find out the rate of interest? So this we are going to learn in capital budgeting conceptually. But right now we can go for trial and error. Trial and error. Let us assume the rate of interest is equal to 10%. Rate of interest is equal to 10%. Then in calculator take 0.1 plus 1 into 1 press equal to 5 times. Press equal to 5 times and multiply with 1 lakh. 1,61,000 something. That means what? 10% is not the correct answer because you should get 2 lakhs. On maturity, you are getting 2 lakhs, right? So that means rate of interest has to be increased or decreased? Increased. Let us try with 15. Let us try with 15. That means 0.15 plus 1. 0.15 plus 1 into 1 press equal to 5 times. 2 lakh 1,000. So that means approximately the answer is 15%, less than 15. Because for 15 we are getting 2 lakh 1,000, but we should get 2 lakhs. So approximately the answer is 15%. But in capital budgeting chapter, we are going to learn how to find out the accurate answer. Accurate answer, okay? So right now trial and error. Trial and error. Clear? Done? Are you able to understand the shortcut? Okay. So time value of a money. Why do we charge interest? What are the reasons for charging interest? Inflation, risk, opportunity cost, postponement of a consumption. Postponement of consumption. Okay. So the basic fundamental, if a profit increases, wealth increases. Wealth depends on two factors, profit and risk. If risk increases, required return, or we can call it as expectations, increases. If expectation increases, value, wealth decreases. Wealth decreases. So no doubt profit maximization is the objective of a financial management, but superior objective is wealth maximization is the superior objective, because wealth considers two factors, profit as well as risk. If risk increases, required return increases, and wealth decreases. It's okay. So do you agree with this concept, risk increases? If risk increases, expectation increases. Yes or no? If expectation increases, wealth decreases. Am I correct? Okay. Clear? If risk increases, required return or expectation increases. So BCom student and CMA student, who will expect more? CMA student. So expectation increases, value decreases. But CMA value is greater than BCom. Why? Risk is high. If risk increases, value has to decrease. But CMA value is greater than BCom. Why? Because value wealth depends on two factors, not just risk factor. Value depends on two factors. What are the two factors? Profit and risk. The benefit we get from CMA course is high. So obviously value will be greater than BCom degree. Okay, clear? So okay, next time value of a money. Present 1 rupee will have a more value than a future 1 rupee. Future 1 rupee. So we started with simple interest and then compound interest. So compound interest shortcut, is it okay? Shortcut. So clear. So illustration number 1, question number 1. Question number 1. So what is the solution? Time value of a money. Question number 1. What is the principal? Principal 2000. Rate of interest I. Rate of interest I is equal to 12%. N is equal to 5 years. Compounded quarterly. Compounded quarterly. N is equal to 5 years. I is equal to 12% per annum. Compounded quarterly. Now the amount is equal to, what is the formula? Amount is equal to P into 1 plus I whole power n, that is equal to 2000 into 1 plus 0.12 0.03 0.03. Why 0.03? Compounded quarterly, so we should take interest rate per quarter. Power 5 or 20 na? 20. Why 20? For 5 years, total number of quarters 20 quarters. Okay. For this, we are using a shortcut. What is the shortcut? In calculator, we take I, that is 0.03 plus 1 into 2000, sorry, into 1, press equal to 20 times. 36. So 3612 is the amount. So this is the final answer. 3612. Clear? Next, second. What is the second question? How long it will take for rupees 20,000 to double at a compound rate of 8% per annum approximately? So what is the amount? Principal 20,000. Principal 20,000. Next what? Amount is equal to 20,000. Rate of interest 8% per annum. Sorry, amount is equal to 40,000. Amount is equal to what? 40,000. So they are asking you to find out what? Number of years in which the principal will get doubled. So how can we do it? Rule 72. 72 divided by rate of interest. So the answer is 9 years. Next rule 69. 69 divided by 8 plus 0.35. 8.975 years. Clear? So accurate answer 8.975 is the accurate answer. Okay. So, but conceptually, how do we do it? Calculator, take 0.08, 0.08 plus 1 into 1, press equal to until you get 2. Ninth time you are getting 1.99. Clear? Next, third one. So note down the answer. First one, note down the answer. Next one, question number 3. Mrs. P deposited rupees 1 lakh on January 2015 in a fixed deposit scheme with a nationalized bank for 5 years. The maturity value of the fixed deposit is rupees 2 lakhs. Compute the rate of interest compounded annually. So first question they are asking you to find out the amount. Second question they are asking you to find out n number of periods. Third question they are asking you to find out the rate of interest. Rate of interest. So question number 3. So note down what is the principal. Principal. Please note down principal is equal to 1 lakh. What is the amount? Amount 2 lakhs. N is equal to 5 years because it is compounded annually. N is equal to 5 years. So clear. Now we have to find out what I. For suppose if we apply this formula, A is equal to P into 1 plus I power N. That means 2 lakhs is equal to 1 lakh into 1 plus I power 5. 1 plus I power 5 is equal to 2 lakhs divided by 1 lakh. Yes or no? 2. Now 1 plus I is equal to 2 power 1 by 5. So how can we find out 2 power 1 by 5? So we have to apply logarithms and then what? Anti-log, and then we have to find out value. Okay. So do you know logarithms? You know? Okay, fine. But so this is a long process. So that's why we have a concept of IRR, internal rate of a return. This concept we are going to learn in capital budgeting chapter. Capital budgeting chapter. So meanwhile, here we do a trial and error basis. Trial and error. Trial 1, 10%. Trial 1, 10%. Amount is equal to. We don't know the answer. We don't know the rate of interest. Let us assume rate of interest is equal to what? 10%. So to find out amount, what is the first step? Take I 0.1 plus 1 into 1 press equal to 5 times multiply with principal. What is the principal? 1 lakh. 1 lakh 51,000. 6. 1 lakh 61,000. 161051. But what is the amount we require actually? 2 lakhs. That means rate of interest has to be increased. Rate of interest has to be increased. Trial 2. 15%. Amount is equal to. So in calculator first we take 0.15. 0.15 plus 1 into 1 press equal to 5 times 2 lakh 201,136. So approximately I is equal to 15%. Approximately I is equal to 15%. Am I clear? Done. But the real procedure we are going to learn in capital budgeting. The real procedure, IRR, internal rate of a return. That concept we are going to learn in capital budgeting chapter. So clear? Now observe this formula. A is equal to formula P into 1 plus I power n. So question number 3 completed. Question number 3 has got completed. Now A is equal to P into 1 plus I power n. Amount is nothing but what? Future value. P is nothing but what? Present value. Because principal is given as on today, and in the future we receive amount. So future value is equal to present value into 1 plus I whole power n. That means present value is equal to future value into 1 divided by 1 plus I power n. Yes or no? Okay. So present value, future value. For suppose if in the question present value is given and they are asking you to find out future value, we do compounding. We do compounding. Compounding means multiply. Compounding means multiply. Okay. So till now we have done compounding only, because in the questions principal is given and they are asking you to find out amount. So what is the shortcut? Take I plus 1 into into. Okay, that means what we are doing compounding. If a present value is given and if they are asking you to find out the future value, we do a compounding, because interest will get added. Interest will get added. So this concept is called as compounding. If a future value is given and if they are asking you to find out present value, then we should do discounting. Then we should do discounting. Discounting means nothing but divided by. Future value is given in the question, and if they are asking you to find out the present value, we should go for discounting. Discounting. Nothing but divided by. You can see the formula here. Present value is equal to what? Future value into 1 divided by 1 plus I divided by. That means what? Discounting. If a future value is given in the question and if they ask you to find out the present value, then we do discounting. We do discounting. Okay, clear? So this is very important time value of money topic for hire purchase. I think in first group you have a hire purchase, right? In hire purchase you might have got this concept, time value of money. So present value, future value. If a present value is given in the question and if they ask you to find out future value, we do compounding. And if a future value is given in the question and if they ask you to find out present value, we do discounting. Discounting means divided by. Discounting means divided by. Okay. For example, present I have 1 rupee. Rate of interest 12%. After 10 years, I will have present I have 1 rupee, rate of interest 12% per annum, compounded annually. After 10 years, I will have I will have more than 1 rupee or less than 1 rupee? More than 1 rupee. So that means in calculator first I should take 0.12 plus 1 into 1 press equal to 10 times. 0.3.105. So in calculator first we take 0.12 plus 1 into 1 press equal to 10 times. So 3.105 is called as future value factor. Future value factor. What is the meaning of this 3.105? For suppose if you have 1 rupee as on today, by the end of 10th year, that will be equal to 3.105 if rate of interest is 12% per annum. 12% per annum. For suppose if I am going to receive 1 rupee after 10 years, rate of interest is 10%. After 10 years, I am going to receive 1 rupee. After 10 years, I am going to receive 1 rupee. Rate of interest is 12%. Then what is the present value? Nothing but what? Amount is given. What is amount? 1 rupee. N is equal to 10. I is equal to 12%. That means what? I have to find out P, present value. P is equal to A into 1 divided by 1 plus I power n. So how can I do it? Simple. Amount 1 rupee divided by 1 plus I. What is I here? 0.12. So 1 divided by 1.12. Press equal to 1 time. Press equal to only 1 time. 1 divided by 1.12. Press equal to 1 time. How much are you getting? 0.892. 0.892. What is the meaning of the 0.892? If you are going to get 1 rupee at the end of a first year, that 1 rupee is equal to 0.892 as on today. Or else we can say like this. If you have a 0.892 as on today, that 0.892 within a year it will be equal to 1 rupee. This 0.892 is called as present value factor. Present value factor will always be less than 1. Future value factor will always be greater than 1. Why future value factor will be greater than 1? Because interest is added. So that's why future value factor will always be greater than 1. Present value factor will always be less than 1 because we are reducing the interest. We are reducing interest. Okay. So 0.892 is called as a present value factor of first year at the rate of 12%. Press again equal to 0.7 0.797 is called as a second year present value factor. Second year present value factor. What is the meaning of this 0.797? If you have a 0.797 today, that will be equal to 1 rupee after 2 years. Or else we can say like this. After 2 years, if you are receiving 1 rupee, that 1 rupee is equal to 0.797 as on today. Okay. Next press again equal to 0. What is this 0.711? Third year present value factor. Third year present value factor. If you have a 0.711 as on today, that 0.711 will become 1 rupee by the end of 3 years, or else at the end of a third year you are going to receive 1 rupee. That 1 rupee is equal to 0.711 as on today. But here in my example, I am going to receive 1 rupee after 10 years. 1 rupee after 10 years. So that's why you should press equal to 7 more times. 0. 0.3219. 0.3219 is present value factor. 0.3219 is the present value factor. Clear? Am I clear? 0.3219 is the present value factor. Done? So this is very important concept. Without this, we cannot proceed further. You have to understand this present value factor and future value factor, that too conceptually. Okay. Clear? If a present value is given and if they are asking you to find out the future value, we should do compounding. If a future value is given and asking to find out present value, then we do discounting. Discounting means divide. We divide with 1 plus I. Okay. Compounding means we multiply with 1 plus I. So that is what we are doing. If you observe the shortcut of a compound interest, I plus 1 into 1. Press equal to n times and then multiply with principal. Multiply with what? Principal. Am I clear? Done? So question number 4. Question number 4. We have a concept of effective rate of interest. Effective rate of interest. Question number 4. If the nominal rate of interest is 10% per annum and frequency of a compound is 4, frequency of a compounding is 4, that is quarterly compounding, the effective rate of interest will be. So nominal rate of interest is 10% per annum. Frequency of a compound is 4, that is quarterly compounding. So the effective rate of interest will be. Effective means, in reality. For example, Manikanta came to class at morning 9, okay? He's sitting in classes up to 6. But effectively, he might be listening to classes only for 2 to 3 hours. Effective. Effective is different. Effective means what? Reality. So generally CA and CMA students, they used to give build-up, yes or no? We study for 12 hours, 16 hours. We sacrifice lot of festivals, relations, etc., etc. But nobody will be studying for 12 to 16 hours. Yes or no? 12 to 16 hours. Is anybody studying for 12 to 16 hours? Nobody is studying. But still what? They portray like we are sacrificing a lot. Yes or no? In reality, they might be effectively studying for what? 3 to 4 hours a day. 3 to 4 hours a day. Likewise, here also, the nominal rate of interest is 10% per annum, but it is compounded quarterly. Compounded quarterly. Compounded quarterly means, in reality, the rate of interest being paid is more than 10. Why it is more than 10? Because it is compounded quarterly. Compounded quarterly means what happens? For every quarter, interest will be added to the principal. Interest will be added to the principal. What is the nominal rate of interest? 10%. So they are saying compounded quarterly. Compounded quarterly. So take the quarter interest rate. What is the quarter interest rate? 2.5. In calculator, you take 0.025. In calculator, take 0.025. What is the meaning of this 0.025? Interest for 1 rupee for 1 quarter. Interest for 1 rupee for 1 quarter. Yes or no? So 0.025 plus 1. Nothing but we are adding principal 1 rupee plus 1 into 1. Press equal to 1 time. 1.025. By the end of a first quarter, we have to pay 1.025. Press equal to again 1 point. By the end of a second quarter, 6 months. By the end of a 6 months, we are going to pay 1.05 something. Yes or no? Press equal to again 1.0768. This is by the end of third quarter. Press equal to again 1.1038. Nothing but on 1 rupee, you are paying interest of 0.1038. Yes or no? On 1 rupee, you are paying interest of 0.1038. Yes or no? That means effective rate of interest is not 10%. Effective rate of interest is more than 10%. That means minus 1 into 100. Minus 1 means you are reducing the principal amount, 1 rupee. Minus 1 into 100. So what is the effective rate of interest? 10.38. Are you getting my point? If they are saying compounded quarterly, that means effectively you are paying more than 10. You are paying more than 10. Simple common sense. 10% rate per annum, but you are paying interest for every quarter means the rate of interest will be more than 10. For suppose if it is compounded quarterly, then compounded half yearly. If it is compounded half yearly, then what is the calculation? 0.05 plus 1 into 1. Press equal to how many times? Only 2 times, because 1 year will have a 2 half years. 1.1025 minus 1 into 100. 10.25. So effective rate of interest will be 10.25 if it is compounded half yearly. If it is compounded quarterly, effective rate of interest 10.38. For suppose if it is compounded monthly, then what? 0.1 divided by 12. 0.1 divided by 12. Then you will get interest rate per month. 0.1 divided by 12 plus 1 into 1. Press equal to how many times? 12 times. Compounded monthly. 1 year is equal to 12 months. 1.10, nothing but 10.47. 10.47 is the effective rate of interest. Apply your common sense. If it is compounded half yearly, rate of interest is 10.25. If it is compounded quarterly, effective rate of interest is 10.38. If it is compounded monthly, effective rate of interest is 10.47. For suppose if it is compounded daily, we are not going to do now, but if it is compounded daily, so effective rate of interest will be more than 10.47 or less than 10.47? More than 10.47, because you are paying interest on daily basis. You are paying interest on daily basis. Clear? Done? So 10.38 is the answer. See the question number 5. If annual effective rate of interest is 10.25, per annum and nominal rate of return is 10% per annum, what is the frequency of a compounding? Effective rate of interest is given. Effective rate of interest is given and nominal rate of return is 10% per annum. What is the frequency of a compounding? Here the answer is given wrong. So frequency of compounding is half a year. Already we have done, no? Compounded half yearly. Yes or no? 0.05 plus 1 into 1 plus equal to 2 times. Minus 1 into 100. So the answer is, so here the frequency of compounding. What is the frequency of compounding? Frequency of compounding half yearly. Frequency of a compounding half yearly. Clear? Okay. Next, question number 6. Suppose someone promises to give you rupees 1,000 3 years hence. Someone promising you to give 1,000 rupees, not now, after 3 years. What is the present value? What is the present value if the rate of interest is 10%? Here they are asking the present value or a future value? Present value. Future value is given. What is the future value? 1,000. We have to find out future present value. Future value is given. They are asking you to find out the present value. We should go for compounding or discounting? Discounting. Discounting means divided by. So 1 divided by 1.1 equal to 3 times. 1 divided by 1.1 equal to 3 times. You will get 0.751. But 0.751 meaning is present value of a 1 rupee to be received after 3 years. But here we are receiving 1,000 rupees. So 1,000 into 0.751. 751. So write down the solution for question number 6. Question number 6. Arvind. Amount or a future value is equal to? Amount or a future value is equal to? What is amount or a future value? 1,000. Rate of interest I is equal to 10% per annum. N is equal to 3 years. They are asking you to find out principal or present value. Principal or present value. Principal or present value. Principal or present value. So generally we apply this formula. What is the formula? A is equal to P into 1 plus I power n. Yes or no? Here we have to find out present value. P is equal to future value into future value into 1 divided by 1 plus I power n. If I have to write it conceptually, then future value into present value factor. 1 divided by 1 plus I power n is called as present value factor. How do I get present value factor? 1 divided by 1 plus I plus equal to how many times? N times. Here n is equal to 3. So 1 divided by 1.1 plus equal to 3 times 0.751. So the answer is 751. If you are going to receive 1000 rupees at the end of 3 years, the value of that 1000 rupees as on today 751. Nothing but if you deposit 751 as on today at the rate of 10%, that will become 1000 rupees in 3 years. Vinay, 1000 rupees in 3 years. Clear? Yes, Raju. Is it clear? Next, question number 7. The ABC Limited Company expects to receive rupees 1000 for a period of 10 years from a new project it has just undertaken. The ABC Limited Company expects to receive rupees 1000 for a period of 10 years from a new project it has just undertaken. Assume a 10% rate of interest. How much would be the present value of this annuity? Present value of this annuity. This question is different. Question number 7 is different from question number 6. Write down the next concept, annuity. Annuity. Annuity means same amount at annuity means same amount at same intervals. Annuity means same amount at same intervals. Same amount at same intervals. Annuity. It can be annuity regular. Annuity regular means at the end of the period. Annuity regular means at the end of the period. Annuity regular means at the end of the period. Annuity immediate is also called as annuity due. Annuity immediate is also called as annuity due. At the beginning of the period. At the beginning of the period. If it is at the beginning of the period, it is called annuity immediate or annuity due. If it is at the end of the period, it is called annuity regular. Annuity regular. Clear? Okay. Annuity regular, annuity immediate. Regular means at the end of the period. Immediate means beginning of the period. If a question is silent, we assume that annuity as a annuity regular. If a question is silent, then we assume the annuity as a annuity regular. Clear? So what is annuity? Annuity means what? Same amount at same intervals. Same amount at same intervals. Okay. For example, year and amount. Year 1, 2, 3, 1 lakh. Fourth year 1 lakh. So is this an annuity or not? Is this an annuity or not? This is not an annuity. Why? Same amount but not at same intervals. Because first year 1 lakh, second year nil, third year 1 lakh, fourth year 1 lakh. So intervals are not same. Interval is not same. So that's why this is not an annuity. Not an annuity. Okay. Next, year and amount. 1 lakh. Now tell me, this is an annuity or not an annuity? This is not an annuity. Why? Amount is not same. Intervals are the same, but amount is not same. So that's why this is not an annuity. Year and amount. So this is an annuity. Why? Same amount at same intervals. Same amount at same interval. And this amount can be at the end of the period or at the beginning of the period. If it is at the end of the period, it is called annuity regular. If it is at the beginning of the period, annuity due or immediate. For example, Hari, he is giving a gift of rupees 1 lakh to his wife on 1st January every year. On 1st January every year, he is giving a gift of rupees 1 lakh. Hari. Now tell me whether it is an annuity or not. It is an annuity. Why? Same amount at same intervals. Every year on 1st January, he is giving 1 lakh rupees gift to his wife. Is it an annuity regular or annuity immediate? Annuity immediate. Why immediate? Because it is given at the beginning of the period. It is given at the beginning of the period. Okay, clear? Okay. For suppose if he is giving 1 lakh rupees gift to his wife on December 31st every year. Annuity regular. Annuity regular. Annuity regular means paid at the end of the period. Immediate means paid at the beginning of the period. So clear? Now let us write the shortcuts. In exam they will ask you present value of a annuity or annuity related questions. They might ask you annuity They might ask you future value or present value. Annuity related questions, they might ask you future value or present value. If they ask future value, we do compounding, right? If they ask present value, discounting. Discounting means divided by. Discounting means divided by. Clear? And again, future value. They might ask you the future value annuity regular or future value annuity immediate. Future value annuity immediate. Likewise, they might ask you present value regular or present value of annuity immediate. Immediate means beginning of the period. Beginning of the period. Beginning of the period. Now, let us take example for future value of annuity. What is the first one? Future value of annuity regular. Future value of annuity regular. Year amount. Future value of a amount. Future value factor. Year amount, future value factor, future value of a amount. Year amount, future value factor, future value of a amount. For example, year 1, 2, 3. Let us assume the rate of interest is equal to 12%. Rate of interest is equal to 12%. What is the amount? 1 lakh every year. 1 lakh every year. What is the heading? Annuity regular. Annuity regular means end of the period. End of the period means 1 lakh at the end of first year, 1 lakh at the end of second year, 1 lakh at the end of third year. So they might ask you to find out the future value of a annuity. Future. Future means at the end of a third year. We are receiving amount for how many years? 3 years. Yes or no? Future value of annuity regular means they are asking you to find out the value at the end of the third year. Value at the end of a third year. So okay. Now tell me. But suppose at the end of a first year we are getting 1 lakh. We are getting 1 lakh. And the question is they are asking to find out. They are asking you to find out the value at the end of the third year. Value at the end of third year. At the end of first year value, we should find out the value at the end of a third year. So now my point is, how many years we are going to get interest? For suppose at the end of first year, I am getting 1 lakh. That 1 lakh I am depositing at the rate of 12%. At the rate of 12%. How many years I am going to get interest? 3 years or 2 years or 1 year? 2 years. Why 2 years? First year ending 1 lakh. If I deposit 1 lakh at the end of a first year, I receive interest for second year and third year. Yes or no? So nothing but 1 plus 0.12 square. What about the second year ending 1 lakh? If I deposit 1 lakh at the end of a second year, how many years I am going to get interest? 1 year. What about the third year? If I receive a third year ending 1 lakh, so I will not receive any interest. Why? Because I am receiving at the end of third year, and the question is value at the end of a third year. So that's why I am not going to receive any interest. That means 1 plus 0 power 0, that is equal to 1. Yes or no? So 1 minute. Okay. Wait. So it is annuity regular. Annuity regular. Question is about what? Future value of a annuity regular. We have to find out the future value. Right? So now tell me, third year ending 1 lakh will be 1 lakh only. Why? Because we are not going to get any interest. What about the second year 1 lakh? On second year 1 lakh, we receive interest for 1 year. So the value will be 1 lakh 12,000. Yes or no? What about the first year 1 lakh? 1.2544. Nothing but 1 lakh 25,440. Last column I can take total or not? Yes, because all the values are at the end of a third year. All the values are at the end of a third year. What is the total? 3 lakh 3,37,440. So this 3,37,440 is called as a future value of a annuity regular. Nothing but if I am going to receive 1 lakh every year for 3 years, by the end of third year, I will have 3,37,440. But instead of doing this, we follow the shortcut. Year 1-3, amount 1 lakh, we take future value, annuity factor. Amount into future value, annuity factor. Or shortcut 1-3. Instead of 1, 2, 3, we take 1-3. Amount column we take 1 lakh and we multiply with future value annuity factor. How do I get future value annuity factor? Simple. Future value annuity factor. Shortcut. Future value annuity factor shortcut. Similar to compound interest amount shortcut. What is the shortcut? Take I, add 1, multiply with 1, press equal to only n minus 1 times. Press equal to only n minus 1 times. Here n is equal to 3. That means you should press equal to only 2 times. Then grand total and then add 1. Grand total and then add 1. Take I plus 1 into 1, press equal to n minus 1 times, press grand total, add 1. So tell me the factor. 3.3744. So the answer is 3,37,440. So understand the shortcut. So first in calculator, first what we are taking? I. So what is I here? 0.12. Everybody please in calculator take 0.12 and observe the numbers. 0.12. What is this 0.12? Interest for 1 rupee. Interest for 1 rupee. 0.12 plus 1 into 1 press equal to. Press one time. I mean just press one time. What is the number you are getting? 1.12. Wait. This is 1.12, right? And again press equal to 1.2544. Press GT. Press GT grand total button. 2.3744. Nothing but total of 1 and 2. Yes or no? And then what? Add 1. Yes or no? Nothing but total of 1.2544, 1.12 and 1. 3.3744. Straight away multiplying with 1 lakh. So the answer is 3,37,440. Once again, observe the shortcut. Observe the shortcut. So first in calculator take 0.12. Understand what is this 0.12. What is this 0.12? Interest for 1 rupee. Interest for 1 rupee. 0.12 plus 1 into 1. Press equal to 1 time. You are getting 1.12. What is the meaning of this 1.12? If you are depositing 1 rupee at the end of a second year, that will become 1.12 by the end of third year. Again press equal to 1.2544. 1.2544. If you are depositing 1 rupee at the end of a first year, that will become 1.2544 by the end of third year. GT grand total. Grand total 2.3744. What is the meaning of this 2.3744? First year ending you are depositing 1 rupee. Second year ending you are depositing 1 rupee. So the total by the end of third year will be 2.3744. But we are depositing 1 more rupee at the end of third year. So that's why add 1. 3.3744. If you are depositing every year 1 rupee for 3 years, the value at the end of third year will be 3.3744. But here I am not depositing 1 rupee. I am depositing 1 lakh. So that's why into 1 lakh. So the answer is 3,37,440. Am I clear? So why we are pressing equal to only n minus 1 times? because for the last year annuity we are not going to get any interest, and for the first year annuity we are going to get interest only for n minus 1 years. N minus 1 years, yes or no? First year annuity, on first year annuity we are going to get interest only for 2 years, because this is annuity regular means end of the period. Okay, completely FM and SFM 200 marks completely dependent on time value of our money. Okay, you should know why we are pressing equal to n minus 1 times, why n times, why GT. You have to understand everything. Next, annuity immediate. Future value of what? Annuity immediate. Future value of annuity immediate. GT లేదా? You should have a calculator with GT. Otherwise, you should use M plus. But M plus, using M plus is risky. So better you buy the calculator with GT, grand total. Okay. You better buy the calculator with GT, grand total button. Otherwise, you will waste time. So year. So this time it is what? Annuity immediate. Immediate means end or beginning? Beginning. Beginning. So tell me first year beginning. First year beginning means as on today. So future value of annuity. I want value at the end of a third year. Value at the end of a third year. First year beginning I am receiving 1 lakh. First year beginning as on today I am receiving 1 lakh. If I deposit 1 lakh, if I deposit 1 lakh as on today, how many years I am going to get interest? 3 years. This time I am going to get interest for 3 years. So that means 1.12 power 3. Second year beginning 1 lakh. Second year beginning I am going to deposit 1 lakh. I am going to get interest for 2 years. 1.12 square. Third year beginning 1 lakh. If I deposit 1 lakh at the beginning of third year, I will receive 1 year interest. So that means 1.12. So 1,12,000. 1,25,440. 140. 490. 2 or 3? 3. So total 3 lakh. 70. 3,77,933 is the future value of a annuity. Regular or immediate? Immediate. Or shortcut year amount, future value annuity factor, rupees into future value annuity factor. Year column 1-3, amount column 1 lakh. Future value annuity factor. Future value annuity factor means always you should press grand total GT. Now shortcut. take I plus add 1 into 1 press equal to how many times? N times. N. Why N? N times why? Because for first year annuity we are getting 3 years interest. That means N years interest. So press equal to N times and grand total GT. We need not add 1 separately. Why? Already we are pressing equal to how many times? 3 times. Grand total. What is the number? 3.77933. So 3,77,933. 3,77,933 is the answer. Clear? Once again, observe the shortcut. In calculator, first you take I plus 1 into 1. Press equal to 1 time. Then you will get 1.12. Press equal to second time. You will get 1.2544. Press equal to third time. You will get 1.40493. All the three are considered. Grand total. We got the total of all the three. So that's why we need not add one separately. Okay. Clear? Clear, Sudarshan? In both the cases, we are doing compounding or discounting? Compounding. Why? We are finding out future value. But if they ask you to find out the present value, we have to do discounting. Next, present value of annuity, regular. Present value of annuity, regular. Present value of annuity, regular. Year amount. This time we should multiply with present value factor. Present value of annuity means we are bringing the future 1 lakhs to present value 0 as on today. In previous question, we are finding out the value at the end of the third year. Clear? This time we are bringing the future cash flows to the present value. So this is regular. Regular means end of the first year, end of the second year, end of the third year. So year 1, 1 lakh. That is at the end of the first year, end of the first year. But we should bring it to the present value. Okay. So in calculator, we should take 1 divided by 1.12. 0.89. 29. 28 means 0.893. 0.893. What is the meaning of this 0.893? If you are receiving 1 rupee at the end of first year, the value as on today is equal to 0.893. Press equal to again. 0.797. Press equal to again. 711. So 89,300, 79,700, 71,100. Vinay, what is the total? 2,40,183. So this is present value of annuity. Present value of annuity regular 2,40,100. Okay, okay. Or year amount, instead of present value factor we take present value annuity factor. Year 1 hyphen 3. What is the amount? 1 lakh. Simple calculation. 1 divided by 1.12. Press equal to n times. Press equal to 3 times. And then what? Grand total. 2.4018. So 2,40,180. So what is the shortcut? Take 1, divide with 1 plus I, press equal to how many times? N times, and then what? GT, grand total. Take 1, divide with 1 plus I, press equal to n times, grand total. So okay, once you observe the calculation, take 1 in calculator. 1 divided by 1.12. You will get 0.893. Yes or no? 0.893. Again equal to 0.711. Press grand total. Nothing but you are getting total of 0.893, 0.797 and 0.711. So multiply with 1 lakh. So final answer 2,40,180. Clear? So this is present value of annuity regular. Next, present value of annuity present value of annuity immediate. Present value of annuity immediate. Present value of annuity immediate. Same example, year 1, 2, 3, amount 1 lakh. Present value factor. Annuity immediate means what? Ending or beginning? Beginning. First year beginning means as on today. First year beginning means today, as on today. So as on today, if you are receiving 1 rupee, what is the value? 1 rupee. So discounting is required or not required? No discounting is required. Yes or no? So that means what is the factor? 1. Yes or no? Second year beginning means end of the first year. End of the first year. So one time discounting is required. Only one time discounting. So 1 divided by 1.12. 0. Third year beginning means second year ending. So 2 times the discounting is enough. 0.797. So 1 lakh 89,300, 79,700. 2 lakh 2,69,000. 2,69,000 is the final answer. Okay. But or 1-3 1 lakh, instead of present value factor we take present value annuity factor. Year 1-3 PVAF at the rate of 12%. This time it is annuity regular or immediate? Immediate. So what is the shortcut? Take 1 divide with divide with 1 plus I. Press equal to how many times? N minus 1 times grand total and then add 1. Why press equal to n minus 1 times? Because first year annuity we need not discount. First year annuity we need not discount it. So that's why press equal to n minus 1 times grand total and then what? Plus 1. So 1 divided by 1.12. When you press equal to first time, you will get 0.893. Again equal to 0.797. And then GT, you will get total of 0.893 and 0.797. Add 1. So factor will be 2.669 6900, nothing but 2,69,000. Clear? Future value of annuity is equal to annuity into future value annuity factor. Yes or no? Future value of annuity is equal to annuity into future value annuity factor. Okay. First, suppose if it is regular, We multiply with future value annuity factor regular. Future value annuity factor regular. Press equal to how many times? N minus 1 times. Why n minus 1 times? Regular means end of the period. So for the last year annuity, we are not going to get any interest. So that's why press equal to how many times? N minus 1 times. If it is future value of annuity, immediate, then what? Annuity into future value annuity factor immediate. Press equal to how many times? N times. Why? Because for last year annuity also we are going to get interest. And for first year annuity we are going to get interest for n years. So that's why press equal to how many times? N times. Next. Present value of annuity regular. Annuity into present value annuity factor regular. Press equal to how many times? N times. Be careful. If it is present value and regular, we press equal to how many times? N times. If it is future value and if it is regular, we press equal to n minus 1 times. Reverse. Next, present value of annuity immediate. Annuity into present value annuity factor immediate. Press equal to how many times? Press equal to n minus 1 times. Am I clear? So this is very important concept. Try to understand today. So okay, if you want again tomorrow I will explain. But you have to understand this concept. Without this concept, we cannot understand FM and SFM also. Okay, clear? So if they are giving present value and they ask you to find out future value, we do compound. And if future value is given and they are asking you to find out present value, we do discounting. Okay. So I think now you can find out the answer for seventh one. ABC Limited Company expects to receive 1 lakh, expects to receive rupees 1 lakh for a period of 10 years. For a period of 10 years from now, from a new project it has just undertaken. Expects to receive 1 lakh for a period of 10 years. For a period of 10 years means every year company is going to get 1 lakh for how many years? 10 years. Assuming 10% rate of interest, how much would be the present value of this annuity? If a question is not clear, we assume annuity as a regular. So this is annuity regular and they are asking you to find out the present value of a annuity. Simple. How do I get present value of annuity? Annuity into present value annuity factor. How do I get present value annuity factor? 1 divided by 1 plus I press equal to n times GT because it is annuity regular. If it is annuity regular, press equal to how many times? N times. So simple. 1 divided by 1.1, 1 divided by 1.1 press equal to 1 divided by 1.1 press equal to 10 times and GT grand total because we are receiving 1 lakh every year for 10 years. So what is the answer? 6 lakh 6,14,460. Clear? If it is 20 years, then 1 divided by 1.1 is equal to 20 times grand total. If it is 30, equal to 30 times grand total. If it is 50, equal to 50 times grand total. That's it. Clear? Done? Clear? So 6,14,460. Write down the answer. Question number 7. Question number 7. Annuity is equal to 1 lakh. I is equal to 10%. N is equal to 10 years. Present value of annuity is equal to annuity into present value annuity factor. If a question is silent, then annuity is annuity regular. So that is equal to, what is the annuity? 1 lakh into present value annuity factor. Discounting, we have to do discounting, nothing but divided by. So 1 divided by 1.10 equal to how many times? 10 times. So 6.1 double. So 6,14,400. Okay, fine. 6,14,400 is the answer. So clear? So before discussing the remaining questions, you practice up to question number 6. I'm just displaying the questions. You practice question number 1 to additional questions. From examination point of view, main questions are enough, but for practice, you do additional questions now. But during examinations, additional questions are not required. Okay. See the question number 1. A person invests 1,50,000 in an investment which pays 12% rate of interest. What will be the future value of a invested amount at the end of 10 years? Simple question, yes or no? If a person invests 1,50,000 which pays a 12% rate of interest, what will be the future value? Principal is given, rate of interest is given, n 10 years, and we have to find out what amount. 4,65,000. Simple calculation. In calculator, first we should take 0.12 plus 1 into 1 plus equal to 10 times. We should not do grand total because this is not an annuity. Single amount. We are depositing as on today 1,50,000. So 0.12 plus 1 into 1 plus equal to how many times? 10 times. So multiply with 1,50,000. 4,65,000. Next question. An individual deposited 1 lakh in a bank at 12% compound interest per annum. How much he would receive after 20 years? Again, same. So in calculator, we take 0.12. In calculator, we take 0.12 plus 1. 0.12 plus 1. So simple, 0.12 plus 1 into 1 press equal to 20 times. Then multiply with what? 1 lakh. So 9,64,600. Third one, ascertain the future value and compound interest of an amount of rupees 7,500, so 75,000 at 8% compounded semi-annually for 5 years. Semi-annually. Half year. That means in calculator we should take 0.04 0.04 plus 1 into 1 plus equal to 0.04 plus 1 0.04 plus 1 into 1 press equal to how many times? 10 times. Then multiply with what? 75,000. So the answer is 1,11,000. Clear? Next, fourth one. Find the present value of 1,000 receivable 6 years hence if the rate of discount is 10%. Already similar question we have already done. Yes or no? So present value. This time present value. We are going to receive 1,000 after 6 years. So what is the present value? Is this an annuity? This is not an annuity. We are going to get only 6,000 rupees at the end of 6th years. Single amount. Annuity means the same amount at same intervals. But here we are getting only 1,000 rupees at the end of 6th year. What is the answer? Simple. 1 divided by 1.1 press equal to 6 times. 1 divided by 1.1 press equal to 6 times. Into what? Into 1,000. 560. Next, fifth one. 1,000 receivable 20 years hence if the discount rate is 8%. What to do? 1 divided by 1.08 press equal to 20 times into 1,000. 214. 214. Clear? Sixth one. How much amount should an investor invest now? How much amount should an investor invest now? Now means present value. In order to receive 5 annuities starting from the end of the year of rupees 1,000, starting from the end of this year of rupees 10,000, if the rate of interest offered by the bank is 10% per annum. If an investor wants to receive 10,000 every year for 5 years, what is the amount to be deposited as of now? That means they are asking you to find out the present value of a annuity. Present value of a annuity. So they have told at the end of this year. End of this year means regular. Annuity, regular. Simple. Present value of annuity is equal to annuity into present value annuity factor. Here annuity 10,000. How do I get present value annuity factor? 1 divided by 1 plus I. 1 divided by 1.1 press equal to 5 annuities. 5 annuities means n is equal to 5. 1 divided by 1.1 press equal to 5 times GT. 30, 37,009, 908. Factor is already given in the question. Even if it is not given in the question, we can calculate. 1 divided by 1.1 press equal to how many times? 5 times, 10. N times. Press equal to n, how many times? N times. Clear? So go through the notes, get clarity by tomorrow. If you want, again, tomorrow I will explain with some more examples. Otherwise, what we proceed further. Without understanding time value for money, we cannot proceed further. Okay? Even if you are able to complete FM, but for SFM, we require time value for money. Okay? So first we started with simple interest, and then what? Compound interest. Compound interest shortcut, I hope you remember. And effective rate of interest. I hope you are able to understand effective rate of interest also. Effective rate of interest. So effective rate of interest, how we are calculating it? Simple, what we are doing? If a frequency of a compounding is quarterly, we take quarter interest. Yes or no? Question number 4. 10% is per annum. Compounded quarterly means quarter interest rate. What is the quarter interest rate? 0.25. 0.025. 0.025 plus 1 into 1 press equal to 4 times. For 1 year, 4 quarters. 0.025 plus 1 into 1 press equal to how many times? 4 times. Minus 1 into 100. So effective rate of interest 10.38. You have to apply shortcuts. We cannot use formula, okay? At the CA foundation or CMA foundation level, you might have learned a formula, but here we cannot apply formula. Okay, you have to understand it conceptually and you have to apply shortcut. Okay, clear? Done? So why time value for money is required for FM? Financial management, two aspects are procurement of fund, effective utilization of fund. Effective utilization of fund. We utilize the fund for two purposes: fixed assets, current assets. For current assets, we have a working capital management chapter, and for fixed assets, we have a capital budgeting. Investment in fixed assets. We utilize the fund for fixed assets. Example, for example, if a BCCA is purchasing a bus, it is a capital budgeting decision. It is a capital budgeting decision. Okay. If a Coca-Cola company is purchasing a machinery, it is a capital budgeting decision. So why do we require time value of money? For suppose, if a company is purchasing plant and machinery as on today, it is going to receive a benefit as on today itself or in the future. For example, if a company is purchasing a fixed asset as on today, will the company receive a benefit immediately or in the future? Future. For example, Manikanda, he purchased a truck from Monica. Monica was doing a business, last journey business. Okay, last journey. So she is using a van for carrying dead bodies. Last journey, last journey. So now she sold that van to truck to Manikanda. Now Manikanda, he is doing, I mean, he is using the truck for tiffin center, idli, dosa, etc. Okay. For Manikanda, it is a fixed asset or not? Fixed asset. Manikanda, he bought the truck for rupees 5 lakhs from Monica. Okay. So Manikanda will get 5 lakh rupees benefit immediately or in the future? In the future, yes or no? So Manikanda will use the truck for what? Tiffins. Yes or no? He will prepare some dosa and sell it to Sudha. Okay, he will prepare some idli and sell it to okay Sunita, etc., etc. Yes or no? That's how he will generate revenue. Whether the revenue will be generated immediately or in the future. In the future, he might be using the truck for next 5 years. Next 5 years. Yes or no? So present 1 rupee is not equal to future 1 rupee. So we have to consider time value of a money. So for capital budgeting decision, we have to consider time value of a money. For Manikanta, it is a capital budgeting decision, whether to purchase a truck or not. For Monica also, it is a capital budgeting decision. అంతే కదా. మౌనికి ఇప్పుడు ట్రక్ కొంది కదా అని చెప్పి అందరూ ఒకేసారి చచ్చిపోయి ఎక్కేస్తారు బండి. ఎక్కరు కదా. ఎలా అవుతుంది? కామన్ సెన్స్ అప్లై చేయండి. ఆ అమ్మాయి బండి కొంటే ఏమవుతాం ఇప్పుడు? ఆ అమ్మాయి ట్రక్ కొంటే ఇన్స్టాల్మెంట్లో ఒక్కొక్కరు అలా చనిపోతూ ఉంటారు, అవునా కదా. బండి ఒకేసారి ఎక్కరు కదా. సో నెక్స్ట్ 5 yearsలో షీ విల్ జనరేట్ రెవెన్యూ. ఎస్ ఆర్ నో? బట్ అవుట్ఫ్లో ఎప్పుడు ఉంది? వెన్ ఈజ్ షీ పర్చేసింగ్ ద ట్రక్? యాజ్ ఆన్ టుడే. అవుట్ఫ్లో ఎప్పుడు ఉంది? ఇన్ఫ్లో ఎప్పుడు వస్తుంది? ఇన్ఫ్లో ఫ్యూచర్. So present 1 rupee is not equal to the future 1 rupee. So we have to consider time value of a money. So that's why we are learning about time value of a money. Clearer? Okay. So go through the notes, Bhavana. So time value of a money. Present 1 rupee will have a more value than a future 1 rupee. So what are the reasons for time value of a money? Inflation, risk, opportunity cost, postponement of a consumption. Postponement of a consumption. Everybody prefer present consumption or a future consumption? Present consumption. Okay. Present consumption. Yes or no? Okay. Next, inflation. Inflation means rise in prices. Rise in prices. Risk means a possibility of occurrence of a loss. Possibility of occurrence of a loss. So for example, we are sitting here. Is there any risk or not? There is a risk. Roof may fall on head, yes or no? But the risk is less, very less. Possibility of occurrence of loss is very less, very less. Okay. But if Sudha is jumping from 3rd floor, the risk will increase or not? Risk will increase or not? Risk will increase. Risk will increase. So Kavya going opposite to the train. Risk will increase. Risk will increase. Yes or no? So risk means a possibility of occurrence of loss. Possibility of occurrence of a loss. So if we are doing a business, whether there is a risk or not, yes, there is a risk. There is a possibility of occurrence of loss, we may or may not get profits. We may or may not get profits. Clear? Done. So first we started with simple interest, right? So simple interest not at all required actually. Why? At CA inter level or CMA inter level, the main important concept is compound interest, because practically nobody will be charging simple interest. Practically, okay, in the market everybody would be charging compound interest. Compound interest. So compound interest A is equal to P into 1 plus I whole power n. A is equal to P into 1 plus I power n. P principal, A amount. A amount. So now tell me, what is the shortcut to find out amount? First we take I plus 1 into 1 equal to n time. Okay, grand total required or not required? Grand total is not required. So multiply with principal. సో బై హార్ట్ చేస్తున్నారా లేకపోతే అర్థమైందా? ఓకే ఫైన్. ఓకే నెక్స్ట్. సో దిస్ ఈస్ ద షార్ట్ కట్ ఫర్ వాట్? కాంపౌండ్ ఇంట్రెస్ట్ అమౌంట్ క్యాలిక్యులేషన్. సో అమౌంట్ మైనస్ ప్రిన్సిపల్ ఈజ్ ఈక్వల్ టు కాంపౌండ్ ఇంట్రెస్ట్. ఓకే ఫైన్. నెక్స్ట్ effective rate of interest. Effective rate of interest. So for effective rate of interest we take I. Yes or no? I means always, I means interest rate per period, not the interest rate per annum. Not the interest rate per annum, interest rate per period. Interest rate per period. Okay. So if it is compounded quarterly, we should take interest rate per quarter. If it is compounded half yearly, interest rate per half year. If it is compounded monthly, interest rate per month. Interest rate per month. Clear? Next. Am I clear? So whenever I write I means what? Interest rate per period, not interest rate per annum. So what is the shortcut for effective rate of interest? Effective rate of interest, first we should take I plus 1 into 1 plus equal to number of periods per annum. ఐఏసీలో ఆఫ్ చేయండి, విండోస్ తీసేది. చంద్రబాబు సార్ చెప్పలేదా? ఓకే. సో ఐ ప్లస్ వన్ విండోస్ తీశారు, ఏసీస్ ఆఫ్ చేయండి. విండోస్ తీసేందుకు I plus 1 into 1 press equal to how many times? Press equal to how many times? Number of periods per annum. So for example, if it is compounded quarterly, then press equal to how many times? 4 times. If it is compounded half yearly, press equal to 2 times. If it is compounded monthly, press equal to 12 times. Thereafter minus 1 into 100. Then you will get effective rate of interest. Am I clear? Done. Next. Annuity. Annuity means same amount at same intervals. Annuity means same amount at same interval. Annuity can be annuity regular or annuity immediate. Annuity regular means end of the period. End of the period. End of the period. Annuity immediate means beginning of the period. Beginning of the period. Okay. So they might ask you to find out the future value or present value. Future value of annuity is equal to annuity into future value annuity factor. In that we have seen regular and what? Immediate. So future value of annuity, immediate. Annuity into future value annuity factor, immediate. So this future value annuity factor is similar to what a compound interest, I mean amount calculation, right? Yes or no? The shortcut is similar to compound interest. So whenever they ask you to find out the future value, we should go for compounding. Compounding means multiplication. We should go for multiplication. Okay, clear? So now tell me, so what is the shortcut for future value annuity factor regular? Future value annuity factor regular. Take I plus 1, I plus 1 into 1 press equal to n minus 1 times GT, grand total, plus 1. Why equal to n minus 1 times? Because for the last year annuity, we are not going to get any interest. And for first year annuity, we are going to get interest for n minus 1 years. So that's why press equal to n minus 1 times grand total plus 1. Why 1? Last year annuity. Last year annuity. Okay. If you are pressing GT, it is called as future value annuity factor. If you are not pressing GT, that is called as future value factor. Future value factor. If you are taking the total, that is called as future value annuity factor. If you are not taking the total, if you are taking a single amount, that is called as what? Future value factor. For example, in calculator, take 0.1, 0.1 plus 1 into 1, 1.1. So this is the future value factor. What is the meaning of this? If you have a 1 rupee, that 1 rupee will become 1.1 in 1 year. In 1 year. Press equal to again 1.21. What is the meaning of this 1.21? If you have a 1 rupee, that 1 rupee will become 1.21 in 2 years. What is this? Second year future value factor. Second year future value factor. You have to understand these numbers conceptually. Press again equal to 1.331. That means in 3 years 1 rupee will become 1.331. Press GT. 3.641. What is the meaning of this 3.641? Future value annuity factor. Nothing but first year 1 rupee, second year 1 rupee, third year 1 rupee. Total will be equal to 3.641 by the end of a third year. By the end of a third year. Clear? Okay. So what is the shortcut for future value annuity factor immediate? Right now we have done the same. Future value annuity factor immediate. So this already written in the notes, okay? Once again, you need not write. I plus 1 into 1 n times and grand total. This time grand total. Why? Straight away equal to n times. Why? Immediate means beginning. For last year annuity also we get interest. And for first year annuity we get interest for n years. Interest for n years. Clear? Vinay, clear? Okay, next. Present value of annuity. Present value of annuity is equal to annuity into present value annuity factor. So if it is regular, Immediate. Present value means always we do discounting. We do discounting. Discounting means divided by. So 1 divided by 1 plus I. Press equal to. If it is regular, press equal to n times GT, grand total. If a question is silent, we assume that annuity as a annuity regular. Next 1 divided by 1 plus I, press equal to GT plus 1. Clear? Okay. So till now, is it clear? Done? Now, so they might ask you to find out what present value of a annuity, or they will ask you to find out what annuity. So present value of annuity will be given in the question. Okay, and rate will also be given in the question. N will also be given in the question. They will ask you to find out what annuity. Okay, or they might ask you to find out what future value of a annuity, future value of a annuity, and they ask you to, or else they might ask you to find out what annuity. Okay, so there can be 4 chances. First one, they might ask you to find out future value or present value of a annuity. So they will give annuity, N and I. Annuity will be given in the question, N will be given in the question, I will be given in the question. For example, in yesterday's class, we have done one question. I think question number 6, not question number 6, question number 7. Annuity is given, N is given, I, R is also given, rate of interest is also given. So they will give annuity, they will give N and rate of interest, and will ask you to find out what the present value or future value of annuity. Or else they will ask you to find out annuity. How do I get annuity? Simple. Future value of annuity divided by future value annuity factor. Yes or no? Likewise, annuity is equal to present value of annuity divided by present value annuity factor. Am I correct? Yes or no? So or else in capital bursting chapter, we are going to find out I, rate of interest. In capital bursting, we call it as a IRR, internal rate of a return. Internal rate of a return. So that we are going to find out in capital budgeting chapter. Nothing but what? So they will give N, they will give present value of a annuity, they will provide annuity. So we have to find out what? Interest. So generally at a CMA inter level or final level, they will not be asking you to find out N. Number of a years, they will not be asking you number of a years. Okay. So in classrooms, we use calculator. Practically, we use Excel, Microsoft Excel to find out these answers. Okay. So, but for examination purpose, we have to use calculator only for shortcuts. Okay. Clearer? Is it clear, Manikanda? So we have completed up to question number 7. 7, right? Okay. Next, write down the notes. So this is very, very important concept. You have to understand the theme of this concept, value of asset. Value of a asset. Value of a asset. So very important concept, value of a asset. Asset value. So for example, building, the building value. So this building value depends upon what? The future economic benefit. If the future economic benefit is equal to 0, then building value is equal to 0. So is there any benefit from this building or not? Yes. We can use this building for next 20 years. Yes or no? So that means this building have a future economic benefit. So there should be economic benefit, monetary benefit, monetary benefit. If there is no future economic benefit, that means that is not a asset. That is not a asset. Am I clear? Okay. So are getting my point? So asset value depends upon what? Future economic benefit. Future economic benefit. For example, car value. So new car value will always be greater than what? Old car value. Why? Because new car will have a greater future economic benefit. Yes or no? So when you compare car and aircraft, aeroplane, which has a more value? Aeroplane will have a more value because aeroplane is giving a more future economic benefit. So value of any asset, your value, my value, bench value, AC value, fan value, business value, value of any asset depends upon what? Future economic benefit. Future economic benefit. So we are going to do human resource valuation also at CMA final level. Nothing but we are going to find out the value of a human. Value of a human. Even the value of a human also depends upon what? Future economic benefit. How much benefit I am going to give to the opposite person. Based on that, the value depends. For example, right now my value will be greater than Deva. Why? What is the reason? Because I'm a qualified CA and CMA. That is the reason. So I'm generating a greater future economic benefit than Deva. Are getting my point? First, suppose, okay, there is a chartered accountant who has a age of a 65 years and Deva. Now, whose value will be greater? Now, Deva value will be greater comparatively. Why? Future economic benefit. 65 years aged chartered accountant. So will not have any future. He will not be able to generate any future economic benefit. So he might have earned benefit during his engage, but that is not relevant. What is relevant actually? Only the future. Only the future. Okay. So that's why to be practical, so when a world person who is having an age of 98 years or 90 years dies in a family, I mean he passes away, so nobody will cry. Why? Generally less number of people will cry. Why? There is no future economic benefit. Already he has seen his life, so that's why nobody will cry. But if a young person who is having an age of 20 years, if something happens to that person, so everybody will get affected. Yes or no? Why? A simple reason. I mean, not about the benefit. He is having a future. He's having a future. Okay. Likewise, asset value will also depends upon what? Future economic benefit. Future economic benefit. For example, this tab has a value. Bottle has a value. Okay. This extension box is having a value. For television, there is a value. But all these values are dependent on future economic benefit. So asset valuation is very important. For example, not just for capital budgeting. So capital budgeting means what? Whether to purchase a plant and machinery or not. whether to purchase a plant and machinery or not. For example, plant and machinery cost 1 crore. We have to decide whether to purchase a plant and machinery for 1 crore or not. Okay. So that is a capital budgeting decision. Likewise, mergers and acquisition. Mergers and acquisition means, for example, Disney Hotstar. Disney Hotstar. It was acquired by Jio. Okay. So Reliance Jio has acquired Hotstar. So before acquiring, so Jio will be finding out the value of a Hotstar. Will find out the value of a Hotstar. Nothing but what? It will estimate the future economic benefit from the Disney Hotstar and will bring that future economic benefit to the present value. Okay. So likewise, so Tata has acquired Air India. So for how much price it has to acquire Air India? Again, a valuation has to be done. Valuation has to be done. How the valuation is done? The most popular method is bringing the future economic benefit to the present value. So one popular method bringing the future economic benefit to the present value. Most popular method. Okay. Bringing the future economic benefit to the present value. Likewise, Byju's has acquired Akash. Byju's has acquired Akash. So how did they acquire Akash? Again, the valuation will be done. So they bring the future economic benefit to the present value. So there are several types of evaluations, but the most popular method is bringing the future economic benefit to the present value. For example, if you have to find out the value of a BCCA, so there might be different perceptions. So if I ask Deva or Esraju to find out the value of a BCCA, they might do a valuation on the basis of net assets method. Net assets method. What is that net assets method? So they will be keep on writing how many benches are there, how many ACs are there, how many fans, speakers, televisions. So they keep on writing the list of assets and they will be writing what? Book value. You know the book value, right? Book value means historical cost minus accumulated depreciation. Okay. For suppose if they value BCCA based on net asset method, that too based on a book value. Book value. Book value means balance sheet value. Balance sheet value. So BCCA value will be around what? 3 to 4 crores. That's it. Only 3 to 4 crores. Why? Why reason? Because benches, ACs, speakers. So is it correct method or not? It is not a correct method to make a valuation. It is a service organization. Service organization. And some other person may step in and they might do a valuation on the basis of net assets, but taking a realizable value. What is the realizable value? Realizable value is different. Realizable value means sale value. Sale value. If I sell the bench as on today, they might purchase for 2000 rupees. So that 2000 rupees is considered as realizable value. Book value means balance sheet value. So is this method correct or not? This method will not be correct. Why? Because this is a service organization and the person who is purchasing BCCA will be paying money for brand value, goodwill, not just for benches or fans. Yes or no? So students will be joining by seeing these benches and fans or what? No. Students will be seeing the results, okay, YouTube subscribers, etc., etc. Yes or no? So that's why how the valuation has to be done. The valuation has to be done by bringing the future benefit to the present value, future economic benefit. So to the purchaser of a BCCA, what is the future economic benefit it is going to give? We should bring the future economic benefit to the present value. I get my point. So the most popular method for valuation is anything. So let it be plant and machinery, AC, okay, vehicle, or a new project, new multiplex theater, or Deva, Vaishnavi, whoever it is, valuation of any asset, bringing the future economic benefit to the present value. You know how to bring the future benefit to the present value. So we have to do compounding or discounting. We have to do discounting. We have to do discounting. Okay, so value of a asset is equal to present value of present value of future economic benefit. Present value of a future economic benefit. Value of asset is equal to present value of a future economic benefit. Brought to present value using required rate of return. Brought to present value using required rate of a return. Am I clear? Brought to present value using required rate of a return. Be careful. Risk increases. I have told you about the risk. Very important point, risk. So risk is involved everywhere. If you are walking, there is a risk. If you're doing a business, there is a risk. Okay. If you're just sitting, there is a risk. Okay. If you're traveling, there is a risk. Risk means what? A possibility of occurrence of loss. Okay. So if risk increases, expectation increases. If risk increases, expectation increases. So that expectation we call here as required rate of a return. Required rate of a return. If risk increases, required rate of a return will also increase. Further, the thumb rule and simple basic common sense, there is a risk involved in CMA course, yes or no? Do you agree or not? There is a risk. Risk means what? There is a possibility of failure. There is a possibility of failure when compared to what? BCom or MBA. BCom or MBA. So there is a risk involved. Now tell me whether your expectations are more than the BCom or MBA student or less than the MBA student. Your expectations are greater than MBA student. Why you are expecting more? Because risk is more. If risk increases, required rate of a return will also increase. Simple logic. Okay. I have left NTPC and that time my package was 14 lakhs. So thereafter I have started my teaching. That means my expectations will be greater than 14 or less than 14? Greater than 14. Why? I have left PSU, public sector undertaking, and have started my teaching. That means I'm taking more risk. When I take more risk, I expect a more return. So that is basic fundamental. You have to remember till final. If risk increases, expectation will also increase. Required rate of a return will also increase. So value of asset is equal to present value of a future economic benefit. And how do we bring the future economic benefit to the present value? By using the required rate of a return. Okay. In time value, we called it as what? Interest. So the same interest we are calling it here as required rate of return. Even interest is also a required rate of return. I have told you. If you are giving a loan to the roadside vendor, you expect a high rate of interest. High rate of a interest. Yes or no? Because high risk is involved. Okay. I will tell you 5 examples. These 5 examples are very important. 5 examples. Okay. First example, single cash inflow. First example. Single cash inflow. Single cash inflow means the asset is going to give a benefit only 1 year. Only 1 year. Only one cash flow in the future. Okay. Clear? So let us assume Mahesh is an asset. Mahesh is an asset. Okay. Mahesh is a asset and Pooja Hegde considering to buy Mahesh. At what price Pooja Hegde has to buy Mahesh? So we are finding out the value from the perception of, what? Pooja Hegde. Okay. Mahesh, year 20, cash flow 10 crores. Kavya, you're giving warning, huh? Okay. Year 20, what is the cash flow? 10 crores. So what is the meaning of this example? If a Pooja Hegde buy an asset called Mahesh, she is going to get a benefit of 10 crores at the end of 20 years. She is not going to get benefit now. She is going to get benefit after 20 years. Okay. And her expectation 20%. Her required rate of return is 20%. Her required rate of return is 20%. What is the reason behind the 20%? Maybe. Okay, Pooja Hegde, she is having another option. She can give a loan to Babjan at the rate of 20%. So instead of giving a loan to Babjan, she is purchasing what? Mahesh. So that's why her required rate of return is what? 20%. Opportunity cost. Opportunity cost. She is losing a benefit. She is losing a benefit in choosing an alternative course of action. So now tell me, what is so how do we find out the present value? Discounting. So 1 divided by 1.2. 1 divided by 1.2. Press equal to how many times? 1 divided by 1.2 press equal to how many times? 20 times. 1 divided by 1.2 press equal to 20 times. 0.0 0.026. This we call as discounted cash flow. Nothing but present value of a future cash flow. Present value of a future cash flow can also be called as discounted cash flow. Am I clear? So now tell me, what is the discounted cash flow? What is the meaning of this 0.026? Present value of a 1 rupee to be received after 20 years. But after 20 years, Pooja Hegde, she is going to receive what? 10 CR. So what is the value of the 10 CR as on today? 10 crores into 0.026. Some students may not be knowing how many zeros 1 crore will have. Be careful, okay? So what is the answer? 26 lakh. So this is the value from the perception of what? Pooja Hegde. But Mahesh mother, she is demanding 50 lakhs. Mahesh mother, she is demanding what? 50 lakhs. Now tell me whether Pooja Hegde is going to buy Mahesh or not. Pooja Hegde will buy Mahesh or not. Mahesh mother, she is demanding what? 50 lakhs. But in Pooja Hegde's perception, what is the value? 26 lakh 8,405. So she is not going to buy. She is not going to buy. Simply she will reject. Yes or no? And value depends on what? Perception. Value depends on perception. Next, year cash flow PVF at the rate of 10%, discounted cash flow. Now Rashmika wanted to do a valuation, Mahesh value. Rashmika wanted to find out the value of a Mahesh, and Rashmika required rate of return is 10%. She is expecting 10% only. Okay, so year 20, how many crores? 10 crores. So now 1 divided by 1.1 press equal to how many times? 1 divided by 1.1 press equal to how many times? 20 times 0.1486. That means 1 crore 48 lakh 60,000. So now Rashmika will buy Mahesh or not? What is the value in the perception of Rashmika? 1 crore 48 lakh 60,000. Now tell me whether Rashmika will buy this asset or not. Yes, because Mahesh mother is just demanding only 50 lakhs. Rashmika will feel like the asset is very cheap. Yes or no? Pooja Hegde will be feeling like the asset is very expensive. Okay. Pooja Hegde rejected, but Rashmika accepted. So that happens in life also. Okay. If somebody rejects, somebody will accept you. You need not worry. Okay. So because value depends on what? Perception. Value depends on perception. So clear? Done. This is a single cash flow. This is a single cash flow. So one thing you have to observe here. If risk increases, required return increases, value decreases. If you observe the two examples, first case the value is less. Why the value is less? Because her expectation is high. She was expecting 20%. She was expecting 20%. So the asset is same, Mahesh is same, but the opposite person's expectations are not the same. Clear? Done, Sunita? So this is single cash inflow. Okay. So if risk increases, what happens to the value of asset? Value of asset decreases. Value of a asset decreases. Am I clear? Okay. Next, let us go for second example. So practically, for this we can give an example of zero coupon bond. Yes or no? In direct taxes, you might have heard about this zero coupon bond. Zero coupon means zero interest. The bond which is redeemable at face value on the maturity. Similar or not? Single cash flow. Investor will get only single cash flow. The only benefit investor is going to get is face value. So for example, year 5, cash flow 10,000. Instead of year 5, I have taken 20. Instead of 10,000, I have taken 10 CR. That's it. Okay. So first category, we can take zero coupon bond or else red sandal. So red sandal is different from mango tree, yes or no? Mango tree will be giving benefit every year. But what about red sandal? Red sandal will give single cash inflow. Teakwood teak wood, red sandal, all these will give benefit for one single cash inflow. Clear? Next, the second one. Multiple even means equal. Multiple even cash inflows. Definite period. Multiple even cash inflow, definite period. Definite period means limited period. Limited period. Multiple even cash inflows. Multiple even cash inflows. Multiple even cash inflows. Okay. Even means equal. Even means equal. So let us find out the value of Hari. Year cash flow. Year 1 hyphen 5. Year 1 hyphen 5. Okay. Hari is going to give a benefit for how many years? 5 years. And the cash flow 10 lakhs. Every year the benefit he is going to give is 10 lakhs. Every year 10 lakhs. Every year 10 lakhs. That means it is an annuity or not? It is an annuity. It is an annuity. So PV AF. Let us assume 20% is the required rate of a return. If it is an annuity, we can directly multiply with what? Annuity factor. We should bring the future benefit to the present value. So that's a we should multiply with present value annuity factor. How do we get present value annuity factor? 1 divided by 1.2 press equal to 5 times. Press equal to 5 times grand total. If a question is silent, it is annuity regular. So 1 divided by 1.2 press equal to 5 times grand total. 2.9906 discounted cash flow 29 lakh 90,600 is the value. 29 lakh 90,600 is the value from the perception of Pooja Hegde. So Pooja Hegde expectation. What is her expectation? 20%. Her expectation is 20%. Okay. But Hari's mother, she is demanding 50 lakhs. Pooja Hegde, she is going to buy or not? No. So let us find out the value from the perception of what? Rashmika. Year 1 to 5. Cash flow 10 lakhs. PVAF at the rate of 10%. Manikanta, notes రాస్తున్నారా? PVAF at the rate of 10%. So 3.79 discounted cash flow 0. So 371 3.791. Clear? So that means 37 lakh 91,000. So this is the value of a Hari from the perception of what? Rashmika. But Hari's mother is demanding 50 lakhs. Rashmika is going to buy or not? No. Rejected by both. Why? Because actual market price is 50 lakhs. I mean, actual market price is 50 lakhs. But Rashmika want it for 37 lakh 91,000. So she is not going to buy. Clear? So in this category, practically we will be getting plant and machinery. Plant and machinery. Clear? Plant and machinery. Next, third, multiple uneven cash inflow. Definite period. Multiple uneven cash inflow. Uneven means cash flows are not equal. Let us find out the value of Aravind. So this you can find out. I mean, your value, you all people will come under this category. Because now you might join a job, yes or no? Every year you will receive a same amount of salary or different amounts of salary. Different amounts because your salary will be increasing year by year. Yes or no? So how to find out the value of yours? You have to write in the year column 1, 2, 3, 4, 5 like this. I think you might work for how many years after qualification? 30 to 35 years. Yes or no? 30 to 35. You have to write year 1, 2, 3 up to 30. You have to write your expected salary and bring it to the present value. You will get the value. Okay. So after going to hostel, find out your value. Okay. And if your father is hitting you, then you can say, my value is 2 crores. He cannot hit me. Okay. So year 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Cash flow. Arvind. So 10 lakhs, 20 lakhs, 30 lakhs, 10 lakhs, 20 lakhs. So these are the benefits we are going to get from Aravind. I mean, Pooja Hegde is going to get the benefit from Aravind. Now, can I take present value annuity factor? No, I cannot take present value annuity factor. Why? Because this is not an annuity. This is not an annuity. So I have to multiply with present value factor separately for each year. So 1 divided by 1.2. 1 divided by 1.2, 0.833. So that is the first year factor. Present value of a 1 rupee to be received after 1 year. Next 0. Press equal to again 0.694, 0.578, 0.482, 0.401. So discounted cash flow 8 lakh 33,000. 8 lakh 33,000. And next 6 lakh 94. 90 వేసిన ఆన్సర్ రాదు. 20 lakhs into 0.694. 13 lakh 17 lakh 34 thousand. 4,82,000. Tell me the total. 52 lakh. You can use GT, grand total. You need not separately take the numbers again. In calculator, first you should take 10 lakhs into 0.833. Press equal to. And then again 20 lakhs into 0.694. Press equal to. And then 30 lakhs into 0.578. Thereafter you can press GT. Grand total. You will take it total again straight away. So, what is the value of Aravind from the perception of Pooja Hegde? 52 lakhs 39,000. 39,000. So, if Aravind mother is demanding 50, then what? She will buy. So, from Rashmika perception, what happens to the value? Value will increase because her expectation is only 10%. Obviously, the value will increase. So, that need not be done, okay? But you know the concept, right? From Rashmika perception, the value will increase. Why the value will increase? Because her expectation is low. When expectation is low, the value increases. Am I clear? Done? Now, let us find out the value of S. Raju. Okay, S. Raju is a follower of Ramdev Baba. He uses Patanjali products and his life is indefinite. His life is indefinite. Fourth category, even cash inflow, infinite years. Third example, in this category again plant and machinery. Fourth category, the asset is going to give a benefit. How many years? Indefinite period, 1-2 years kaadu. Benefit is going to, we are going to get benefit of how many years? Indefinite period. So generally in this category, business will come under this category, or perpetuity bond. Perpetuity means in Companies Act you might have heard about this word, continuous. Perpetuity means continuous, forever. Okay, business perpetuity bond, equity shares. Equity shares will come under this category. Equity shares will come under this category. Even cash inflows, infinite years. Of course, A.S. Raju will also come under this category because his life is indefinite period. Indefinite period. Even means what? Equal. Even means what? Equal. Year cash flow. One hyphen infinity. One hyphen infinity. And cash flow 10 lakhs. So S. Raju is going to give a benefit of 10 lakhs to Pooja Hegde for how many years? Indefinite period. So this example is similar to what second one. In second case, what is the life? 5 years. But now the benefit is how many years? Benefit is infinite years. Benefit is infinite years. If it is 5 years, okay, fine. 1 divided by 1.2 press equal to 5 times grand total. Yes or no? For suppose if life is 10 years, then what? 1 divided by 1.2 press equal to 10 times. If it is 20 years, 1 divided by 1.2 press equal to 20 times. Yes or no? For suppose if it is 100 years, equal to 100 times grand total. Yes or no? But here the life is what? Indefinite period. Indefinite period. So clear. So how to find out the value? How to find out the value? Here it is simple. Value is equal to benefit divided by required return. Benefit divided by required return. What is the benefit? 10 lakhs. 10 lakhs. And what is the required rate of return? 20%. 0.2. So 10 lakhs divided by 0.2. 50 lakhs is the value. 50 lakhs is the value of a Ace Raju from the perception of what? Pooja Hegde. Now, if you observe the second and fourth example, see the second example. Second example, Hari value. What is the Hari value? 20. Hari is giving a benefit only for how many years? You should get one doubt. What is the doubt? Hari is just giving a benefit for how many years? 5 years. But here Esraj is giving a benefit for how many years? Infinite years. But still the value is only 50 lakhs. Okay, so you might be thinking that the value must be even more high, greater. Because in second example, you are getting a benefit just for how many years? 5 years. And what is the value? 29 lakhs. So if we get benefit for 20 years, then the value should exceed what? 50 lakhs. Yes or no? But you are saying that the asset is going to give a benefit for indefinite period, but the value is still 50 lakhs. How it can be? Let us try, for example. Let us assume we are getting a benefit of 10 lakhs for 20 years. Let us find out the value. So how to find out the value? 1 divided by 1.2 press equal to 20 times. Grand total. 1 divided by 1.2 press equal to 20 times grand total into 10 lakhs. 48 lakhs. Is it exceeding 50 lakhs or not? No. So if the asset is giving a benefit for 20 years, the value of that asset is 48 lakhs. Let us try 100. 1 divided by 1.2 press equal to 100 times grand total. 1 divided by 1.2 press equal to 100 times and then grand total. So what is the value? Exact amount. Tell me the exact amount. 49 lakh 99,000 Even if you take 200 years also, you will not, the value will not be exceeding what? 50. So 50 is the maximum value. మీకు అర్థమవుతుందా? నేను అడిగేది ఏంటంటే బెనిఫిట్ 5 years వస్తేనే 29 lakhs అన్నప్పుడు పోనీ ఒక 20 yearsకి వాల్యూ 50 lakhs ఎక్సీడ్ అయిపోవాలి. ఇన్ఫినైట్ ఇయర్స్ బెనిఫిట్ అన్నప్పుడు 50 lakhs అయినా వాల్యూ ఇంకా ఎక్కువ ఉండాలి కదా అనిపిస్తుంది మీకు. బట్ మీరు అర్థం చేసుకోవాల్సింది ఏంటంటే 1/1.2 ఇఫ్ యూ ప్రెస్ ఈక్వల్ టు 100 times యూ విల్ గెట్ అ నెగ్లిజిబుల్ నెంబర్. నెగ్లిజిబుల్ నెంబర్ అంటే దాని అర్థం ఏంటి? ఓకే, ఒకసారి చేయండి. 1/1.2 1/1.2 ప్రెస్ ఈక్వల్ టు 100 times. Do not press grand total. Do not press grand total. Do not press grand total. Zero point double zero double zero double zero something. Yes or no? Multiply with 100 CR, 100 crores. You know how many zeros will be there for 100 crores? 100 crores. Multiply with 100 crores. Multiply with 100 crores. How much you got? 12 point. What is the meaning of this? If you have a 12 rupees in your pocket as on today, that means that is equal to 100 crores after 100 years. If you have a 12 rupees as on today in your pocket, that is equal to what? 100 crores after 100 years. Nothing but after 100 years, if you have a 100 crores, that is equivalent to what? 12 rupees as on today. Present 1 rupee will have a more value than a future 1 rupee. For example, for 12 rupees, you are getting 2 Mirpka Bhaji. 2 or 1? 1 as on today. Okay. But after 100 years, for the same bhaji, you have to spend 100 CR. Okay, so this is the time value of a money. క్లియరా? ఇప్పుడు అలానే అనిపిస్తుంది మనకి. ఇప్పుడు 100 crores is a big amount. Okay, 1 lakh is very small amount. Yes or no? But if you go back to 100 years, 1925. Okay, if in 1925, if you have a 12 rupees, with the 12 rupees you might have bought what? 10 acres in bypass road. Yes or no? In 1925. In 1925, for suppose 12 rupees ఉంటే ఏం చేసేవాడివి? ఇక్కడ 100 acres of land. You might have got what? 100 acres of a land. ఓకే, సో ఫ్యూచర్ వెళ్ళే కొద్దీ 1 రూపీ వాల్యూ ఏమవుద్ది? తగ్గిపోద్ది. సో దట్ ఈస్ కామన్ సెన్స్. ఓకే, క్లియర్? ఈజ్ ఇట్ క్లియర్? సో దట్స్ వై ఇఫ్ Esraj is giving a benefit of 10 lakhs for indefinite period, what is his value? 50 lakhs. In Rashmika perception, 10 lakhs divided by 0.1, 1 CR. Clear? See, Facet is giving a benefit for indefinite period. So simple, how to find out the value? Benefit divided by required rate of a return. Benefit divided by required rate of return. Am I clear? Done. అదవుతుందా? Okay, if you are saving 12 rupees as on today, your great grandchildren will have a 100 crores. Ishwar Nag, you are saying 60 rupees, huh? That means that person will have what? 500 crores. Next, fifth example. Fifth example. అదో అదనా ఓకే 100 years బ్యాక్ మీ ముత్తాత ఇంకెవరికైనా ఇచ్చుంటే ఒక 12 రూపీస్ దాని వాల్యూ ఎంత మీ రోజు 100 crores ఎంక్వైరీ చేసుకోండి. సో ఫిఫ్త్ ఎగ్జాంపుల్, cash inflows infinite years with growth. Cash inflows infinite years with growth. Manikanda, we are going to find out the value of Manikanda. So Manikanda life, Manikanda supreme asking. Okay, life how many years? Infinite years, and there is a growth also. There is growth. So then how? Here cash flow and growth rate. Here 1-infinity, cash flow 10 lakhs, and growth rate 8%. What is this growth rate? Every year cash flows are increasing by 8%. Then how to find out the value? Simple, value is equal to benefit divided by required return minus growth rate. Pooja Hegde expectation is 20%, but it is getting offset by 8% growth rate. We should take net. That means 10 lakhs divided by 0.2 minus 0.08. 83 lakh, 33,333. Rashmika valuation 10 lakhs divided by 0.1 minus 0.08. 5 crores. 5 crores. Rashmika perception, what is the value of Manikanta? 5 CR. But Manikanda's mother demanding only 50 lakhs. Okay. Rashmika will buy Manikanda or not? Yes. In this category, again the same fourth, like business, perpetuity bond will not come in this category. Only business and equity shares. Business and what? Equity shares. So generally we all come under which category? Apply your common sense. First category, yeah? Single cash flow, na? No. We come under which category? 5. We come under which category? Third category. Multiple uneven cash inflow. If you want to find out your value, right, take columns. What are the columns here? Cash flow, present value, factor at the rate of whatever the rate you feel you can take. And next what? Discounted cash flow. So find out your value. Okay. After going to hostel, you can find out your value. Clear? Done? Yes, Raju? So these 5 examples are very important. These 5 examples are very, very important. Okay. In final level, SFM and business valuation, total 150 marks, completely dependent on these 5 examples. And also financial reporting, CFR. in CFR also. So two chapters completely dependent on time value of money. Okay, very important. Clear? Now let us come to the questions. See the question number 8. Question number 8. An investor, you might find different serial numbers because I have categorized questions into main and additional. Okay, in question bank you might find a different order because I have categorized the questions into main and additional. Even if you focus on main, that would be fine enough. Okay, so question number 8. An investor expects a perpetual sum. Perpetual means continuous, indefinite sum of rupees 5,000 annually from his investment. What is the present value of a perpetuity if interest rate is 10%? Simple. So this comes under which category? Fourth category. So 5,000 divided by 10%, 50,000. June 2025, 2 marks MCQ was asked the same question, 2 marks. So simple, perpetuity divided by, benefit divided by required return. 5,000 divided by 10%. So 50,000 is the answer. Next question number 9. A student takes a loan of rupees 5 lakhs from SBI. So 50,000 from SBI has taken a loan. Student has taken a loan. The rate of interest being charged by SBI. The rate of interest being charged by SBI 10% per annum. What would be the amount of equal annual installments if he wishes to pay back? If he wishes to pay back it back in 5 installments. 5 installments. Okay. The next sentence is irrelevant. So what is the amount of equal annual installment if he wishes to pay back in 5 installments? So first you have to understand the question. Student has taken a loan. So you know the procedure, right? So first we take loan. So thereafter what? We pay installments. We pay installment. Equal installments or unequal installments? Equal installments. Every month, EMI, equated monthly installment. But suppose if your father has bought a bike, he will be paying what? Equated monthly installment. So that is an annuity or not an annuity? Annuity, because same amount at same intervals. Likewise, in this question, student has taken a loan of rupees 50,000 and he wanted to pay back this in 5 equal annual installments. Annual. That means every year he is going to pay installment. So, what are they asking? They're asking you to find out the equal annual installment. Nothing but they're asking you to find out what? Annuity. They're asking you to find out what? Annuity. Rate of interest is given. What is the rate of interest? 10%. N is also given. N 5 because he wanted to pay back in 5 installments. So N is also given. So what is this 50,000? What is this 50,000? You have to understand the question carefully. Question number 9. So write down the answer. The rate of interest. What is the rate of interest? 10%. N is equal to 5. What are they asking you to find out? They are asking you to find out annuity. So what is this 50,000? Loan is taken as on today or in the future? We take loan today and we pay the installments in the future. So loan is nothing but present value, right? What is this present value? Present value of a future installments. Present value of a future installments. Nothing but this is present value of annuity. Present value of annuity is given in the question. Loan is nothing but present value of a annuity. You have to understand this, because once again this point will get repeated in capital budgeting. Loan amount is nothing but what? Present value of a annuity. Present value of a installments. Present value of a installments. Okay. So now present value of annuity 50,000 is equal to annuity into what? Present value annuity factor. Annuity is equal to 50,000 divided by present value annuity factor. How do we get present value annuity factor? 1 divided by 1.1, 1 divided by 1.1 press equal to 5 times grand total. The same factor is given in the question, 3.7908. So the answer is, so the answer is 13,190. So what is the installment to be paid? 13,190 rupees. Clear? Done? Clear? Manikanda? So let us take another example. For suppose if you want to buy a car, let us take a car loan. Car loan 20 lakhs. Car loan what? 20 lakhs. Rate of interest I 8% per annum. 8% per annum. Okay. So now n is equal to 5 years. N is equal to 5 years. So be careful. Find out equated monthly installment. Equated monthly installment, EMI. You have to learn this, because you may purchase a house or a car on a loan. You have to know how to find out equated monthly installment. Equated monthly installment. Simple. Car loan. Car loan is what? Present value of annuity is equal to annuity into what? Present value annuity factor. Equated monthly installment is nothing but annuity only. Same amount at same intervals. Same amount at same intervals. So annuity is equal to present value of annuity. What is the present value of annuity? 20 lakhs. Divided by what? Present value annuity factor. So be careful while finding out present value annuity factor. You might take 1 divided by 1.08, press equal to 5 times and grand total. So that is not correct. They are not asking you to find out the equated annual installment. They are asking you to find out equated monthly installment. So equated monthly installment means we should take month interest rate. Month interest rate. What is the month interest rate? 0.08 divided by 12. 0.08 divided by 12. 0.0. So 1 divided by 1.006667. That's what rounding off has to be done. 1 divided by 1.00667. Press equal to how many times? 60 times, not 5 times. Why 60 times? Because we have to find out equated monthly installment. So that's why press equal to 60 times. 5 years means 5 into 12, 60 months. So 1 divided by 1.00667, press equal to 60 times. And then what? GT, grand total. 49.313. So the answer is 20 lakhs divided by 49.313. 40 lakhs. 40,000. If you want to buy 20 lakhs worth car, you have to pay an EMI of 40,557. So be careful before purchasing a car. Because equated monthly installment 40,557. House could kontara. But generally housing loan tenure will be 30 years. 30 years means press equal to how many times? 30 into 12. 360 times. Generally housing loan tenure will be 30 years. And house cost will be around 80 lakhs in Hyderabad, 2 BHK. At least 80. Okay. If you want to find out EMI, 1 divided by 1.00667, press equal to how many times? 360 times. And then grand total. And divide 80 lakhs with that present value annuity factor. Then you will get equated monthly installment. Car EMI, house EMI. Add the both and compare with your salary. Okay. So done. Next, see the question number 10. Question number 10. Mr. X is depositing 20,000 in a recurring bank. Recurring means repeatedly. Mr. X is depositing 20,000 in a recurring bank deposit. Recurring bank deposit means the deposit is repeated, which pays 9% per annum compound interest. How much amount Mr. A will get at the end of the 5th year? So what is given and what they are asking you? Mr. X is depositing 20,000 in a recurring bank deposit. Recurring bank deposit. Recurring means every year he is depositing 20,000. What is the rate of interest? 9%. How much amount will he get at the end of 5th year? So what is given? Annuity is given. Annuity is given. N is given. What is N? 5. Rate of interest is given. They are asking you to find out future value of a annuity. How much amount Mr. A will get at the end of a 5th year? How do I get future value of annuity? Annuity into future value annuity factor. How do we get future value annuity factor? If a question is silent, regular, So in calculator take 0.09, 0.09 plus 1 into 1 press equal to how many times? 4 times. Grand total plus 1 into 20,000. 1,19,694. Clear? So you have to understand the question. So deposit 20,000 every year. Rate of interest 9%. They are asking the value at the end of a fifth year. That means they are asking you to find out future value of a annuity. Clear? See the 11th question, last question. Apex Limited has an obligation to redeem. Apex Limited has an obligation to redeem. Redeem means repay. Rupees 50 crore bond 6 years hence. So Apex Limited has an obligation. Obligation means duty. Obligation means duty. It is liable to repay 50 CR after 6 years. After 6 years. How much should the company deposit annually? Be careful, understand the question. How much should the company deposit annually in a sinking fund account wherein it earn 12% interest to accumulate 50 crores in a 6 years time? So tell me what is given and what is they are asking. So they are asking you to find out how much should the company deposit annually. That means they are asking you to find out annuity. They are asking annuity, same amount at same intervals. How much should the company deposit annually? Okay, so they are asking annuity. What is this 50 crores? After 6 years, you are liable to pay 50 crores. 50 crores. Future value of a annuity. Nothing but every year we have to deposit certain sum of money that should be accumulated to 50 crores. So in this question, future value of annuity is given and they are asking you to find out what annuity, not the present value. They are asking you to find out what annuity. So question number 11. They are asking you to find out the annuity. What is given? After how many years? 6 years. I want 50 crores. So general questions elage untai. So at once I cannot bring 50 crores. So I have to deposit every year certain sum of money. So they are asking you to find out what is that certain sum of money. They are asking annuity. So what is given? Future value of annuity. What is the future value of annuity? 50 crores. Rate of interest. Rate of interest 12%. Next what? N is equal to 6 years. Future value of annuity is equal to annuity into future value annuity factor. That means annuity is equal to 50 crores divided by future value annuity factor. How do we get future value annuity factor? Simple. I 0.12 plus 1 into 1 press equal to how many times? 6 times or 5 times? If a question is silent, it is annuity regular. Annuity regular means press equal to 5 times. 0.12 plus 1 into 1 press equal to 5 times grand total plus 1. 8.115. So the answer is 50 crores divided by 8.115. 6 crore, 6 crore, 16 lakhs, 14,295. 6 crores, 16 lakh, 14,295. So I think here 5 is missing. 6 crore 16 lakh 14,000. Yes or no? 11th question. So 5 is missing. Or else instead of 50 crores, you should take only 5 crores. Done? So in additional questions, we have completed what? Question number 1. 4, 5, up to 6. 7 we have to do. XYZ Limited has borrowed 5 lakhs to be repaid in 5 equal annual installments. The rate of interest is 16%. Compute amount of each payment. The same question already we have done. What is the loan amount? 5 lakhs. Rate of interest 16%. Compute the amount of each payment. What are they asking? Annuity. Loan amount is nothing but present value of a annuity. Simple. 1 divided by 1.16 press equal to 1 divided by 1.16 press equal to 5 times grand total 3.2743. So 5 lakhs divided by 3.2743. 1 lakh 1,52,704. Eighth question. A person is required to pay annual payment of rupees 8,000 in his deposit account that pay 10% interest per year. Find out the future value of annuity at the end of 5 years. So simple. In calculator, first you take 0.1 plus 1 into 1 press equal to how many times? 4 times. Grand total plus 1 into 8,000. 48,841. Clear? Done? So ninth question. Again, ninth question simple. A company wants to repay a loan of rupees 5 lakhs 10 years from today. Rate of interest. What amount should it invest each year for 10 years if the fund can earn 8% per annum? The first investment will be made at the beginning of this. Beginning of this year means immediate. Be careful. A company wants to repay a loan of rupees 5 lakhs 10 years from today. So this is similar to that 50 crore question. So we have to repay the loan after 10 years. After 10 years. What is the amount of loan? 5 lakhs. So the question is, what amount should it invest each year? What amount should it invest each year? So we have to find out annuity. What is that 5 lakhs? 5 lakhs is future value of annuity. Future value of annuity. After 10 years, we have to pay 5 lakhs. So simple. First, we have to find out future value, annuity factor. So 0.08 plus 1 into 1 plus equal to how many times? 10 times. Why? Because it is annuity immediate. 0.08 plus 1 into 1 plus equal to 10 times. Grand total 15 point. 0.08 plus 1 into 1 plus equal to 10 times. $15.15. 15.645. So the answer is 5 lakhs divided by 15.645. 31,960. 960. 31,960 is the answer. But in question, they might have considered it as a annuity regular instead of a immediate. But they have clearly mentioned it is beginning. Beginning means what? Immediate. Let us try regular also. Regular means 0.08. 0.08 plus 1. 0.08 plus 1 into 1 plus equal to how many times? 9 times. GT plus 1. 14.487. So if they are giving a factor, apply the factor directly. Okay, be careful. Okay, but the correct answer is what? 31,960, because they have clearly mentioned it is beginning of the year. Done. The next question, again the same. The company has issued a debenture of rupees 50 lakhs to be repaid after 7 years. How much should the company invest in a sinking fund, earning 12% in order to able to repay debentures? Again same. What is given? Future value of annuity is given. So you have to find out future value annuity factor. 0.12 plus 1 into 1 plus equal to 6 times. GT plus 1. 10.089. So 50 lakhs divided by 10.089. 4,95,589. So clear? So with this we have completed time value of money. It's a very important topic. So today go through the examples again. Okay, in the next session we are going to start cost of a capital chapter. From cost of a capital you will get compulsory one descriptive question, 7 marks, and one MCQ. At least one MCQ. Okay, clear? So next topic, cost of a capital. Cost of a capital. So what is the weightage? Compulsory 7 marks. Descriptive 4B. 4B. So if you want to answer 4B, I mean fourth question, 4B cost of a capital, and 4A comparative and common size financial statements and trend analysis. If you prepare 3 questions, that is more than enough for comparative common size financial statements and trend analysis. And for cost of a capital also, after completion of chapter, we pick 3 questions. And if you practice those 3 questions, that is more than enough. That means 3 plus 3, 6 questions. If you practice 6 questions, you can answer question number 4, 4A and 4B. So 14 marks. 14 marks. Okay, clear? So what is the weightage of this chapter? You will get 1 MCQ. So there is a chance that 0 MCQ or 2 MCQ. Cost of a capital. Cost of a capital. Okay. So compulsory you will get 1 descriptive question, and this topic comes under A category. A category. Cost of a capital. And this topic comes under what? Which aspect of procurement or effective utilization of fund? Procurement of fund. The financial management 2 aspects are procurement of fund and effective utilization of fund. Effective utilization of fund. Okay. So cost of a capital. First write down the meaning. Cost of a capital. Cost of a capital. It is denoted with KO. KO. KO means overall cost of a capital. Overall cost of a capital. Cost of a capital or weighted average cost of a capital or KO means cost of a capital or weighted average cost of a capital or KO. Up to CMA final, so they might give cost of a capital as opportunity cost of a capital. Sometimes they will mention it as a opportunity cost of a capital. Capitalization rate. Capitalization rate. Or sometimes they will mention it as a required rate of a return. Required rate of a return. Or sometimes they will mention it as a discount rate. Discount rate. So we have seen examples for valuation of asset, right? How do we get value of asset? Present value of a future economic benefit. How do we find out present value? Using required rate of a return. Yes or no? So that's why the required rate of a return is also called as discount rate. Discount rate, because the rate is used to bring the future cash inflows to the present value. That's what rate is used for discounting. Discounting means dividing. Discounting means what? Dividing. So cost of a capital or weighted average cost of a capital or KO means minimum return required, minimum return required to be earned by company or a firm. Here we call business as a company or a firm. Minimum return required to be earned by a company. Minimum return required to be earned by a company to meet the expectations, to meet the expectations of investors to meet the expectation of the investors. So who can be an investor to meet the investors? That is equity shareholders, debt holders, debt holders, nothing but debenture holders, people who are giving a debt to the company, debt holders, preference shareholders, etc. So understand this sentence carefully. So cost of a capital or weighted average cost of a capital or overall cost of a capital means minimum return required to be earned by the company to meet the expectations of investors. So who can be an investor? Equity shareholder, debt holder, preference holders, etc. So generally these three: equity shareholder, debt holder, or preference shareholders. Preference shareholders. Am I clear? So minimum return required to be earned. So cost of a capital is always denoted as a percentage. As a percentage. It is not an absolute amount. It is not an amount, it is a percentage. 20%, 15%, 10% cost of a capital. So why this chapter is required? So we select a capital structure which is having a lower cost of a capital. We have already discussed while procuring fund we need to consider four factors. What are the four factors? Risk, cost, control, flexibility. Cost should be less or high. Less. Here cost means expectation. Expectation should be low. So we should select a capital structure or a capital mix where a cost of a capital is low. So let us say for example we got a cost of a capital of 10%. 10% is the cost of a capital. What is the meaning of this 10%? Minimum return, minimum rate of a return required to be earned by the company to meet the expectation of the investors. So to meet the expectation of investors, that is boys and girls, to meet the expectation of the investors, company has to earn minimum 10%. If company is able to earn 10%, that is enough to meet the expectation of our investors. This 10% we use in capital bursting again. Capital bursting, nothing but while utilizing the funds. While we utilize the funds, we use this rate. For example, I want to buy a plant and machinery. Let us say, for example, plant and machinery. So now I will calculate the return which I am going to get from the plant and machinery. For suppose that plant and machinery is giving 20% return. If I invest money in plant and machinery, I can generate a revenue of 20%. Company can generate a revenue of 20%. So whether a company should buy that plant and machinery or not? Yes, company should buy that plant and machinery. Why? Because the investment is giving 20% return, but whereas our cost of a capital is 10%. What is the minimum return required to be earned by the company? 10%. But whereas the plant and machinery is giving 20%. So we accept the project, we accept the investment decision. So we use this discount rate, we use this cost of a capital again in capital budgeting chapter. So cost of a capital means minimum return required to be earned by the company to meet the expectation of our investors. Investors can be equity shareholders, debt holders, preference shareholders. Preference shareholders. So clear? Okay. So before moving on to the cost of a capital, concept. First, write down the income statement. You know the income statement, right? What is the income statement? Sales minus variable cost. Okay. So take heading income statement. Income statement. Particulars and amount. So income statement first, what is the revenue? Sales. Sales minus what? Variable cost. Contribution minus what? Fixed cost. You write complete words, variable cost, and you write fixed cost. You cannot write VC and FC. Minus fixed cost. Sales minus variable cost contribution. So why it is called as contribution? Because it is contributing for recovery of a fixed cost and profit. So that's why it is called as a contribution. Minus fixed cost. Contribution minus fixed cost what? Profit. So that is in cost accounting. That is in cost accounting. Now we call this as a EBIT. EBIT means earnings before interest and tax. Earnings before interest and tax. Earnings before interest and tax. EBIT. Earnings before interest and tax. So these are earnings, no doubt. Sales minus variable cost, contribution minus fixed cost is profit. But this is the profit before payment of interest and tax. Interest is not yet paid. Okay. Interest is also a fixed cost. But here, this is the fixed cost other than what? Interest. Contribution minus fixed cost means we are reducing the fixed cost other than what? Interest. Okay. EBIT, earnings before interest and tax. Earnings before interest and tax, EBIT. Next what? EBIT is also called as profit before payment of interest and tax. So first we should pay tax or interest. So direct taxes, I think you have completed income tax. Interest is an allowable expenditure. Interest is an allowable expenditure. Allowable expenditure. Yes or no? Interest is an allowable expenditure. So allowable means what? Interest is allowed as an expenditure. That means that interest expense will reduce the taxable income. So interest has to be reduced before payment of tax. And moreover, the important point, interest is a charge to P&L. Charge to P&L. Dividend is an appropriation to P&L. So dividend is paid after payment of tax. Interest is paid before payment of tax. So that's a minus. Minus what? Interest. Then it is called as earnings before tax or profit before tax. Profit before tax. Okay. Now what? Minus tax. Then you will get earnings after tax is also called as profit after tax. Earnings after tax or a profit after tax. Are you able to understand the logic? After paying interest, then tax is paid. So earnings after tax. From this, first preference has to be given to the preference shareholders. So why it is called as preference share capital? Because preference share capital. Why it is called as preference share capital? Because the shareholders will be given preference in payment of dividend, and at the time of liquidation, at the time of winding up, at the time of closing the business, preference will be given in the repayment of a capital. That means before paying anything to the equity shareholders, these preference shareholders will be given preference, priority. Priority will be given. So that's why they are called as what? Preference shareholders. Preference shareholders. So first minus what? Preference dividend. Preference dividend. Then you will get earnings available to equity shareholders. In FM, we call it as earnings available to equity shareholders. In corporate accounting, you might call it as a profit or a loss attributable to equity shareholders. Okay. Earnings available to equity shareholders. You write completely. Ishwar Naik. Earnings available to equity shareholders. Earnings available to equity shareholders. Clear? After payment of variable cost, fixed cost, interest, tax, preference dividend, the amount left out is earnings available to equity shareholders. Now, what about these earnings? These earnings can be distributed among the equity shareholders as a equity dividend or can be retained. So let us say, for example, we got a earnings available to equity shareholders of 10 crores. 10 crores is the earnings available to equity shareholders. What we can do is, instead of paying the dividend, we can retain the 10 crores. Retain means we can keep 10 crores with the company itself and what? Use this money for expansion. Use this money for expansion. Okay, so that means so whether to distribute a dividend or not, that we are going to learn in dividend decisions chapter. Dividend decision chapter. Dividend decision chapter. Okay. So we are going to learn the theories. Okay, whether to pay a dividend or not. And again, Companies Act 2013 will also get involved because to make a payment of a dividend, first, Board of Directors must recommend payment of a dividend. Board of Directors must recommend payment of a dividend. Point number one. So Board of Directors, before recommending the payment of a dividend, they will go through the dividend decision chapter in FM. They should have a sound knowledge of dividend decisions chapter. So Board of Directors. So Board of Directors must recommend payment of dividend. Recommend, only recommend. And that has to be approved by the shareholders in a general meeting. Then only the payment of dividend will be made. Okay. Otherwise, payment of dividend will not be made. Clear? Okay. So earnings available to equity shareholders. From this what? Minus equity dividend. But payment of equity dividend is not mandatory. Clear? There are several companies will not, from the incorporation, they haven't paid any dividend. They will not be paying any dividend. What they will do is they will keep the profits. They will be keep on reinvesting. So minus equity dividend, the rest of the amount, the remaining amount is called as what? Retained earnings. So this is the internal source of a finance. Retained earnings is nothing but what? Internal source of finance. That means if you want to go for expansion, this is the internal source. You will be utilizing this money for expansion. Clearer? Arvind, clear? Income statement, retained earnings. So income statement, sales minus variable cost, contribution minus fixed cost, EBIT minus interest, earnings before tax minus tax, earnings after tax minus preference dividend, earnings earnings available to equity shareholders minus equity dividend, retained earnings, retained earnings. Am I clear? So this is the what income statement, and you should not by heart this. You have to understand. So preference dividend is reduced before equity dividend because it is preference. Preference has to be given to the preference shareholders. Okay. And here you have to understand the few terms. Earnings per share. Earnings per share is equal to earnings available to equity shareholders divided by number of shares. Shares means nothing but equity shares. Earnings per share is equal to earnings available to equity shareholders divided by number of shares. Yes or no? If you are dividing the total earnings with number of shares, then obviously you will get earnings per share. Clear? Next, financial charges. Financial charges means the charges which are paid for procurement of a finance. So I will write the examples. Financial charges. Interest is a financial charge because interest is paid on what? Debt. Financial charges mean charges paid for procurement of a fund. Fund can be equity, debt, preference. Yes or no? So interest is a financial charge. Yes or no? Interest is a financial charge and it is fixed. And it is fixed. Yes or no? It is a charge. Charge means irrespective of a financial position, we have to make a payment of a interest. Clear? Next. Is it fixed or not interest? Interest is fixed or not? Yes, fixed rate has to be paid irrespective of a financial position of a company. So interest is a fixed financial charge. What about preference dividend? Preference dividend is also a financial charge because it is paid on preference share capital. What about this one? This is also fixed, but it is not a charge. Why it is not a charge? Preference dividend is paid only when there are profits. You know that there are two types, cumulative preference shares and Non-cumulative preference shares. So preference dividend is what? Fixed. It is a fixed financial charge, but it is not a charge, it is a appropriation. Here charges means expense. Financial charges. Interest is a fixed financial charge. Preference dividend is also a fixed financial charge, but it is appropriation. That means it is paid only if there are profits. What about equity dividend? Equity dividend, fixed or variable? Variable. And it is also what? Equity dividend is not a fixed financial charge. Why it is not fixed financial charges? Sometimes 10% is paid, sometimes 20, 30, 100%, 200% of face value will be paid. So that's why it is not a fixed financial charge. Clear? Income statement, Sunita. So sales minus variable cost, contribution minus fixed cost, EBIT minus interest, EBT minus tax, EAT minus preference dividend, earnings available to equity shareholders minus equity dividend, retained earnings. Earnings per share is equal to earnings available to equity shareholders divided by the number of shares. Retained earnings is an internal source of finance. Okay. Financial charges. Interest, preference dividend, equity dividend. Both interest and preference dividend are fixed financial charges, but interest is a charge to P&L, but whereas preference dividend is a appropriation to P&L, because preference dividend is paid only if there are profits. What about equity dividend? Variable financial charge, and it is an appropriation. It is an appropriation. Clear? Okay. So now come to the cost of a capital definition. What is the cost of a capital? Minimum return required to be earned by the company to meet the expectation of a. So who are the investors here? Equity shareholders, debt holders, preference holders. So step by step we are going to learn cost of a capital. First we are going to learn how to find out the cost of a debt. Cost of a debt. And then cost of a preference. Cost of a preference. And then cost of a equity. Cost of a equity. KE. And later on we come to KO. Overall cost of a capital. Overall cost of a capital. First we start with what? KD, and then KP, and then what? KE, cost of equity. And meanwhile we discuss about KR. KR means cost of a retained earnings. Cost of a retained earning. Retained earnings is also called as what? Reserves and surplus. Retained earnings is also called as what? Reserves and surplus. Yes or no? Okay. So take heading cost of a debt. Cost of a debt. Cost of a debt. మోనికి ఏంటమ్మా లైటర్ కావాలా? కాస్ట్ ఆఫ్ అ డెట్. కాస్ట్ ఆఫ్ అ డెట్. So first write down the formula, then later on we shall see the justification. Cost of a debt. In this we have a two categories: redeemable, irredeemable. Redeemable and irredeemable. 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 KD is equal to I into 1 minus T divided by NP. If it is irredeemable debt, irredeemable, nothing but perpetual debt. Perpetual means continuous. If it is irredeemable debt, cost of a debt KD is equal to I into 1 minus T divided by net proceeds NP. Redeemable KD is equal to, గర్ల్స్ అందరూ దండం పెట్టుకోండి మీ టాపిక్ అయ్యేంతవరకు పవర్ పోకూడదని, దేవుని కోరుకోండి. బాయ్స్ మీరు కూడా. కేడీ ఈజ్ ఈక్వల్ టు, రివర్స్లో కోరుకుంటున్నారా, ఆర్వి మైనస్ ఎన్పి డివైడెడ్ బై ఎన్ హోల్ డివైడెడ్ బై ఆర్వి ప్లస్ ఎన్పి డివైడెడ్ బై 2. Redeemable cost of a debt KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2. So let us write down I is equal to interest amount. I is equal to interest amount. T is equal to tax rate. T is equal to tax rate, not tax amount. It is a tax rate. That means if it is 30%, we should take 0.3. If it is 40%, we should take 0.4. So T is equal to tax rate. Next what? NP is equal to net proceeds. NP is equal to net proceeds. Clear? So net proceeds means issue price minus flotation cost. And again flotation cost means what? Cost of issue. Cost of a issue. I'm going to explain justification. I'm going to give justification. Wait for some time. Flotation cost means what? Cost of a issue. Net proceeds, issue price. Issue price means face value plus premium or face value minus discount. Yes or no? Next, RV. RV is equal to RV is equal to redemption value. N is equal to number of years. Number of years or number of periods. Better you write number of periods. N is equal to number of periods. The RV redemption value, N is equal to what? Number of periods, number of periods, okay? Now let us see the justification for formula. So cost of a irredeemable debt I into 1 minus T divided by NP. Redeemable I into 1 minus T plus RV minus NP divided by N all divided by RV plus NP divided by 2. Divided by 2. Yes or no? So let us see the justification with examples. Example number 1. Example number 1. So cost of a capital means minimum return required to be earned by the company to meet the expectation of the investors. Yes or no? Okay. So let us see the example. So let us take a basic example. Loan is equal to 1 lakh at the rate of 10 percentage per annum. Loan is equal to 1 lakh at the rate of 10 percentage per annum. So company is doing a business, company wanted money. So company has taken a loan of rupees 1 lakh. And what is the rate of interest? 10% is the rate of interest. Okay. Now tell me what the other person, that is lender, will expect. Cost means expectation, right? So company is taking a loan. What the other person expectation would be? The other person expectation would be what? Interest. The other person will expect what? Interest. Yes or no? Company is taking a loan from Deva at the rate of what? 10%. So now Deva, lender, will expect what? Interest at the rate of what? 10%. So that is his expectation. Cost of a capital means minimum return required to be earned by the company to meet the expectation of the investor. Investor can be debenture holder, preference holder, or equity shareholder. I'm talking about debt now. So now tell me, what is the expectation? So here simple, KD is equal to. So Deva will be expecting 1 lakh into 10%. Yes or no? So company is going to make investment of 1 lakh. So company has to earn 10%. Company has to earn 10%. 10% is the cost of a debt. What is the minimum return required to be earned by the company to meet the expectation of investor? 10%. If a company can earn 10% rate of a return, that is enough. Why it is enough? Because rate of interest is also 10%. Am I clear? Are you getting my point? Cost of a capital. Cost means expectation. Cost of a capital means minimum return required to be earned by the company to meet the expectation of an investor. Investor would expect 10,000. Investor would expect 10,000. I have to earn minimum what? 10,000 on 1 lakh. So that means what is the minimum rate of a return required to be earned? 10% is the minimum rate of a return required to be earned by the company. So clear? That means here our formula is, what is the numerator? Numerator is I. Numerator is I divided by what? Principal. I divided by principal. Yes or no? Interest amount 10,000 divided by principal 1 lakh. Okay. Let us take example 2. Loan 1 lakh at the rate of 10% per annum. 2% processing charges. 2% processing charges. So what are these processing charges? If you are taking any loan from a bank, bank will be taking some amount as a processing charges. For example, if you are taking a loan of rupees 1 lakh from bank, bank will be giving only 98,000. Only 98,000 because remaining 2,000 will be charged as a processing charges. Those are the charges levied for processing the loan. Processing the loan. Okay. So for processing the loan, bank is employing several staff. For that purpose, they will be charging 1%, 2%, or sometimes 3% also. Are you getting my point? That means even though the loan amount is 1 lakh, ultimately the borrower will receive only what? 98,000. But interest has to be paid on. Interest has to be paid on 1 lakh. Even if you take car loan, home loan, whatever the loan you take, bank will be levying processing charges. So the processing charges depends 0.5%, 1%, 2%, 3%, depending upon the credit rating of a customer. Credit rating. If a credit rating is good, they might charge 1%. If a credit rating is not good, they might charge 2%, 3%, etc. Are you able to understand these processing charges? Okay. So that means here in example 2, company will receive only 98. Company will be able to make investment of only company will be able to make investment of only 98 because company received only 98 and company will be able to make an investment of only 98. But interest has to be paid on 1 lakh. Lender will expect 1 lakh into 10%. But the investment we are making is 98,000. That means second case, cost of a debt KD is equal to 1 lakh into 10% divided by, we should take only 98,000. This time company should earn 10,000 on 98,000 because company will be able to make investment of only 98,000. Are you getting my point? So the answer is 10 point 10 point convert it into percentage, multiply with 100, 0 point some 10 point. So now our formula is not interest divided by principal. Our formula is what? Interest divided by net proceeds, the net amount which the company is receiving. We should not take the principal amount. We should take the net amount the company receiving. Net proceeds. How do we get net proceeds? Issue price. That is 1 lakh minus flotation cost. Cost of a issue. For suppose if it is a debenture. Let us assume if it is a debenture. And if debenture is issued at 110 rupees. Debenture is issued at 110 rupees. Flotation cost 4 rupees. Cost of issue of a debenture 4 rupees. For example, underwriting commission. You know the concept of underwriting commission, right? Underwriting commission, it has to be paid at the time of issue of a debentures. So let us assume 110 is the issue price and the cost of issue is 4 rupees. Then what is the net proceed? 110 minus 4. 106. So we should take 106 in the denominator. 106 in the denominator. Clear? Are getting my point? So I divided by what? NP. So there is one more component. What is the other component? 1 minus T. So example 3. Example 3, case 1 and case 2. Case 1, case 2. Example 3. Okay, Arvind? Equity 20 lakhs. Equity 20 lakhs. Second case 10 lakhs. Second case 10 lakhs. Next 10% is debt. Nil and 10 lakhs. 20 lakhs. I'm taking two cases. First case, the capital structure is 100% equity. First case, the capital structure is 100% equity. 100%. Company is doing business with 100% equity. Second case, 50% equity, 50% debt. 50% equity and 50% debt. Clear? So the both the companies engaged in same business, same amount of investment, because amount of investment in first case is 20 lakhs, second case is also 20 lakhs. Both the cases amount of investment is same. They're doing same business. They're doing same business. Then obviously they will get same return, yes or no? Let us assume EBIT is equal to 4 lakhs and 4 lakhs. EBIT is equal to 4 lakhs and 4 lakhs. Minus interest. Is there any interest in first case? Is there any interest in first case? No. Second case, 10 lakhs into 10%, 1 lakh. 10 lakhs into 10%, we should not use the calculator. If anybody is using calculator, see your face in mirror, okay? So EBIT minus interest, earnings before tax. What is earnings before tax? 4 lakhs minus, let us assume tax at the rate of 30%. Tax at the rate of 30%. What is the tax? 1,20,000. Okay. Just stop it here. Observe the tax. Observe the tax. I have taken two cases. In two cases, companies are doing the same business, same amount of investment, same amount of investment. Both the cases investment is equal to 20 lakhs, 20 and 20. Yes or no? So both the cases investment is same. And EBIT is also same. Earnings before interest and tax is also same. The only difference is what? The only difference is capital structure. Capital structure. Capital structure means what? Capital mix. First case 100% equity. Second case 50% equity, 50% debt. That is the only difference. Are you getting my point? Girls are doing the same business, boys are also doing the same business, but the only difference is girls 100% equity, boys 50% equity and 50% debt. Same amount of investment, 20 lakhs, 20 lakhs. T time, T time. EBIT is also same. Both the cases EBIT 4 lakhs, 4 lakhs. But girls paying tax amount of 1,20,000. Boys paying only 90,000. Yes or no? Less amount of tax is being paid in second case. అమ్మా డిఎస్పి ఏంటి వాయిస్తున్నావు నువ్వే మ్యూజిక్ ఏదో ఈ పేరేంటి ప్రియాంక ఏదో బీట్ వాయిస్తున్నావు కుర్రోళ్ళను నలుగురు రమ్మంటావు డాన్స్కి సో వాట్ ఇస్ ద ట్యాక్స్ అమౌంట్ మహేష్ ఐఎమ్ సారీ మహేష్ what is the tax amount 1.2 0.9 1.2 0.9 So second case, the tax payment is only 0.9. So less amount of tax is being paid, yes or no? So only 90,000. That means less amount. What is the less amount? Difference. So 30,000 less amount of tax is being paid. So tell me the reason. What is the reason? Because of interest. Because of interest. You are paying interest of 1 lakh. On that 1 lakh, saving a tax at the rate of 30%. So that 30,000 is tax savings on interest. That 30,000 is what? Tax savings on interest. Nothing but in second case, if I have to find out the cost of a debt Priyanka, KD is equal to what is the interest amount? 1 lakh. But 1 lakh is not the cost actually because I am saving tax by 30,000. And what is the debt amount? 10 lakhs. My real cost will be 1 lakh minus 30,000 divided by 10 lakhs. Nothing but you will get 7%. Okay, here answer is not important, derivation is important. So 1 lakh minus what? 30,000 divided by 10 lakhs. Are you able to understand my point? What is the real cost? Not 1 lakh. 1 lakh is not the real cost. Why 1 lakh is not the real cost? On payment of 1 lakh interest, we are saving tax 30,000. So our net cost will be 70,000 only. So if I take 1 lakh common, then I will get 1 minus 0.3, yes or no, divided by 10 lakhs. Nothing but 1 lakh is interest amount, I. 1 minus 0.3 is nothing but tax rate. 10 lakhs is nothing but what? Net proceeds. So therefore, cost of a debt KD is equal to I into 1 minus T divided by net proceeds. Am I clear? So why are we taking into 1 minus T? Because on payment of a interest, we can save tax. Vaishnavi, we can save what? Tax. Yes or no? Yes or no? First case we are paying tax of 1.2 lakh. Second case we are paying tax of 90,000. So we have taken 3 examples to justify the formula. What is the formula? KD is equal to I into 1 minus T divided by net proceeds. Why net proceeds? Why first I? Cost of a capital itself means minimum return required to be earned by the company to meet the expectation. What does the debenture holder expect? The debenture holder will expect interest. So that's why I'm taking I divided by my investment. What is my investment? Net proceeds. Net proceeds. Issue price minus flotation cost. Y into 1 minus T. Because the company can save tax on payment of interest. So that's why KD is equal to I into 1 minus T divided by net proceeds. Clear? Done? So note down the example. ఏసాజ్ నోట్ చేశారా ఎక్కడి వరకు మొత్తం అయిందా So next one. So we have seen justification for first formula, right? I into 1 minus T divided by net proceeds. Next formula, what is the next one? I into 1 minus t plus RV minus NP divided by N whole divided by RV plus in చిన్న ఫార్ములాకి 3 ఎగ్జాంపుల్స్ అంటే దీనికి అయిపోయినట్టు అనుకున్నా. No, just one example only. So what is the second one? Formula. Example 4. Pandu, example 4. So let us assume interest is equal to 12 rupees. Interest is equal to 12 rupees. T is equal to 30%, tax rate 30%, that means 0.3. N is equal to 5. RV is equal to 120. NP is equal to 90 rupees. NP is equal to 90 rupees. Now, cost of a debt KD is equal to cost of a debt KD is equal to, what is the second formula? I into I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2. RV plus NP divided by 2. Clear? Done. That is equal to, what is the interest amount I have given? 12 into 1 minus 0.3 plus RV redemption value 120, very good Ameshwar Nayak, minus 90 divided by 5. So here answer is not important, do not calculate. First observe the numbers, okay? Observe the numbers. It is a redeemable debt. It is a redeemable debt. If it is a redeemable debt, then formula is I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2. Okay, why? First 12. What is this 12? Interest amount. That is their expectation. Y into 1 minus 0.3? Tax savings. We know the logic up to I into 1 minus T. What is that second part? Simple. In case of redeemable debenture, we are not just paying interest. We are not just paying interest, we are paying an extra amount. What is that extra amount? We have taken only 90 rupees from the investor. But at the time of redemption, we are paying 120. Yes or no? Forget about RV and NP. So in layman language, I am taking 90 from the investor and giving back 120. That means I am paying extra 30. In addition to interest, I am paying extra 30. But I am not paying that 30 every year. I am paying that 30 over a period of 5 years. That means if I apportion it for 1 year, how much I am paying? 30 divided by 5, 6. So 12 rupees interest, and on the 12 rupees I will be saving tax 30%. In addition to that, I am paying extra principal of 6 rupees per annum. 6 rupees per annum. So that's why I am taking RV minus NP divided by N. So that can be positive or negative. So that means the number can be reverse. Redemption value 90, net proceeds what? 120. That means what? I am taking 120 and repaying only 90. In that case, what? Minus. That will become minus. The cost of a debt will decrease. Cost of a debt will decrease. Clear? Are you able to understand the logic for RV minus NP divided by N? RV minus NP divided by N. In addition to interest, I am paying extra principal. I am paying extra principal of 30 over a period of 5 years. That means per annum I am paying 6 rupees. 6 rupees. Okay. So divided by I should take what? Investment. Nothing but the net proceeds. But why I am taking simple average of both? Because I am taking 90, repaying 120. So if I take 90, that is not correct. If I take 120 is not correct. So that's why what I am taking simple average. 90 plus 120 divided by 2. Clear? So the logic behind the formula. KD is equal to cost of a redeemable debt. KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2. So now it is easy to remember if you know the logic. Clear? Done? So tell me the answer. 13.71. In FM and SFM, students will be doing a clerical mistake. Clerical mistake means generally 90% of the questions will have a face value 100. 90% of the questions will have a face value 100. Let us say, for example, rate of interest 12%. Rate of interest 12%. So interest amount will be 12. Interest amount is equal to 12. If it is 13%, 13. If it is 14, 14. If it is 15, 15. Yes or no? But in examination, sometimes they will give a face value 1000. Face value 1000. Face value 1000 and interest rate 12% means you should take 120. But generally, students will take, subconscious mind will take 12. ఓకే సో 12 తీసుకుంటారు బయటకు వచ్చి తక్కువలో తక్కువ 70 అనుకుంటారు రావుగా ఎందుకని ఫేస్ వాల్యూ 1000 మీన్స్ 1000 into 12% ఇంట్రెస్ట్ అమౌంట్ ఈజ్ ఈక్వల్ టు 120. సో బీ కేర్ఫుల్ ఓకే సో క్లియరా సెకండ్ ఫార్ములా లాజిక్ పండు ఓకే నెక్స్ట్ నోట్ పాయింట్ రైట్ డౌన్ ద నోట్ పాయింట్ new issue net proceeds. If it is new issue we take net proceeds. New, that means fresh issue, we take net proceeds. For debt, preference and equity, for all the three sources we take net proceeds if it is a new issue. If it is existing issue, we take market price. If it is an existing issue, we take market price. If it is an existing issue, we take what? Market price. What is the logic behind this? So Infosys share price right now, so 1614 as on today. Okay, 1614. Okay, clear? So this company was founded in the year 1981. 1981. What is the current market price of a share? 1614 is the current market price. But the company was founded in the year 1981. In the year 1981, the company might have issued equity shares at the rate of rupees 15. At the rate of rupees 15. Flotation cost, let us assume 1 rupee. Then what is the net proceeds? Net proceeds 15 minus 1, 14. In 1981, net proceeds 14. Okay. Now we are in 2025. So if you take the same 14 rupees, is it correct to find out the cost of equity? Not correct. Why? Right now, the investor is foregoing 14 rupees on one share. So indirectly, he is making an investment of 1614, not 14 rupees. 14 rupees is in the year 1981. But now he has an opportunity of selling this Infosys share at the rate of 1614, and he can invest this 1614 in any other company. Yes or no? But he is leaving this 1614 in our company, means that means his investment is indirectly 1614. So that's why if it is a new issue, fresh issue, we take what? Net proceeds. But if a issue was already existing, I mean 10 years back the issue was made, 5 years back issue was made, then we should take what? Current market price. Market price as on today. Clear? Okay. So these are the formulas for what? Cost of a irredeemable debt, redeemable debt. So now let us write cost of preference shares. Cost of a preference shares. Cost of a preference shares. In this we have a two categories again. What are the two categories? No company can issue irredeemable preference shares, yes or no? But still in FM they may not be giving a redeemability period. If they are not giving redeemability period, then you have to apply this formula. If redeemability period is not given, that means these are irredeemable. Cost of preference KP is equal to. So tell me what do the preference holders expect? Do they expect interest? Preference shareholders, will they expect interest? They will expect dividend. What dividend? Equity dividend or preference dividend? Preference dividend. So that means instead of I, we take PD. Am I clear? Instead of interest, we take PD, preference dividend, because preference holders will expect preference dividend divided by net proceeds. So why are we not taking into 1 minus T? Because we cannot save tax on payment of a preference dividend. See the income statement once. If you see the income statement, preference dividend is reduced after payment of a tax, and have clearly mentioned preference dividend is an appropriation. That means no tax can be saved on a preference dividend. So that's why simple our formula is PD divided by NP. Next, redeemable. So I think you can guess the formula. Redeemable. Redeemable. Pandu, what is the formula? Redeemable. PD. Pandaniki one chance. PD plus PD plus or PD into 1 minus T. PD plus RV plus or minus minus NP divided by N whole divided by RV plus NP. Very good amma. Pandan encourage amma. The simple formula PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2. The only difference is 1 minus T. So 1 minus T is not applicable here because we cannot save tax on payment of a preference dividend. Clear? We cannot save tax. We cannot save tax on payment of a preference dividend. Yes or no? Preference dividend is not allowed as an expenditure. Sunita, yes or no? Bharat, Anedama Rutherford, Chiranjeevi. So clear? So we have discussed the cost of it at KD, and next what? KP, cost of a preference. The next what? We have to discuss cost of a equity and cost of a retained earnings, K, R. And next what? KO. KO. Overall cost of a capital. Weighted average cost of a capital. Weighted average cost of a capital. Our chapter name is cost of a capital. Minimum return, minimum rate of a return required to be earned by the company to meet the expectation of investors. Investors can be equity shareholders, preference shareholders, debt holders. So we have learned how to find out KD and then what? KP. Okay. So for Sunday, you know the syllabus, right? What is the syllabus? Cost of a capital, time value of a money, introduction to financial management. So this is the syllabus for FM. Okay. In similar manner, you have a syllabus for what? Management accounting and what? Corporate accounting also. Indama? Chippu. For Sunday exam, you will get 2 descriptive questions from cost of a capital. 2 descriptive questions from cost of a capital. Okay, and 5 MCQs. 5 multiple choice questions from introduction to FM, time value of a money, and next what? Cost of a capital. Okay, so this is the syllabus, Aravind. Okay, clear? So every week you will have an exam on week syllabus. Week syllabus, okay? Clear? Cost of a capital, we have discussed up to what? Cost of a preference. Cost of a preference. So why are we discussing this topic in financial management? The financial management 2 aspects are procurement of fund, effective utilization of funds. Effective utilization of fund. Okay. So while procuring funds, we should consider how many factors? So we should keep in mind 4 factors. What are the 4 factors? Risk, cost, control, flexibility. So risk means a possibility of occurrence of a loss. From risk point of view, which is the best source? Equity is the best source because less risk, payment of dividend is not mandatory, repayment of a capital is also not mandatory. Yes or no? So next one, cost. Cost means expectation. From cost point of view, debt is the best option. Debt is the best option. And next what? Control. Control point of view. Debt is the best option because if we procure fund by way of a debt, control will not get diluted. Flexibility point of view, debt is the best option because debt can be repaid. Debt can be repaid, but equity cannot be repaid. Yes or no? So we have to consider four factors, and in that four factors, one of the factor cost. Cost. So the present chapter name is cost of a capital. Cost of a capital. So cost of a capital is also known as required rate of a return, weighted average cost of a capital, overall cost of a capital, or a discount rate or a capitalization rate. Okay, so we can call it with different names. Cost of a capital, weighted average cost of a capital, discount rate, required rate of a return, next capitalization rate. Capitalization rate. Okay. So now cost of a capital means minimum rate of a return required to be earned by the company to meet the expectation of investors. Investors can be of a three three categories. Yes or no? Generally three only. Generally three. So equity shareholders, girls, equity shareholders. Girls, equity shareholders. Okay. So debt holders. And next word, preference shareholder. Preference shareholder. Okay. Three categories. Okay. So simple common sense. What do the debenture holder expect? Debenture holder will expect interest. Preference holder will expect preference dividend. Preference dividend. Equity shareholder will expect equity dividend. Equity dividend. Yes or no? So here cost of a capital means minimum rate of a return required to be earned by the company to meet the expectation of investors. So we have seen income statement. Income statement. So I hope you understood the income statement. So interest is a charge to P&L. Charge to P&L. It has to be paid irrespective of a financial position. Yes or no? So what about preference dividend? It is an appropriation. It is not allowable as an expense under Income Tax Act. Okay, so that's why we cannot save tax. Next, earnings per share is equal to earnings available to equity shareholders divided by number of shares. So fixed financial charges. What are the examples for fixed financial charges? Interest. Interest is a fixed financial charge. Preference dividend is also a fixed financial charges. Financial charge means charges to be paid on procurement of a finance funds. Equity dividend is a variable financial charge. Variable financial charge. So interest is charge expense has to be paid irrespective of financial position. Preference dividend appropriation, equity dividend appropriation. Next, the cost of a debt formula KD is equal to I into 1 minus T divided by net proceeds. Redeemable KD is equal to I into 1 minus T plus. Very good, Amma. Baharcharu. I into 1 minus T plus RV minus NP divided by N all divided by RV plus NP divided by 2. So I means interest amount, T means a tax rate, NP net proceeds, issue price minus flotation cost. Flotation cost means cost of a issue. RV redemption value. N mean number of periods. N number of periods. Number of periods. Okay. So example number one. So I have given a justification for I into 1 minus t divided by NP with the 3 examples. First example, first of all, cost means an expectation, right? So loan 1 lakh at the rate of 10%. So investors would expect rate of a interest only. Yes or no? Investor will expect interest. Yes or no? So debenture holder will expect only interest. So even if they expect more than interest, we are not going to give. Yes or no? It is a fixed financial charge. Yes or no? So what is their expectation? Their expectation is 1 lakh into 10 percentage, 10,000. What is their expectation? 10,000 is their expectation. Yes or no? 10,000 is their expectation. So we are getting an amount of 1 lakh. What is the amount to be invested? 1 lakh. So now tell me what is the minimum rate of a return required to be earned. Minimum rate of a return required to be earned is equal to 10,000 divided by 1 lakh. So that is equal to what? 10 percentage. So 10 percentage is the answer. 10 percentage. Clear? But sometimes there may be a concept of processing charges. Nothing but flotation cost, cost of a issue, cost of procuring funds, cost of procuring funds, cost of a procuring funds. Okay. So example 2% is the processing charges. Then I cannot do 10,000 divided by 1 lakh. 10,000 divided by 1 lakh. Because 10% is not enough. 10% is not enough because I'm able to invest only 98,000. I'm able to invest only what? 98,000. That's why the point is here. So what is the minimum rate of a return required? 10% is not enough because we are able to invest only what? 98,000. 98,000. So 98,000 into 10%, 9,800. But what is the rate of interest? What is the rate of interest? Amount of interest to be paid is equal to 10,000. But if we earn 10% on 98,000, it is not enough. So that's why instead of 1 lakh in the denominator, we should take 98,000. 98,000. Am I clear? So 10.204% is the answer, cost of our debt. So I divided by NP. We should not take principal. We should not take principal. We should always take what? Net proceeds. Why net proceeds? Because we can invest only 98,000 net proceeds. We are getting only net proceeds, right? We would be able to invest only net proceeds. So that's why in the denominator we should take net proceeds. Next, I have taken example 3 for giving a justification for into 1 minus t. What is this t? T means a tax rate. T means a tax rate. T means a tax rate. So I have given a justification for this tax rate. So take two scenarios, two cases. For example, there are two businesses, both the businesses are same. Both the businesses are same. Okay. First case, 20 lakhs capital. Second case, 20 lakhs is the capital. That means overall investment is 20 lakhs only. First case and second case. In both the cases, investment is equal to 20 lakhs. But the only difference is, first case, 100% equity. Second case, 50% equity, 50% debt. Are you getting my point? Okay. For example, Sudha, she has started a business. Okay. So selling stationery items. So what is the investment? 20 lakhs. Okay. Nandan has started the same business, Same capital. What is the capital? 20 lakhs. Both have started the same business, stationary business. But what is the difference? The only difference is Sudha 100% equity, Nandan 50% equity, 50% debt. So they are doing a same business. Imagine they are doing a same business. Okay. So obviously they will have a same EBIT, same sales, same variable cost, same fixed cost, and earnings before interest and tax will also be same EBIT. So in our example, what is the EBIT? 4 lakhs is the EBIT. 4 lakhs is the EBIT. Earnings before interest and tax. Now tell me, Sudha capital structure is 100% equity. Is she going to pay any interest? She is not going to pay any interest. So her earnings before tax will be 4 lakhs. Let us assume the tax rate is 30%. I'm taking an example. Let us assume the tax rate is 30%. That means Sudha has to pay 30% tax on 4 lakhs. That means what is the tax amount? 1.2 lakhs. 1.2 lakhs is the tax amount. 1.2 lakhs is the tax amount. Yes or no? Am I correct? Okay. What about Nandan? Nandan will not be paying tax on 4 lakhs. Why? Nandan is having a debt in the capital structure. Debt in a capital structure. So he will be paying interest. What is the interest amount? 1 lakh. 10 lakh into 10%, 1 lakh. So 4 lakhs minus 1 lakh. So what is the taxable income? 3 lakhs is the taxable income. So 3 lakhs into what? 30%. 3 lakhs into 30%. So tell me what is the tax to be paid. So there are two cases. First case, Sudha, she is paying tax amount of 1.2 lakhs. Nandan is paying a tax amount of 90,000. So why Nandan is paying less amount of a tax? What is the reason? If you observe the statement, second case, Nandan is paying interest. Because of interest, the taxable income has got reduced by 1 lakh. On that 1 lakh, he is saving 30%. Yes or no? Because tax rate is 30%. On that 1 lakh, he is saving 30%. That is 30,000. So that's why Sudha is paying 1.2 lakhs tax, whereas Nandan is paying tax amount of 90,000. So Nandan is paying less amount of a tax. What is the difference? 30,000. Why there is a difference of 30,000? Simple. 1 lakh into 30%. Because in second case, taxable income has got reduced by 1 lakh. So 1 lakh into 30% is the what? Tax savings. Am I clear? Clear? So 30,000. So that means here, see the logic, cost of a debt. Cost of a debt. We cannot say 1 lakh is the cost. We cannot say 1 lakh is the cost. Why? Even though we are paying interest of 1 lakh, we are saving a tax of 30,000. Yes or no? So the reason for tax saving is payment of a interest. So what is the interest amount? 1 lakh. And tax savings 30,000. That means our net cost should be only 70,000. Net cost is only what? 70,000. We should consider only 70,000. Why 70,000? If you are taking a debt, the benefit you are going to get is you will be saving tax on payment of a interest. Payment of a interest. Okay. So that's why I have taken 1 lakh minus 30,000. If I take 1 lakh common, then what? In brackets, I will get 1 minus 0.3. What is that 1 lakh? 1 lakh is interest, 0.3 is tax. 0.3 is what? Tax rate. Tax rate. So that's why I into 1 minus t divided by np. I into 1 minus t divided by np. Clear, Priyanka? Is it clear? Are you able to understand the logic? You will be getting a theory question also. For example, they might ask you why the cost of a debt is cheaper than cost of a equity. I have already told you from cost point of view, which is the best source? Debt is the best source. That means cost of a debt is less than cost of a equity. Yes or no? So cost of a debt is less than cost of equity for three reasons. For three reasons. One reason is in case of a debt, we can save tax on payment of a interest. We can save tax on payment of a interest. Okay, so later on we shall discuss the other two reasons also. But right now, are you able to understand this KD formula? I into 1 minus T divided by NP, net proceeds. Clear? If it is redeemable, yesterday I gave a logic with an example. If it is redeemable, then I into 1 minus T plus. So are you able to understand why we are taking RV minus NP? So that is difference of a principle. For example, in the above example, we are taking 90 and paying 120. We are paying extra amount of 30 over a period of 5 years. So that's why RV minus NP divided by N whole divided by average investment. What is average investment? RV plus NP divided by 2. Clear? So what about cost of preference? PD divided by NP if it is irredeemable. If it is redeemable, PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2. NP divided by 2. Clear? So here there will not be any tax savings. And preference holders will expect what? Preference dividend. Preference holders will expect what? Preference dividend. Clear? Okay. So FME is very interesting subject. Very interesting subject. You have to apply common sense. So if risk increases, what happens to the expectation? Expectation increases. Basic fundamental point. Yes or no? So cost of a capital. So financial management, two aspects are procurement and effective utilization of a fund. Effective utilization of a fund. Okay. So object of any business is to meet the expectation of the shareholders. Shareholders will have, investors will have some expectation over the company, and the company has to meet that expectations. Otherwise, what happens to the value? Value decreases. For example, your parents will have some expectation on you. Yes or no? If you are meeting that expectation, then obviously your value will increase. Otherwise, value will decrease. So clear? So this is cost of a preference. Cost of preference. Am I clear? So why this chapter? Simple. While procuring fund, we should keep in mind cost of a capital. cost of a capital. Okay. Next, cost of a equity. Manikanta, is it clear till now? So next concept, cost of a equity. Cost of a equity. See the next concept, cost of a equity. Next 1 hour class is very important. In next 1 hour, we are going to complete the concept of a cost of a capital, and later on we start questions, practical questions. Okay. Cost of a equity. Cost of a equity. So what equity shareholders will expect from the company? Equity dividend. Equity dividend. So that's why our formula is D1 by D1 means, so D1 expected dividend. Expected dividend at the end of a year one. At the end of year one. D1 divided by net proceeds. If it is fresh issue. If it is fresh issue, then we take net proceeds. But if it is already an existing issue, market price, that means D1 by what? P naught. P naught means current market price. Current market price. Clear? P naught means current market price. So will there be any tax savings? No tax savings. No tax savings. Company is not going to save any tax. So that's why what D1 divided by P naught. P naught means what? Current market price. D1 means an expected dividend. Expected dividend. Clear? Next. Second one. D1 by NP plus G or D1 by P naught plus G. G means a growth rate. G means what? Growth rate. D1 by NP plus G or D1 by P naught plus G. So, note just Nara Manikanda. I will explain later, okay? Third one. E1 by P naught. E1 by P naught. E1 means earnings per share. D1 means dividend per share. E1 means what? Earnings per share. Fourth, E1 by P naught plus G. E1 by P naught plus G. Growth rate. E1 by P naught plus growth rate. Clear? Bharat? Next, fifth. Cost of equity we denote with KE. So conceptual understanding is very important. In CMA final also, students, they are struggling in SFM. The only reason is they don't know the basics, so that's why. Okay. FM and SFM. Without knowing FM, we cannot learn SFM. Okay. So fourth one, even by P naught plus G. Next, K is equal to RF plus RM minus RF into beta. Without fifth formula, there will not be SFM paper. In every paper, so this concept they will ask. This is called CAPM. CAPM, Capital Asset Pricing Model. Capital Asset Pricing Model. Capital Asset Pricing Model. Here the capital asset means equity share. Equity share pricing model. Equity share pricing model. So K is equal to RF plus RM minus RF into beta. So now let us write down each one. So first one, D1. D1 is equal to expected dividend per share expected dividend per share at the end of year 1. Expected dividend per share at the end of year 1. Next, P naught. We already know net proceeds, right? Issue price minus flotation cost. Flotation cost means cost of a issue. That includes underwriting commission, brokerage. Do you know the brokerage? So we sell shares through a broker. Okay, and we have to pay brokerage, underwriting commission, and when you are issuing shares or debentures to the public, you have to issue the prospectus. Do you know the concept of prospectus? Prospect is similar to our brochure, college brochure, what we are and what we are going to do in the future. Okay. So prospectus cost, all these are the cost of a issue. Next, P naught. P naught means what? Current market price. P naught is equal to current market price. Am I clear? Next, what? G. G is equal to growth rate. G is equal to growth rate. Next, what? Even. Expected. Expected earnings per share at the end of year 1. Expected earnings per share at the end of a year 1. Clear? Expected earnings per share at the end of a year 1. Next. What is the next one? RF. RF is equal to risk free rate of a return. Risk free rate of a return. Risk free rate of a return. RF. So this is a final level concept, but here basics will be tested in FM. RM. Market return. Beta. Risk factor. Beta. Risk factor. Here we discuss, I mean, we just note down the beta formula generally. So we are not going to discuss the logic, okay, for deriving the beta, because that is a big chapter in SFM, portfolio management chapter. So that's why we just, okay, discuss the formula of a beta, but we are not going to discuss the logic behind the derivation, okay. So beta means what? Risk factor. Next term, RM minus RF. RM minus RF is called as market risk premium. Market risk premium. RM minus RF is called as a market risk premium. RM minus RF is called as what? Market risk premium. Next. RM minus RF into beta is called as RM minus RF into beta is called as security risk premium. Security risk premium. Security risk premium. Security risk premium. Okay. Next. Dividend per share is equal to earnings per share into payout ratio. Payout ratio. Dividend per share is equal to earnings per share into payout ratio. Next. Payout ratio is equal to 1 minus retention ratio. Payout ratio is equal to 1 minus retention ratio. 1 minus retention ratio. Payout ratio is equal to 1 minus retention ratio. Next. Growth rate G is equal to B into R. B into R. Growth rate G is equal to what? B into R. Next, B is equal to retention ratio. B is equal to retention ratio. R is equal to return on equity. R is equal to return on equity. That is equal to earnings available to equity shareholders divided by equity. I'm writing all the formulas. These formulas we may or may not use in cost of a capital, but we'll be using in ratio analysis and leverages chapter. Okay. R is equal to return on equity. Return on equity is equal to earnings available to equity shareholders divided by equity. Equity is equal to equity share capital plus reserves and surplus minus fictitious assets. Equity share capital plus reserves and surplus minus what? Fictitious assets. Fictitious meaning unreal. Fictitious meaning unreal. And examples: discount on issue of debentures not written off. Discount on issue of debentures not written off. Preliminary expenses not written off, etc. P&L debit balance is also a fictitious asset. P&L debit balance is also a fictitious asset. Have you heard about fictitious asset? Fictitious means what? Imaginary, unreal. Unreal. Really, it is not an asset. Okay. So let us discuss cost of equity. Cost of a equity, KE. Okay. So let us take a small example. So for example, 200 rupees procured. 100 rupees procured from boys, debt. 100 rupees procured from equity. So 10% is debt. 10% is debt. That means rate of interest on a debt is 10%. So company has taken 100 from boys and 100 from girls. Debt and equity. Debt and equity. Clear? So for suppose this 200 rupees invested. 200 rupees invested in a business. 200 rupees invested in a business. Okay. Clear? So 50 rupees profit. 50 rupees profit for the first year. First year profit 50 rupees. Now return on investment. Return on a investment. Return on equity is different from return on a investment. Return on a investment. So return on investment is equal to EBIT divided by capital employed. And capital employed is equal to equity plus what? Debt. Long term debt. Equity plus long term debt. I'm taking a small example, 100 rupees debt and 100 rupees equity. So what is the total investment? 200. That 200 is called as what? Capital employed. Capital employed. So what is the profit? EBIT 50 rupees. So return on investment is equal to 50 divided by 200. Simple. 50 divided by 200. So what is the answer? 25%. So 25% is the return on investment. Apply common sense. 100 rupees debt, 100 rupees equity, 200 rupees invested, and 50 rupees EBIT. So what is the return? Return means benefit. What is the benefit we are getting? 50 rupees. We cannot say sales as a benefit. Sales minus variable cost minus fixed cost. EBIT is the benefit for the investors. So what is the rate of a return? 50 divided by 200. That is 25%. This 25% is called as a return on a investment. Return on a investment. Am I clear? Are able to understand the logic for this formula? EBIT. Return on equity. What is this return on equity? Return on equity means benefit to the equity shareholders. Benefit to the equity shareholders. Entire 50 EBIT is not the benefit to the equity shareholders, because we have to pay interest. So on 100 rupees, what is the rate of interest? 10%. 100 into 10%, 10 rupees. So 50 minus 10, 40. 40 rupees is the benefit to the equity shareholders. Assume there is no tax and there are no preference share capital. In my example, there is no preference share capital. What is the benefit to the equity shareholders? 40. So 40 is the benefit on equity. What is the equity amount? 100. Equity amount is 100. So simple, 40 divided by 100. So 40% is the return on equity. Return on investment is 25%. Return on equity is 40%. Simple common sense. Why return on equity is greater than return on investment? Why return on equity is greater than return on an investment? Because we are taking 100 rupees debt and investing. We are able to generate 25%, but we are giving only 10% to the debt holders. Yes or no? So the remaining 15% will be enjoyed by equity shareholders. Yes or no? So this situation is called as favorable financial leverage. Favorable financial leverage. Once again, I will repeat in capital structure. If return on investment is greater than rate of interest, here the rate of interest is 10%, return on investment is 25%. So obviously the extra 15 will be enjoyed by equity shareholders. Yes or no? So that's why we got a return on equity of 40. Return on equity, return divided by equity. What is the return to the equity shareholders? Earnings available to equity shareholders is the return. Hello, last పేరేంటమ్మా జోష్న ఎంత 45 seconds okay. So return on equity is equal to return divided by equity. So that is earnings available to equity shareholders divided by equity. Clear? Once again, we discuss these concepts in leverages and ratio analysis also. So what is the expectation of debt holders? Debt holders will expect interest. Yes or no? Debt holders will expect interest. Okay. What about equity shareholders? They will expect equity dividend. Equity dividend. Okay, fine. So for suppose equity dividend is paid, 10 rupees paid as a equity dividend. Let us assume 10 rupees paid as a equity dividend. What about next year? Next year they will expect the same 10 rupees or more than 10? More than 10. Okay, 11 rupees paid. What about next year? More than 11. What about debt? Fixed. If I pay 10 rupees, next year 10. So they will not expect any growth. They will not expect any growth. Yes or no? Because they are not the owners. They are not the owners. So they will not expect any growth. But equity shareholders will expect growth. They will expect growth in earnings or not? Obviously, they will expect earnings. I mean, growth in earnings. So that's why if you observe the first formula, this is similar to KP, cost of a preference. Cost of a preference. What is the formula? D1 by P naught or D1 by net proceeds. So this is simple. Equity shareholders will expect equity dividend on current market price. So D1 by P naught. So this is correct to some extent. But generally, so there is another perception. What is another perception? So why do the equity shareholders will expect same amount of a dividend every year? So they will not expect same amount of a dividend every year. They will be expecting what? Growth. They will expect growth. Yes or no? General common sense. Okay. So SBI has given a loan to a BCCA, for example. So if BCCA is growing, will SBI expect more interest or what? So financial position of BCCA is irrelevant to State Bank of India. Yes or no? So irrespective of financial position, I will pay fixed rate of a interest. But for suppose Monica is an investor in BCCA. So whether her expectation will remain same or not, her expectation will keeps on what? Increasing year by year, year by year. She will expect growth because she is taking risk. She is the owner of the company. She is taking risk. So that means cost means an expectation. Cost means what? Expectation. No doubt, equity shareholder will expect a dividend, but apart from dividend, they will be expecting what? Every year growth. Every year growth. Every year. So they will be expecting growth every year. So that's why what second formula? D1 by P naught plus G. G means what here? Growth rate. Growth rate. Okay, fine. Next third, E1 by P naught. Why E1 by P naught? Is the dividend per share and earnings per share same? యాక్టింగ్ చేస్తుందండి కావాలన్నట్టు పడుకున్నావా లేదా సరే E1 by P naught. Next one, E1 by P naught. E1 by P naught. Earnings per share at the end of a first year divided by what? Current market price. Then why again third formula? So payment of a dividend is mandatory or not mandatory? Not mandatory. Okay. So do you have a dividend chapter in law? Companies Act? Yes or no? So dividend will be paid on recommendation of board of directors and after approval by members in general meeting. So what does that mean? Every company will not be paying a dividend. There are a lot of companies, they will not be paying any dividend. Okay. If dividend is not paid, then what is the benefit equity shareholder is going to get? Earnings per share. Earnings per share is nothing. Earnings per share belongs to whom? Equity shareholder. Yes or no? Then what companies will do? Companies instead of paying dividend, they will retain and reinvest. If they are retaining and reinvesting, then obviously market price per share will increase. So they will get benefited by increase in the share price. Increase in the share price. Are getting my point? So there are a lot of companies, they will not be paying a dividend at all. They will not pay dividend. They what? They will be reinvesting. They will be reinvesting. In that case, cost of equity is equal to dividend 0 divided by P naught. Is it correct or not? No. If a company is not paying dividend, that means equity shareholders will not have any expectations or what? They will have an expectation. Then what? They will be expecting earnings per share. They will be expecting what? Earnings per share. So that's why K is equal to E1 divided by P naught. E1 by P naught. And again, the other perception, they will expect growth in earnings per share every year. So that's why E1 by P naught plus G. E1 by P naught plus G. Okay. So how do we find out G? G is equal to B into R. B means a retention ratio. R means a return on equity. R means a return on equity. So growth depends upon two factors. One is the retention ratio. Second is return on equity. Return on equity. So okay, retention ratio. What is payout ratio? Payout ratio. So 1 minus retention ratio. 1 minus retention ratio. For example, payout ratio 40%. Payout ratio 40%. 40%. That means retention ratio 60. Retention ratio 60. Okay. So what is this payout ratio? For example, earnings per share 100. Payout ratio 40%. That means what? Out of 100, 40 rupees is paid as a dividend. Out of 100, 40 rupees is paid as a dividend. Are you getting my point? Payout ratio 40%. That means out of 100, 40 rupees is paid as a dividend and 60 is retained by the company. 60 is retained by the company. Clear? So growth is equal to B into R. So let me take an example. So for example, Mahesh, he is earning, okay, 1 crore every year. He is earning 1 crore every year. Okay. Retention ratio 0. Retention ratio 0. Okay, let us take a small number, 1000 rupees his earnings. Retention ratio 0. Retention ratio 0 means what? He is spending 1000. He is spending all the 1000 or he is distributing this 1000 to his children. Okay. So that means retention ratio what? 0. Retention ratio 0. Will there be any growth in the wealth of a family? Simple common sense. He is not saving any money. He is not retaining. His earnings are 1000 and he is spending entire 1000 rupees or he is distributing this 1000 rupees his children. Okay. Now tell me, will there be any growth in the wealth of a family? No. Yes or no? Yes or no? So most of the families will be spending, yes or no, spending on luxurious items. So what happens then? Retention ratio 0. If retention ratio is 0, then growth 0. Simple common sense. If you have 100 rupees, you have to retain that 100 and reinvest. Then there will be a growth. If you are using that 100 rupees, then what happens? There will not be any growth. Yes or no? First one, Mahesh, he is not retaining even a single rupee. Retention ratio 0. Growth is equal to 0. Am I correct? Next, Nandan, retention ratio 100. His daily earnings 1000 rupees. Retention ratio 100. Retention ratio 100 means he is not even spending 1 rupee. He is giving entire 1000 rupees to Mrs. Nandan. Entire 1000. Now Mrs. Nandan Instead of reinvesting that 1000, she kept that 1000 rupees under pillow. From 1980s, she was doing the same. So will there be any growth or not? No growth. So demonetization has been done, yes or no? So there will not be any value for old notes also. Okay, so there will not be any growth. Why? Because return on equity is equal to 0. Return on equity is equal to 0. Clear? For example, Pandu, he is earning 1000 rupees every day. He is giving that 1000 rupees to his wife, Mrs. Pandu. And Mrs. Pandu, instead of keeping that money under pillow, she is reinvesting. She is reinvesting. Then what happens? So there will be a growth, yes or no? Earnings will grow, wealth will be increasing. So that's why some families are financially well off. If you observe the families in your relatives or something, so why they are well off, why they have a money, what is the reason? They have a retained and reinvested. They have retained and reinvested. So that's why there was a growth. So growth depends upon two factors: retention ratio and return on a equity. Return on a equity. Clear? So growth is equal to what? B into R. Again, I will explain this concept in ratio analysis with example. Right now, just G means growth rate. G is equal to what? Growth rate. Okay. Dividend per share is equal to earnings per share into payout ratio. Clear? Now come to the fifth formula. What is the fifth formula? RF plus RM minus RF into beta. Okay. So beta is also called as a systematic risk. You will get MCQ. Multiple choice question. Beta can also be called as what? Systematic risk. Beta can also be called as what? Systematic risk. Beta is also called as what? Systematic risk. Kirti, what is your name? Sandhya. Okay. For example, Pandu, retired employee, he is having a 50 lakhs provident fund. Provident fund amount 50 lakhs. Okay. He made a fixed deposit in a bank. Fixed deposit in bank. 50 lakhs. He made a fixed deposit. 7%. He is earning 7% rate of a interest. 7% rate of a interest. Or we have a treasury bills. Treasury bills. So instead of depositing, for example, Pandu, he invested money in treasury bills and rate of interest is 7%. Rate of interest 7%. Treasury bill means issued by RBI, Reserve Bank of India, 7%. 7%. Or Government of India bonds. Government of India bonds. So Pandu, he invested money in Government of India bonds and the rate of interest is what? 7%. So now tell me, so is there any risk in investing Government of India bonds or not? So there will not be any risk in investing Government of India bonds or a treasury bills. Why? Because government will not make any default. Government will repay 50 lakhs to Pandu and interest also. There is no uncertainty and there is no risk involved. There is no risk involved. Yes or no? So that 7% is called as a risk-free rate of a return. Risk-free. No risk is involved. No risk is involved. If no risk is involved, without any risk, he is earning 7%. That 7% is called as a risk-free rate of a return. Now Sandhya, okay, she wanted to start a business, okay, like S-Mart, okay. So she wanted to imitate Kmart. So she wanted to start S-Mart, okay. So how the funds are procured? How the funds are procured? Promoter will give a pitch presentation. Promoter will give a pitch presentation. Master. Promoter will give a pitch presentation. So name ఏంటమ్మా మనది Pradeep. So Pradeep and Sanya both are promoters. Pradeep and Sanya both are promoters. Okay. Most of the time they will be sleeping. Sanya and పడుకోలేదమ్మా ఓకే ఎగ్జాంపుల్కి Sanya and Pradeep both are the promoters. Both are promoters. How the funds are procured? So generally promoters will give a pitch presentation. Pitch presentation. Pitch presentation means that presentation will last from 15 minutes to 20 minutes. 15 to 20. So they have to introduce themselves. Okay, they should discuss about team, business idea, and how they are going to generate returns. So you might have watched Shark Tank program. Shark Tank. Shark Tank. So Shark Tank, generally the program is venture capitalist, they will be sitting. Venture capitalist. Who is venture capitalist? Venture capitalist means a person, okay, who has a huge money, high net worth individual. High net worth individual. Shortcut HNI. HNI. Okay, in Telugu we call them as Baga. High net worth individuals. So they will have a lot of money and they will be looking for what? Investment opportunities. Investment opportunities. So Shark Tank program is nothing but the venture capitalist, they will be sitting, and the promoter, a person, an youngster who has a startup idea, innovative idea, will come and will give a presentation. They will share their idea, presentation, okay. So they will be giving what? Presentation over their idea, and that is called pitch presentation. Pitch presentation. So right now Wi-Fi is not connected. Tomorrow I will show you the video. So the promoters will give a pitch presentation to the venture capitalist, and if a venture capitalist gets convinced, they will be investing in the company. They will buy equity share capital in the company, in startup company. Okay. So pitch presentation. Pitch presentation means the presentation given by the promoter. Given by the promoter. Okay. Now, Sandhya and Pradeep, they both gave a pitch presentation. Okay. And there are two types of a procurement. I hope you are aware. Private placement, public issue. Private placement means funds are procured from friends and relatives. Close circle. Close circle. Private placement. So private company cannot go for a public issue. Private company can procure fund by way of a private placement. Public company can go for a public issue. So if it is going for the first time to the public issue, it is called as IPO, initial public offer. And if it is going for second time or third time, it is called as a FPO, further public offer. Further public offer. Now, Sandhya and Pradeep, they have called all the close relatives and friends, and they gave a pitch presentation about S-Mart. So Pandu has got convinced. Pandu has got convinced. Pandu is having how much? Pandu is having 50 lakhs or no? Already Pandu has invested in Government of India bonds. Government of India bonds. He is earning. How much return he is earning? He is earning 7%. He is earning 7 percentage. Yes or no? He is earning already 7%. But now he got convinced by the idea presentation given by what? Pradeep and Sandhya. Okay. Now he is considering to invest money in S-Mart. Now tell me. So will he expect the same 7% or more than 7? More than? More than 7. Why more than 7? Risk is involved. They both are sleeping, yes or no? And they are starting what? S-Mart. Already there is a K-Mart. Already there is K-Mart and D-Mart. Okay, now they wanted to start what? S-Mart. So Pandu age 60. Already he might be having what? BP, sugar, what not, everything, yes or no? So at this age, instead of making investment in Government of India bonds, he is withdrawing that money and he wanted to make investment in S-Mart. Is it risky or not? Risky. So we know that if risk increases, expectation increases. That means cost of a equity. Cost of equity, KE. KE means required rate of a return to the equity shareholder. Pandu. Pandu require a return. Pandu require a return greater than risk-free rate or less than risk-free rate. So that is obvious. Greater than risk-free rate. Greater than risk-free rate. Nothing but without any risk he can earn 7%. But now he is taking risk. So that's why he wants premium. He wants premium. So that premium is called as a security risk premium. Security risk premium. So RF plus RM minus RF into beta. Beta means a risk factor. Beta means a risk factor. So we are going to learn beta concept in CMA final. How to calculate beta. What does beta denotes? So we are going to learn in CMA final. So beta is a ratio. Beta is a ratio. For example, beta is equal to 1. Beta is equal to 1. What does it mean? If a market changes by 1, for example, beta of a S-Mart is 1. Beta of S-Mart is 1. So beta of a S-Mart is 1. That means if a market changes by 1, S-Mart will also change by 1. What is market here? Market means Sensex, Nifty. Sensex or a Nifty is called as what? Market. Nifty is a composition of 50 companies. Nifty is a composition of 50 companies and Sensex 30, 31, 32. Okay, composition of 30 companies. What is this concept of Nifty and Sensex? Index. Do you know the meaning of index? General meaning index. In every book, generally we give what? Index. What does index contains? Index will communicate what actually that book contains. Yes or no? Yes or no? Index. Likewise, Sensex and Nifty is an index. Index means what? So you know the popular, the thing. So అన్నం ఉడికిందా లేదా అంటే మొత్తం తిని చూడం కదా, ఏం చేస్తాం? ఒక మెతికేదో తింటామంటారు కదా, అలానే. So there are more than 14 lakh companies in India. There are crores of businesses in India. Crores of business. If you count canteen, small businesses also, there are crores of businesses. Okay, on daily basis, a government or any other agency cannot evaluate the performance of every business. అంటే అన్నం అంతా తినలేం కదా మనం, అలానే we cannot evaluate the performance of every business. Yes or no? So to know whether the markets in India doing well or not, what we do is we take a top 50 companies in India. If those top 50 companies are performing well, that indicates markets are good in India. That means businesses are doing well in India. Are you getting my point? So the concept of Nifty or a Sensex, Nifty index, Sensex index. What is the concept of this index? Simple. If those 50 companies are performing well, what does it indicate? Indicate all the companies in India are doing well. That means markets are doing good. Markets are doing good. Okay. But so the composition of Nifty will always be the top 50 companies. Top 50. So the companies are selected mainly on the basis of market capitalization. Market capitalization. Market capitalization means the number of shares into market price per share. Number of shares into market price per share. The companies which is having a higher market value will be selected for Nifty calculation, Nifty points. So how these Nifty points are calculated? Simple. If those 50 companies market price is increasing, then the Nifty points will increase. If those 50 companies market price is decreasing, then Nifty points will decrease. Clear? Okay. So here, whenever I say market, market means what? Nifty or a Sensex is a market. Nifty is an index of National Stock Exchange. Sensex is an index of Bombay Stock Exchange. Okay. So likewise in India, we have more than 20 stock exchanges. But the popular stock exchanges are NSE and BSE. Here beta means what? Risk factor. Sensitivity. So beta means, for example, beta of a S smart is equal to 1. Beta of S smart is equal to 1. What does it mean? If a market increases by 1, S smart will also increase by 1. Okay. If a market decreases by 1, S smart decreases by 1%. If a market decreases by 20%, S smart will decrease by 20%. For suppose beta of a Kmart is equal to 5. Beta of a Kmart is equal to 5. That means if a market increases by 10, Kmart increases by 50. 5 times. This is the ratio. Beta 5 means 5 times. If a market decreases by 10%, then Kmart decreases by 50%. 50%. Okay. That means if market just changes by 10, then Kmart changes by 50. But whereas S smart will changes by what? 10 only. 10 percentage only. High beta indicates high risk. Risk means possibility of occurrence of a loss. Kmart is having a high risk because if market changes by 10, if market decreases by just 10, Kmart will decrease by 50. If a market decreases by 20, Kmart decreases by 100%. There is a high risk involved. Okay. So that's why if you observe the formula, K is equal to RF plus RM minus RF into beta. So for example, Pandu is investing in S-Mart. Then his expectation is RF plus RM minus RF into 1. RM minus RF into 1. If Pandu is investing in Kmart, then what is his expectation? RF plus RM minus RF into 5. RM minus RF into 5. Okay, that means nothing but he will be expecting more return if he is investing in S-Mart or K-Mart? K-Mart. Simple logic, if risk increases, expectation increases. Beta is a risk factor, right? If a beta increases, then obviously what K will also increase. So K is equal to RF plus RM minus RF into beta. RM means what? Market return. RM means what? Market return. RM minus RF is called as a market risk premium. Market risk premium. Okay. Market risk premium. So beta calculation now we are not going to discuss. In CMA final itself, we take 20 hours time to what? Discuss entire this concept. Okay. So K is equal to RF plus RM minus RF into beta. Beta means what? Risk factor. Pradeep, beta means risk factor. If a beta increases, beta of a risk-free security is equal to 0. Beta of a risk-free security is equal to 0. Beta 0 means no relation between risk-free security and market. Example, Government of India bonds. There is no relationship between market and Government of India bonds. Whether market increases or decreases. But Government of India bond will pay 7%. There is no risk involved. So that's why beta of a risk-free security is equal to 0. That means the second part will be 0 and the expectation will be RF. That means if investor is making investment in risk-free security, then expectation is equal to RF, risk-free rate. Clear? So CAPM is equal to RF plus K is equal to RF plus RM minus RF into beta. Beta is called as a systematic risk. Beta is called as a systematic risk. So clear? We have discussed everything or not? Fixed assets, fictitious assets means what? Unreal, imaginary. For example, if debentures are issued on discount, issued at discount. If debentures are issued at discount, what is the entry? Bank account debit, discount account debit, to debenture. Yes or no? Bank account 95, discount 5, to debenture 100. So debit balance, discount 5. Actually, discount on issue of debenture is a loss. Yes or no? This 5 rupees discount on issue of debenture will be written off. Will be written off over a redeemability period. Over a redeemability period. Yes or no? This 5 rupees will have a debit balance and will be shown on asset side of a balance sheet. Will be shown on a asset side of a balance sheet. But is it really an asset or not? It is not an asset. In reality, it is not an asset. Discount on issue of a debenture. Is it an asset? It has a debit balance, but it is not an asset. Likewise, preliminary expenses not written off. Preliminary expenses not written off. Preliminary expenses not written off is not a preliminary expenses not written off is an preliminary expenses not written off is not a asset. For example, preliminary expenses incurred. What is the entry? Preliminary expenses debit to bank. Preliminary expenses debit to bank. Yes or no? So we have not yet written off. Then that will go to balance sheet, right? Preliminary expenses to bank. That is the only entry. So what happens? That preliminary expenses will go to the balance sheet. And it will be shown on a asset side. So is it really an asset or what? It is not an asset. So it is what? A fictitious asset. Likewise, P&L debit balance. Arvind, P&L debit balance. P&L debit balance is not an asset. P&L debit balance means what? Loss. P&L debit balance means what? Loss. So whether loss is an asset or what? It is not an asset. Fictitious, unreal. So that's why what? We are reducing from equity, share capital and reserves and surplus. So equity is equal to equity share capital plus reserves and surplus minus what? Fictitious assets. Fictitious assets. Clear? Sandhya, is it clear? Okay. So you are written up to what? Cost of equity? K E. K E. Next, cost of a retained earnings, KR. Write down the last two concepts. KR, cost of a retained earnings. Cost of a retained earnings. Cost of a retained earnings. KR is equal to KR. Cost of a retained earnings. So these retained earnings belongs to whom? Debenture holders, preference holders or equity shareholders? Equity shareholders. Retained earnings will also have a cost. Equity shareholders will have a expectation on retained earnings. Equity shareholders will have a expectation on retained earnings. Yes or no? Because they can take a dividend, can invest elsewhere. But instead of taking a dividend, they are keeping that amount with the company itself. So that's why they will have a expectation. So cost of a retained earnings is equal to cost of a equity, KE. Cost of a retained earnings is equal to cost of equity, KE, into 1 minus TP. 1 minus TP. TP means personal tax rate. Personal tax rate. TP is equal to personal tax rate. Personal tax rate. Corporate tax rate is different. Personal tax rate is different. Corporate tax rate means tax rate applicable to the company. Personal tax rate means tax rate applicable to the individual investor. Okay. So KE into 1 minus TP minus what? Brokerage. So this is the cost of a retained earnings. Next, last one, weighted average cost of a capital. It is also called as overall cost of a capital. Overall cost of a capital. Overall cost of a capital, KO is equal to W1 K1 plus W2 K2 plus W3 K3 and so on. Here W1 means weight of a source 1. Weight of a source 1. K1 means cost of a source 1. Cost of a source 1. W2 means weight of a source 2. K2 means cost of a source 2. Ishwar Naik. So let me take an example. But generally, we take a table for calculation of a weighted average cost of a capital. We will not be applying this formula, Manikanda. We take what? Table. Okay. So, table columns, source, amount, amount we take book value or market value. Book value or market value. Book value means balance sheet value. Next, proportion, specific cost, proportion into specific cost. We are reaching the conclusion. Wait for 15 to 20 minutes more. Source. Source, amount, proportion, specific cost, proportion into specific cost. Source, equity share capital, మనకి కాన్సెప్ట్ కానీ థియరీ కానీ డిస్కస్ చేసేటప్పుడు నిద్ర వస్తుంది. అర్థమైందా? ప్రాబ్లం చేసేటప్పుడు ఏంటమ్మా, అప్పుడు నిద్ర ఏం రాదు మనకి కదా, అంతేనే కదా? ఓకే, నిన్నేమంటలేదమ్మా సంధ్య, జనరల్గా చెప్తున్నాను. ఇంట్రడక్షన్లో నిద్ర రావడం అనేది సహజం, కానీ ఏం చేయాలమ్మా, నిద్ర ఆపుకోవాలి. అర్థమైందా? ఆపుకుంటే అప్పుడు ప్రాబ్లమ్స్ ఏంటి, ప్రశాంతంగా చేసుకుంటూ వెళ్ళవచ్చు. ఓకే, సలగాని కాంప్రమైజ్ అయ్యారనుకోండి కష్టమైపోతుంది. చూడండి ఒకసారి, ఈక్విటీ షేర్ క్యాపిటల్. నెక్స్ట్ ఏంటమ్మా, ప్రిఫరెన్స్ షేర్ క్యాపిటల్, డెట్, రీటైన్డ్ ఎర్నింగ్స్. Example, I'm taking an example. Equity share capital, preference share capital, debt and retained earnings. So for example, equity share capital 40 lakhs, preference share capital 20 lakhs, debt 30 lakhs, retained earnings 10 lakhs. So what is the total? 1 crore. One crore is the total investment. Out of 1 crore, 40 lakhs invested from equity share capital. That means what is the proportion? 0.4. For every 1 rupee investment, 0.4 is made from equity share capital. What about next? 0.2, 0.3, 0.1. The total of proportion must always be equal to 1. Sudhamurthy, proportions 0.4, 0.2, 0.3, 0.1. కుమ్మేద్దాం గ్రూప్ 2 మామూలు కాదు. 0.4, 0.2, 0.3, 0.1. Next, specific cost. Example, I'm taking a specific cost 20%, 15%, 10%, 15%. So cost of equity will always be greater than cost of preference. Cost of preference will always be greater than cost of a debt. Why? In case of a debt, tax can be saved on payment of a interest and they will have a less expectation. Debenture holders, equity shareholders will have a high expectation and there will not be any tax savings. So that's why. So this is an example. I'm taking random numbers. How this 20% is calculated? This 20% is calculated by applying the formula RF plus Rm minus Rf into beta or D1 by P naught plus G. Okay, how this 15% is calculated? PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2. How the 10% is calculated? I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2. How this KE retained earnings 15% is calculated? KE into 1 minus TP minus brokerage. Am I clear? Now proportion into specific cost, 0.4 into 20, 8, 0.2 into 15, 3, 0.3 into 10, 3, 1.5. So what is the answer? 15.5 is what? Weighted average cost of a capital. Weighted average cost of a capital. Weighted average cost of a capital. So clear? So weighted average cost of a capital KO is equal to 15.5. So this is what the first sentence. First sentence. We have written one first sentence, right? What is the first sentence? Minimum rate of a return required by the company to meet the expectation of the investors is cost of a capital. This 15.5% I will use in capital budgeting decision and working capital management. Utilization of fund. While utilizing the funds also, I will keep this 15.5 in my mind. Because before investing, I must ensure I should get at least 15.5. If I get at least 15.5, I proceed for investment. Otherwise, what? I will not go for investment. Because to meet the expectation of my investors, I require minimum of 15.5. For suppose, if I get 15.5 on 1 crore, that means 15 lakh 50,000. Yes or no? Total investment is equal to 1 crore. So 1 crore into 15.5%. So 15 lakh 50,000. Okay, minimum rate of a return required to be earned by the company. Minimum I have to earn 15 lakh 50,000 so that I can meet the expectation of the investors. First, equity shareholders expectation 40 lakhs into 20%. Yes or no? Equity share capital investment is 40 lakhs and their expectation is 20%. 8 lakhs. Next, preference share capital. What is the amount? Preference share capital 20 lakhs into 15%. 3 lakhs. Debt 30 lakhs into 10%. Next, what? Retained earnings 10 lakhs into 15%. So I'm able to meet the expectation or not? 8 lakhs plus 6, 14 plus 15. I mean 1 lakh 50. 15 lakh 50,000. So that I can meet the expectation of a investors. Cost of a capital means minimum rate of a return required to be earned by the company to meet the expectation of a investors. If I get 15.5, that is enough to meet the expectation of a investors. So how to find out the overall expectation? First, I should find out the individual expectation. 20, 15, 10, 15. These are the individual expectations, specific cost. So that is what we have learned. How to find out cost of a debt, cost of preference, cost of equity, and cost of a retained earnings. To know the overall expectation, first I should find out what? Individual expectation. KD, KP, KE, KR. and then what? KO. So you will get 7 marks question. This is very simple. So the order is what? First you have to find out specific cost. First you have to find out specific cost. KD, KP, KE, KR. And then what? KO. For KO, these are the columns. For KO, these are the columns. What are the columns? Source, amount, proportion, specific cost, proportion into specific cost. Okay. And this 15.5%. Again, we use this 15.5 in capital budgeting. Okay. I have a proposal to start a project in Vizag. Yes, I will start a project in Vizag provided if it gives minimum 15.5. If the project is not giving 15.5, then I will not start the project in Vizag. Clearer? Okay. So with this we have completed concept. So there are few minor concepts while discussing questions. So I will explain the logic for KR also. I have not given logic for KR, cost of a retained earnings, complete logic. I will give a complete logic while discussing a questions. Okay. So after discussing practical questions, you will get more clarity. And after discussing practical questions, if you have a doubts, you can ask me. Okay. And see the link actually. First, any entrepreneur to start a business, what are the stages? First stage, decide what to buy. Estimate total investment. Estimate working capital. And next what? Tap. Identify all the sources of finance. What are all the sources available? What are all the sources available? So two aspects of financial management are procurement, effective utilization of fund. While procuring or utilizing the fund, the only objective is profit maximization, wealth maximization. Superior objective, wealth maximization. Why superior objective wealth maximization? Because wealth depends on two factors, profit and risk. Profit and risk. If a profit increases, wealth increases. If risk increases, wealth decreases. If risk increases, what happens to the required rate of return? Expectation increases. If expectation increases, value decreases. For example, we have written one formula, right? K is equal to D1 by P naught plus G. Yes or no? K is equal to, sorry, K minus G is equal to D1 by P naught. P naught is equal to D1 by K minus G. P naught means what? Current market price. D1 means expected dividend at the end of year 1. K means a required return. K means required return. G means a growth rate. Have you seen this formula before? In yesterday's class, we have discussed the fifth example, valuation of asset. Fifth example. Go through the fifth example of valuation of asset. Fifth example. Benefit for indefinite period with growth. Is it the same or not? P naught means current market price of a share. Nothing but value of a share. Simple benefit. If I purchase equity share, what is the benefit I am going to get? Dividend. K means required return. G means growth rate. Is it similar to fifth example or not? Fifth example. Okay. At the time of initial public offer, company has to quote issue price. Issue price. So this is how the issue price is calculated. There are several methods. This is one of the method. So price is equal to what? D1 divided by KE minus G. Yes or no? And KE is equal to RF plus RM minus RF into beta. Capital asset pricing model. So this is final concept, but they are testing in financial management also. K is equal to RF plus RM minus RF into beta. You apply the common sense. If beta increases, beta means what? Risk factor. If a beta increases, K increases. K increases. If you observe the P naught formula, P naught is equal to D1 divided by K minus G. K in the denominator or numerator? Denominator. If a K increases, what happens to P naught? P naught decreases. So now see the link. If risk increases, required return KE increases. Yes or no? That you can observe in this formula. If a KE increases, sorry, if risk increases, KE required return increases. If required return KE increases, what happens to the current market price? Decreases. Value decreases. That means wealth decreases. Indirectly, if risk increases, wealth decreases. So our objective must be maximization of a wealth, superior objective. Because if our superior objective is wealth maximization, then we consider what? Risk factor as well. Then we consider what? Risk factor. We keep in our mind risk. Risk also. Okay, so superior objective, wealth maximization. అర్థమైందా? Okay. So cost of our capital KD, KP, KE, KR, and next KO. అర్థమైందా? So if you have any uncleared dots or doubts, so later on అవన్నీ కనెక్ట్ అవుతాయి. నేను చాలా చెప్పుండొచ్చు, బట్ మీరు అవన్నీ రీటైన్ చేసుకోవాల్సిన అవసరం లేదు. సో వాట్ ఎవర్ రిటర్న్ ఆన్ పేపర్ దట్ యూ హ్యావ్ టు అండర్స్టాండ్. For example, I have told you about Nifty, Sensex. So that you have to understand, you need not retain it, okay? So clear? Nandan?